should also come with enormous responsibility. A big part of that responsibility is to make sure that investors, not taxpayers, are on the hook when risks at your bank don't pay off. That's why we need strong capital requirements at the biggest banks. Because of this committee, we finally have financial watchdogs in place who are now serious about the need for these protections. Common sense rules to ensure that banks can withstand losses from the riskiest financial shenanigans that create no value to the real economy. These rules protect against risky trading and derivative activities on Wall Street, the same activities that led to the 2008 financial crisis. They would close a loophole that allowed banks like SVB to hide behind an accounting fiction that lowered capital requirements and contributed to its failure. And anyone who had any doubt about whether Wall Street could be trusted to use its power responsibly need only look at the current lobbying fight on this. If you've watched the local news in Washington, if you've waited at a bus stop in Washington, if you've flown out of Washington National Airport, you've probably seen ads urging people to stop Basel Endgame. The 8 of you surely know your audience. And you haven't stopped there. You've even gone national in that campaign, pouring money into ads for Sunday Night Football. It's a campaign waged by your lobbyists to prevent financial watchdogs from putting in place these stronger capital requirements to protect our banking system and our economy. Listening to these ads, you hear all kinds of claims about how stronger rules will raise the cost of mortgages and stop small business from making loans. Wall Street banks are actually saying that cracking down on them will, quote, hurt working families. Really? You're going to say that cracking down on Wall Street is going to hurt working families? You're really going to claim that? The economic devastation of 2008 is what hurt working families. The uncertainty and the turmoil from the failure of Silicon Valley Bank hurt working families. When small businesses with their employees in Ohio, in Utah, in Minnesota, and California, and Rhode Island, and Montana, and South Carolina, across the country, didn't know if they could get access to their money and make payroll. And of course, the claims in this ad campaign simply are not true. Your game too often is to try to confuse people. Most Americans think of a bank's capital, if you force people to think about it at all, most Americans think of a bank's capital as money stashed away in a vault somewhere. But that's not what it means. You all know that. Capital is just a way to fund loans and investments and risky activities in a way that can absorb losses if things go south. It means shareholders and investors are on the hook, not taxpayers. And what those glossy ads don't tell you is that your banks have been reducing your lending to small businesses and veterans and home buyers for years now, long before the new capital requirements were proposed. Remember that. These are proposals at this point. They haven't even been implemented. Be clear, absolutely nothing in these rules would stop your banks from making loans to working families, to veterans, to homeowners, to small businesses. Absolutely nothing. The reason banks might make fewer of these good loans in the future is the same reason we've been seeing less and less productive banking activity for years. It doesn't make your banks as much money as the risky stuff. You know that. We all know that. You'd rather fund risky trading and derivatives bets than boring bread and butter small business lending. So even with this rule, you can still lend to small businesses and homeowners. You just might not increase your profits quarter over quarter by quite as much as you increased them last year. But I think most Americans would agree that that's a fair trade-off for society. More small business lending, more first-time home buyers, less chance of taxpayer bank bailouts. In exchange, maybe smaller executive bonuses and a teeny tiny bit less profit for multi-trillion-dollar Wall Street banks. We know the banking industry doesn't give up without a well-funded fight. Wall Street pours money into high-priced lobbyists to fight any effort to put the most basic guard rules on your ability to do whatever you want. What your banks want is to maximize quarterly profits. We understand that. The cost of everything and everyone else be damned. We've seen over and over what a problem that is and the harm that the current system does in places like Ohio. Earlier this year, when I first heard about SVB's collapse, my mind immediately went to another crisis in my state in East Palestine, Ohio, the place where the train derailment happened and affected dramatically a community in my state. They have one thing in common. Corporate lobbyists for years push for weaker rules, less oversight. Companies cut costs. They don't care about safety if it gets in the way of increasing profits. Working people always working people pay the price. That's why people hate Wall Street. That's why people hate Washington, because these lobbying campaigns that you've engaged in usually work. We see it over and over. We saw it during the fight to pass Dodd-Frank after the financial crisis. Many of us remember the quote from an industry lobbyist after the president signed Dodd-Frank. Now it's halftime. This time, Wall Street was true to its word. The executives whose banks failed this spring had lobbied for watered-down rules to make it easier to chase profits at all costs. They knew risks were building at their banks, but they chose to ignore those risks because it meant a bigger payout for executives at the top. So we should be concerned when the executives of even bigger banks are doing the same thing against capital requirements. Working Americans are tired of arrogant executives gambling with other people's money, then riding off in the sunset without any consequences. That's why we need to pass the Bipartisan Recoup Act. Thank you, Senator Scott, for your work on that, to hold failed bank executives accountable for driving their banks into the ground. It's why we need strong capital rules. Before your protest, I know, of course, that it wasn't your banks, the 8 of you, that failed. But after those failures earlier this year, we were reminded about how fragile our banking system could be. And as a result, your banks only got even more powerful. So it's fair to take stock of how you're using that power. I appreciate the long overdue increases in wages and benefits for many of your frontline employees. Thank you for that. At least one of your banks has made real efforts to get rid of overdraft fees. Thank you for that. But your banks need to do far better when it comes to meeting customers where they are in recognizing their dignity of work, your employees and your customers. You should be cutting prices for consumers, increasing opportunities for your employees, increasing diversity with your executive ranks, supporting your workers' efforts if they so choose to unionize. And you should stop pouring money into lobbying against efforts to protect taxpayers who in the end subsidize your entire industry. The reason for this hearing every year is to hold the biggest banks accountable to the American public. I thanked each of you for being here a moment ago. Personally, I appreciate you're all coming together for this hearing. We want to hear from you. What will you do to support workers, to invest in the real economy, to finally put Wall Street to work for Main Street? Senator Scott.
Thank you, Chairman. And thank you to a very long list of CEOs who've come to talk with us about how the impacts of our regulatory environment will impact everyday consumers. And I hope that you all, some of the things I will say will be redundant because some of it's unprepared based on what the chairman just said, but I hope you all will really answer the question. Nothing in these proposals will stop your banks from lending to small businesses or first-time home buyers. Because if the proposals Basel III endgame, who in America knows what Basel III endgame really is? Let's translate that for the average American sitting at home watching this because they have nothing else on TV to watch. It is simply requiring more capital on the sidelines, which then means fewer dollars to lend to small businesses, first-time home buyers, car loans. So the actual impact of a higher regulatory standard is fewer dollars to lend to Americans who need desperately to be engaged in the process of achieving the American dream that is typically defined by having access to capital. Oh, if you work really hard, keep your life in order, you can have a good quality middle-class life. But if you want to actually experience wealth in America, you have to experience the benefits of profit or equity. Equity comes from having capital. Having capital typically means you either have it because you were born with it, or you have access to it because you have an idea or a vision that will make your community or this nation better. When that happens, you go to a lending facility, call a bank or outside the market, and you find that capital that allows you to start your business. And as you start your business and it appreciates it, it creates a profit, and that profit allows you to experience the upper echelon of the American dream. If you have a home, you look at the differences between African Americans and majority population and net worth, tenfold difference. Much of that difference is found in the profit or the equity in a home. So when we think about the proposals, not of good regulation, but of a nightmare proposal called Basel III Endgame that would put so much more capital on the sidelines, we should ask ourselves, how does that translate for the average American living and working paycheck to paycheck? My thought is it has a devastating impact to access to capital that makes the American dream harder to achieve and access to capital for some folks who started where I started, virtually impossible. I think if you think about today's hearing from my perspective, I want to talk about three things. Number one is certainly Basel III, the end game. Number two is the burdensome regulations and guidance that will ultimately hamper consumer choice. And number three, the job our regulators are doing, or frankly should be doing, and the workplaces our regulators cultivate. I'll start, as I just did with Basel III, the end game. The fact of the matter is that this one proposal could have a devastating impact on small businesses, and I would like for you all to address that either now or during the questions. Last month, I led a letter to the FDIC, Fed, and OCC calling on them to withdraw this misguided proposal because American families, the folks who will bear the burden of this burdensome regulations, simply can't afford it. The letter was signed by nearly 80% of my Republican colleagues that really spanned the entire ideological spectrum in the country. Nearly every single person who signed the letter did so because they all agreed that costly, harmful impacts on our constituents, our businesses, and their families is something that could be avoided if simply the banking regulators would listen to common sense and withdraw the proposal. And frankly, last month when the regulators spoke, even some of my Democrat colleagues agreed with our concerns on the negative impacts brought to us by a burdensome regulatory environment. Let me be clear, this proposal could limit, and frankly, I think will limit the following: availability of credit for housing for those who need it most, severely restrict lending for small businesses that are still rebounding from the pandemic, and cut into the retirement savings for hardworking Americans like teachers, police officers, firefighters, when they're dealing with higher prices and runaway inflation brought by the radical left. These are very, very serious and real concerns. But Americans shouldn't just hear about the concerns from those of us who are senators. We should hear from those who actually run the institutions that they have entrusted and have confidence in. As a former business owner myself, I believe that you all, as the day-to-day operators of these businesses, not elected officials, have a better sense of what the communities are facing, the challenges brought upon the communities by these higher standards. Vice Chair Barr last month said that the new Basel endgame will only impact about 40 of the banks in our country. Said differently, 2/3 of all the loans processed will be negatively impacted by the endgame proposal. That's $60 billion in small business loans in 2021, $250 billion negatively impacted. And the definition of negative, higher interest rates or fewer loans in 2022. In my home state of South Carolina, that translates into $550 million of small businesses having higher interest rates or fewer loans, and $3 billion in 2022 in home mortgage originations. If regulations continue to increase the costs of providing a loan, I fear that banks will decrease lending, not only in my home state, but across the country. Decreased lending means increased financial hardship, and increased financial hardship means a reduction in opportunity. That's my ultimate concern: reducing opportunity for everyday Americans. At the end of the day, these consequences will create a ceiling for low-income Americans, and it won't be a ceiling made of glass. Instead, it will be made of concrete. We simply can't let that happen. The second item I want to discuss with you all today concerns the onslaught of rules and proposals targeting your institutions and the banking system writ large. For instance, in recent months, we've seen proposals or final rules all the way from climate risk management to the Community Reinvestment Act. None of these proposals exist in a vacuum, and it is vital that this committee hear from each of you about the overall impact on the health of our economy. In particular, I'm deeply concerned by the continued partisan attempts of this administration to advance their climate goals by any means possible, including through our banking system with the recent climate risk management guidance. Banks have been considering weather risks for decades, and you should. It's called common sense. And it remains incumbent upon each of you to base your lending decisions on risks you can reasonably assess, like weather or credit risk, not, however, perceived political, rhetorical, or reputational risk. Beyond the explicit cost of these proposals, which ultimately are passed on to consumers, I fear that the only real accomplishments of the regulators will be to push more activity outside of the regulated financial system, where we have less insight into the impacts on consumers. And finally, number three, we must emphasize and turn our attention to the performance of our regulators and their core mission, the supervision of your banks and the stability of our financial economy. This past spring, we saw the failures of several banks, which shook consumer confidence. Since then, there's been nonstop finger pointing by our regulators. In the aftermath of the failures, I was critical of the failed bank executives because that's where the dollar should stop. The buck stops with the executives. But you can't see that in a vacuum. You have to ask yourself the question, what was the role of the regulators? What did they do? What did they see? And how do they respond to that? Your institutions have teams of examiners from the regulatory agencies in your offices every day. And I can tell by your faces, you're really excited to see them when they show up. But the truth is that we, the American people, deserve to understand the complexity of the web that exists that makes the headwinds real for lending money to would-be entrepreneurs or first-time home buyers. Let me close with this. We're not on the same page on a lot of issues. I think there are times when banks go too far in getting involved in politics. But when it comes to your objective of creating access to credit, to resources for the American people and the American dream, that's where I hope we find our attention today, focused on an environment that is either easier for the average American to experience the American dream, or it's made harder because of the challenges brought to them by this government.
Thanks, Senator Scott. I'd like to introduce our 8 witnesses, and then I'm going to ask you each to stand and raise your right hand, swear you in. Charles Scharf, CEO and President of Wells Fargo, welcome. Brian Moynihan, Chair and CEO of Bank of America, welcome. Jamie Dimon, Chair and CEO of JPMorgan Chase, welcome. Jane Fraser, CEO of Citigroup, welcome. Ronald O'Hanley, CEO of State Street, welcome to you. Robin Vance, CEO of BNY Mellon, thank you for joining us. David Solomon of Goldman Sachs CEO, James Gorman, CEO of Morgan Stanley. Please stand for a moment and raise your right hand. Do you swear or affirm that the testimony you're about to give is the truth, the whole truth, and nothing but the truth, so help you God? Thank you. Make sure you take your seat, and Mr. Scharf, please begin.
Chairman Brown, Ranking Member Scott, members of the committee, thank you for the opportunity to be here today. I look forward to talking with you about the contributions Wells Fargo is making to support our customers, communities, employees, and to ensure the banking system is strong and resilient. In March of this year, we all saw the failure of several banks rapidly create instability in certain parts of the banking sector. Though the causes were specific to the institutions that failed, markets became concerned that the issues were broader. In response, Wells Fargo, along with other banks here today, stood as a source of strength and stability. The strength of our institution allowed us to lend support to a smaller bank in a time of need. These actions helped stabilize the banking system, ease consumer concerns, and keep a challenge from becoming a much broader crisis. I'm proud of the role we were able to play. Wells Fargo's strength comes from a strong financial profile, disciplined financial risk management, and a commitment to run our business with high standards. Our top priority continues to be building and running a well-controlled company. Over the past 4 years, we have simplified our business model and have exited or downsized several businesses. We are primarily a U.S. domestic bank and we do not have many complexities that running large-scale international businesses brings. Our legal entity structure and physical footprint are far simpler than many of our competitors. Approximately 90% of our revenues come from the United States. We proudly serve 1 in 3 U.S. households and more than 10% of small businesses in the U.S. We are a leading middle market banking provider here. We maintain one of the largest branch networks in the nation, and we have more rural branches than any other large bank. Nearly 30% of our branches are in low or moderate income census tracts. We are constantly improving how we serve our customers in our communities. We're investing in our branches. We're building digital capabilities to complement our physical presence, and we are investing in the products we offer to our customers. Since 2019, we have taken numerous steps to reduce and simplify fees, which as of year-end 22 have resulted in average consumer deposit account paying approximately 25% less in fees per year. We give customers the choice of an account that offers overdraft protection or one that is not subject to overdraft fees. We eliminated non-sufficient fund fees and transfer fees for customers enrolled in overdraft protection. We introduced early payday, which makes eligible direct deposits available up to 2 days early. Extra day grace, which gives eligible customers an additional business day to make deposits to avoid overdraft fees. And Flex Loan, a new digital-only small dollar loan. I'm also proud of the role we play in our communities, where we seek to have broad impact. Last year, people who work at Wells Fargo contributed over 700,000 hours of volunteer service. I've spoken in the past of our decision to take the $420 million in fees we received from administering the PPP program and donating them through local partners to small businesses in need. Through the first half of 2023, these funds have helped support more than 203,000 small businesses, the majority of them diverse-owned, and helped preserve or create nearly 254,000 jobs. Finally, we believe our employees are our greatest asset. We invest in them and we listen to them. Since 2019, we have increased wages for U.S. hourly employees by nearly 20% and increased the average pay rate for tellers by 34%. In 2022, we increased the minimum base pay for more than 40,000 employees, and we invested an additional $200 million in employee development. We have several ways for employees to share ideas or voice concerns. Their voice matters. We take their feedback seriously, and we act on their comments. For example, in our consumer bank, approximately 4,000 improvement ideas that our employees have submitted this year have been implemented or are in the process for future implementation. Engaging directly with our employees in this way is critical to improving the work experience at Wells Fargo. I want to close by thanking our employees. Their dedication is unmatched. I'm thankful for all that they do, and I remain committed to leading Wells Fargo to being one of the most respected financial institutions in the country. Thank you, and I welcome your questions.
Thank you, Mr. Moynihan. Welcome.
Chairman Brown, Ranking Member Scott, and distinguished members of the committee, good morning. I'm here once again to proudly represent my 212,000 plus Bank of America teammates. Today, I'll provide an update from last year and how we deliver responsible growth for our clients, our teammates, our communities, and shareholders every day. Responsible growth continues to deliver strong results during times of relative calm, as well as during challenging environments like we experienced earlier this year. We saw market turbulence as a limited number of financial institutions face challenges due to their unique business models. Bank of America, as we did during the pandemic, along with my colleague companies, served as a source of strength and stability for our industry and for our customers during these times. And we did this all while continuing to strengthen our balance sheet. As a GSIB, we are subject to the highest capital and liquidity requirements, and all of our metrics exceed those requirements. And while we have declared that we have the capital today to meet the proposed new capital rules, we remind you that in recent years, including this one, have shown just how important it is to have these institutions be able to position their balance sheets to help customers and clients in times of stress. That's why we continue to play an active role to help inform the future of this industry, including comments on proposed Basel III capital rule. We believe the capital accumulated by the industry should continue to serve the customers and America's economy, not be subject to regulatory capture by a theoretical model. The $30 billion in excess today at Bank of America should be used to grow the U.S. economy, to support the business plan of small business and medium-sized businesses, to help consumers buy a home and recognize the American dream. And now for a few specific examples of progress on responsible growth. At Bank of America, we serve 60 million American consumers, 11 million small business clients, and tens of thousands of commercial clients. We continue to focus on delivering expert network and guidance across our high-touch physical network. We ended the year with 3,900 financial centers and 15,500 ATMs. We opened 58 new financial centers last year and renovated 784 more of them. In addition to these branches, we have tens of thousands of teammates and serving over 100 local markets around the country. Over the next 4 years, we're expanding to Omaha, Louisville, Boise, Birmingham, Madison, New Orleans, Milwaukee, Dayton, and Huntsville. This will enable us to bring our full range of services and solutions to better serve clients and help drive local community growth and development. We also deployed our strength to low and moderate income customers, including approximately $9 billion in LMI loans to small businesses in 2022. In addition, we provided nearly $8 billion in debt and equity financing, creating more than 10,000 units of affordable housing. And we've committed $15 billion to our affordable home ownership program. That will help 60,000 American families purchase a home to ensure the American dream. Over the last few years, we've also invested in 24 minority deposit institutions. We have $2 billion outstanding to CDFIs. We've helped seed more than 150 private equity funds run by women and diverse private equity entrepreneurs. Our clients also continue to look to us to help them achieve a transition to a secure, low-carbon economy. With tens of trillions of dollars in investment needed over the next 30 years, this transition creates significant opportunities for our clients and for our company. This transition has to be led by the private sector, or it simply is not going to happen. Within our company, we continue to invest in our teammates' physical, emotional, and financial health. This includes taking steps to continue to move to our $25 U.S. minimum wage hourly wage pledge, which we increased to $23 in October. And for the 12th year in a row, U.S. teammates earning less than $50,000 annually will not see any increase in medical premiums. For the 6th year in a row, our teammates receive special sharing success bonus, generating equity ownership to over 200,000 teammates. We're a great place to work, as recognized by external parties and by our teammates. Our employee satisfaction scores remain at all-time highs, and our turnover rate is approaching an all-time low. Responsible growth also means supporting the communities where we live and work. In 2022, we made $360 million in philanthropic investments. Our teammates reported nearly 2 million volunteer hours for the year. We also create opportunity in our communities through employment. We're in the second leg of a 10,000 teammate hiring. That's 20,000 total from low and moderate income communities to work in our company. Similarly, we've hired over 15,000 veterans in the last 8 years. And importantly, responsible growth delivers for our shareholders. We have delivered strong earnings and strong returns. We continue to increase our common dividend, and we continue to return capital to shareholders. This is driving responsible growth. This is American capitalism at work. Thank you.
Thank you, Mr. Moynihan. Mr. Dimon, welcome.
Thank you, Chairman Brown, Ranking Member Scott, and members of the committee. I appreciate the opportunity to talk about JPMorgan Chase and the role of America's largest banks in supporting our economy. The United States has the best financial system in the world, where retail banks, investment banks, asset managers, investors, hedge funds, and non-banks serve the American economy. The country benefits from thousands of banks and credit unions of all sizes, covering all corners of our country. I'm very proud of this company and of the more than 300,000 employees worldwide. In the U.S., we serve more than 80 million customers, 6 million small businesses. We have more than 4,800 branches now in 48 states, almost all of your states here, and Washington, D.C., which puts a Chase branch within a 10-minute drive for 60% of the population. We are a top lender in every rural state, serving medium and large companies, local governments, hospitals, universities, farms, and manufacturers, providing almost $100 billion of credit and capital to clients in rural and small towns. JPMorgan Chase extended in total $1.7 trillion in credit to consumers and corporations in 2023. We move $10 trillion around the world every day in 120 currencies and 160 countries daily, and we safeguard more than $29 trillion in assets. The country benefits from thousands of banks and credit unions of all sizes serving all corners, and we must acknowledge that there are some things that can only be done by large and complex banks, things that are essential to a thriving U.S. economy and American competitiveness. While we are a large Main Street bank, large banks in this panel serve Americans' interests overseas. We bank America's largest multinational corporations around the world. We bank other banks and financial institutions, such as mortgage finance companies, insurance companies, the World Bank, IMF, community banks, MDIs, CDFIs. Large American banks support the deepest, transparent, and most liquid capital markets in the world. We underwrite large and complex municipal bonds, which provide governments financing for roads, bridges, schools, hospitals, and airports. And we help Americans and small businesses manage their money and finance their dreams. Our collective work is important in good times, but essential in troubled times. In good times, large banks help America save, invest, and grow. We underwrite stocks and bonds to create investments for retirees and other savers and raise money for companies, fueling job creation and new business development. As guardians of the financial system, we support our government and national security to combat financial crimes and to carry out complex operations. We are a force for good for the country, its citizens, and the global economy. In troubled time, large banks provide market stability to protect customers and employees alike. As demonstrated recently during the spring 2023 regional bank turmoil, large banks stepped in to provide market liquidity, which protected consumers, retirement savers, and employers. During COVID, we also saw America's large banks provide significant support, extending tens of billions of dollars of credit and capital to struggling large and small businesses, local governments, universities, and hospitals at a time when they needed it the most. Banks waived hundreds of millions of dollars in fees and postponed loan payments for customers struggling to make ends meet. Despite zero evidence that U.S. banks are undercapitalized today, the proposed Basel III Endgame rule, 10 years in the making, shockingly, if enacted, would increase capital requirements by about 25% for the largest banks. None of these proposed changes, by the way, would have effectively prevented the Silicon Valley Bank failure. The rule would have predictable and harmful outcomes to the economy, markets, business of all sizes, and American households in ways the Federal Reserve has not studied, contemplated, or shared. Mortgages and small business loans will be more expensive and harder to access, particularly for low to moderate income borrowers, as costs for originating and securitizing loans rise. Savings for retirement or college will yield lower returns as costs rise for asset managers, money market funds, and pension funds. Government infrastructure projects will become more expensive as capital requirements for market activities will more than double, translating to higher costs to build hospitals, bridges, and roads. From beverage companies that need to manage aluminum costs to farms that need to protect against environmental risks, if the cost of hedging these risks increases, everything from a can of soda to meat products will be impacted. Ironically, a proposal meant to mitigate risk will actually increase risk. This rule will result in an increased shift away from regulated markets to less regulated markets, which was not also studied, by the way, and this activity will be out of the sight of regulators unable to see the next crisis brewing. I fear that the proposed now, study later is becoming a troublesome new theme in Washington. There have been a number of consumer-focused products, caps and late fees or interest rates, cuts to debit interchange, to name a few, where virtually no economic analysis has been performed to determine the individual or collective impact of these rules in consumers, small businesses, lower income families, markets, or the economy. The debate should not always be about more or less regulation, about the right regulations to keep America's banking system the best in the world. I urge lawmakers and regulators to be thoughtful about the effect of arbitrary and unstudied regulatory proposals and their cumulative impact on the economy. Good regulations and good regulators are critical to maintain the strength of our banking system. Our nation should give thanks to Chairman Powell and Secretary Yellen for the tremendous work through some complicated economic times, including their work on sanctions following Russia's invasion of Ukraine and the steps they took during the regional bank turmoil this spring. These are excellent examples of how regulators working with the industry collaboratively, sharing information transparently, can protect the financial system and the country. To close, I'd like to speak to my 300,000 employees and actually maybe all bank employees around the world about how I am proud of everything they do every day in hundreds of communities around the world, serving consumers, businesses, large and small, farms, cities, schools, states, hospitals, around the clock, 24/7. Thank you very much for the great things you do for this country.
Thank you, Ms. Fraser. Welcome.
Chairman Brown, Ranking Member Scott, and esteemed members of the committee, thank you for the opportunity to speak to you this morning. As CEO, I have the opportunity to lead a 211-year-old institution that supports clients in nearly 160 markets around the world, and we have 240,000 employees, of whom I could not be more proud to lead and more grateful to. Through decades of geopolitical shifts and technological advances, we have seen how the US banking system is truly unmatched. The isolated bank failures of the spring may have tested the confidence of our people in our industry, but I am proud of how our industry, including my peers sitting around me today, how we came together and worked with the government to affirm the underlying strength and stability of the system. As we chart a path forward, we need to make sure we don't inadvertently upend the very system and unique system that we have. Our financial system is the envy of others because it is underpinned by the most competitive banking system and the deepest capital markets. We're home to banks of all sizes, each with an important role to play. Collectively, our banks serve as the engines of growth, supporting businesses and households and promoting access to financial services in hard-to-reach communities. For American multinationals, global banks such as ours offer the size and scale to help them compete overseas without having to rely on foreign banks. We finance supply chains and partner with Americans' top companies to bring products and services to American consumers at affordable prices. We use our robust balance sheets to fund transformational projects. Last year alone, Citi worked with state and local governments to raise or finance nearly $31 billion in infrastructure investment. That included financing 35,000 affordable housing units across 32 states. That's our 13th year as the country's #1 affordable housing lender. And in addition, we provide a variety of products to drive financial inclusion and work with CDFIs and MDIs to reach the underserved. As a proud participant of the OCC's Project Reach, we are co-leading the work stream that's focused on strengthening MDIs. And we are also engaged in initiatives to increase access to credit and reduce the number of Americans who are credit invisible. The strength of our financial system becomes most critical when the outlook for our economy weakens. Although we certainly don't see a drastic downturn on the horizon, history suggests that a recession is possible given the macroeconomic factors at play. And they include persistent inflation in services, rising debt, and a slowdown in global growth, as well as 2 major conflicts in Europe and the Middle East. And we're beginning to see some concerning signs in the lower FICO score segment of our customers. And this is unfortunately the very same group that feels any tightening of credit first. Raising capital requirements by as much as 20% on an industry that all participants believe is well capitalized is a bad idea in any environment. But it becomes even more problematic with economic uncertainty ahead. Almost every element of the Basel III Endgame proposal would make lending and other financial activities more expensive, especially for smaller companies and consumers. The most likely result of increasing the cost of banks to offer a variety of products is that it would move more activity into the less regulated non-bank sector, which carries its own risk for consumers and the stability of the financial system. It would also diminish our industry's ability to compete internationally, especially with our European counterparts. I raise these concerns as I know we all share the same goal, that is of maintaining a strong and competitive banking system that supports a resilient economy. Thank you, and I look forward to answering your questions later today.
Thank you, Ms. Fraser. Mr. O'Hanley, welcome.
Chairman Brown, Ranking Member Scott, and members of the committee, good morning. I am proud to serve as State Street's chairman and CEO. To start, I want to be clear on what State Street is not. We are not a consumer bank, a commercial bank, a mortgage bank, or an investment bank. We do not serve individual customers directly, and we have no retail branches. What we are is highly focused on 2 lines of business: investment servicing and investment management. Our investment servicing business, which includes custody and related services, enables our clients to invest and execute transactions daily in markets across the globe in a safe and efficient manner. Our investment management division is a pioneer in indexing and quantitative investing, creator of many of the world's first ETFs and the world's fourth largest asset manager. Our low-cost, diversified investment products are the building blocks of savings and investments around the world. Both business lines have the same corporate purpose: to create better investment outcomes for the world's institutional investors and the people they serve. Our direct clients are institutions across the globe: pension funds, mutual funds, central banks, sovereign wealth funds, endowments, foundations, and insurance companies, holders of assets for the benefits of individuals, such as retirees, savers, or students. I would like to focus a bit today on my very strong view of the value and importance of custody banks. Quite simply, strong, effective custody combined with innovation in the asset management industry is the backbone of our democratized capital market, providing investors access in a secure and cost-effective manner to the investment products they need to meet retirement and other financial goals. The safekeeping custody banks provide ensures investor assets are held and accounted for where and how they should be. This has not always been the case. From the collapse of investment trusts in the 1930s, to the failure of the Studebaker Pension Fund in 1963, to the misappropriation of the Mirror Group Pension Fund prior to Robert Maxwell's death in 1991, to the Madoff scandal uncovered in the late aughts, investors are put at risk when there is no proper custody of assets. In contrast, proper custody regulation, such as the Investment Company Act of 1940 and ERISA, coupled with the enormous investments in technology by today's custody banks, has produced a modern time near perfect track record of safekeeping assets. The recent events around FTX, which did not use bank custodians, demonstrate that more remains to be done to protect investors' assets and the financial system. In the emerging digital finance space, a comprehensive, effective regulatory framework is not yet in place, and the consequences are clear. State Street is subject to the highest level of regulation and supervision. We are well capitalized, both stressed and unstressed. Our balance sheet is conservatively positioned to deliver liquidity when our clients need it. We are subject to extensive resolution and recovery plans. We are a proven source of stability for capital markets and our customers in times of stress. Despite the challenges of COVID and the banking stress earlier this year, the 8 GSIB banks before you have done their jobs exceedingly well, partnering with regulators during COVID and the SVB First Republic crises, and providing stability to our financial system. I am proud of State Street's strong performance over these stressful periods. Looking forward, the geopolitical environment is complex and unpredictable. The US and the global economic recovery is uncertain as we all navigate higher interest rates and debt levels. And the financial services regulatory environment in the US is in flux, in many cases with unclear goals. From a State Street perspective, I am concerned with the US banking regulator's capital proposal, which I fear could negatively impact the US economy by limiting bank credit extension and impairing the ability of US banks like State Street to continue to provide high-quality custody and asset management services. I am also concerned by the SEC's proposed safekeeping rule, which, with no clear rationale, challenges some of the foundational elements of custody banking and, in effect, destroys the low-cost, near-perfect service now provided to investors. I hope these proposals can be adjusted, for if they not, they create risk of negative economic, market, and individual outcomes going forward. I am very proud of our company, our diverse workforce, and the role we play in the financial system. State Street and the other GSIB banks here are the most well-capitalized and technologically advanced financial services firms in the world. They are essential to America's competitiveness and prosperity. I look forward to our dialogue today.
Thanks, Mr. O'Hanley. Mr. Vince, welcome.
Good morning, Chair Brown, Ranking Member Scott, and members of the committee. I've had the honor of serving as the CEO of BNY Mellon for just over a year. I take this responsibility very seriously. As a company, we work for a strong, competitive banking system that serves customers and communities, supports the economy, and preserves US economic leadership. My appreciation for this role has only grown as I get to know our history, our clients, our people, and our culture. Let me start with who we are. BNY Mellon is the nation's oldest bank, founded by Alexander Hamilton in 1784. Today, we are a global financial services company with 50,000 employees. Our client base is varied, ranging from governments and pension funds to corporations and financial firms. These clients all have different needs and roles in the economy, and we provide the services to put their money to work, keeping it safe, moving it, and managing it. While we're proud of our history and our leading market positions, we do not take them for granted. They are constant reminders to earn trust and to plan for the long term. We know that our economy will face challenges. It's not a matter of if, but when and for how long. It's critical that we are prepared to operate through these different conditions, being prepared to prevent, respond, and recover. This is what we mean by resiliency. It's a basic concept and a shared goal amongst our clients, regulators, and other stakeholders. And it's embedded in our strategy. One part of being prepared is financial resiliency, having enough capital and liquidity to weather unexpected market stress. We have a strong track record, and customers consistently look to us as a dependable provider during market disruptions. We aim to manage our balance sheet conservatively with a high proportion of cash and high-quality liquid assets to adjust for changing market conditions. Another part of being prepared is operational resiliency, having the technology, the people, the processes in place to respond to events that could disrupt operations. I'm very proud of the hard work that our teams have put in to keep markets running smoothly, all through record volatility and volumes during the pandemic, wars, and market stresses. This work happens behind the scenes, and I want to commend our people who've made this happen. We have a long legacy of firsts as a company to solve problems and help move the country forward. We provided the first loan to the United States, and we were the first stock listed on the New York Stock Exchange. These actions, taken for granted today, were financial innovations at the time. But we cannot be complacent. Markets are uncertain. We must adapt to new needs and address new risks as we plan and prepare for the future. US leadership on technology, including on cyber, distributed ledger technology, and artificial intelligence, is important for our economy. This will require diligence and innovation by the public and private sectors to address them in a responsible way. Finally, I'd like to close with an emphasis on our more than 50,000 employees who do the hard work to keep our company and global markets running. Our goal at BNY Mellon is to drive a spirit of ownership, shared responsibility, and mutual success. Equity ownership in our company is an important part of this, and I'm particularly proud of our BK Shares program to grant equity to employees who otherwise would not have received stock. This program has benefited more than 45,000 employees and allowed many of them to become first-time participants in the capital markets that they help to serve. This is just one example of our culture and commitment to invest in our people and our company's long-term success. Thank you for your time, and I'm happy to answer any questions that you may have.
Thank you, Mr. Vince. Mr. Solomon, welcome.
Thank you, Chairman Brown, Ranking Member Scott, members of the committee. Thank you for giving me the opportunity to testify. I'm proud to serve as the Chairman and CEO of Goldman Sachs and lead our incredibly talented team of 45,000 people around the world as they work tirelessly to serve our clients. Goldman Sachs has a deep history spanning over 150 years as a global leader in investment banking, securities, trading, and investment management. Our size, global reach, and capabilities allows us to provide tailored services and products, aiding institutions, businesses of all size, and individuals in achieving their financial goals. We sit at the center of the U.S. capital markets, which forms the bedrock of our financial system and helps drive America's innovation. In fact, 75% of financing for U.S. businesses and state and local governments is conducted through our capital markets. A core component of our firm lies in the talent and expertise of our people and their commitment to advising our clients on buying and selling businesses, raising capital, and managing risks. In particular, Goldman Sachs serves as a crucial risk advisor to help businesses of all sizes navigate through challenges and financial risks that range from currency fluctuations and commodity price volatility to interest rate risks and various forms of credit risk. In addition, we finance infrastructure projects for local governments to invest in schools, hospitals, and roads. We also invest on behalf of our clients so that jobs can be created, retirement savings can grow, and economies can expand. We are able to facilitate all these activities because of the strength and resiliency of our balance sheet. In fact, since 2007, Goldman Sachs capital has nearly tripled, our liquidity has increased more than 5 times, and our leverage has decreased by half. In addition, the Federal Reserve stress tests have consistently confirmed that all of us here have sufficient capital to withstand a severe global recession. As an example, the scenario has included a 50% decline in equity prices within a year, in addition to separate global market shock that also features dramatic instantaneous declines in equity prices. You have the finest and most innovative financial institutions in the world represented here today, and we all served as a source of strength to the economy throughout the pandemic, the Ukraine war, and regional bank failures. Federal Reserve Chairman Powell, Treasury Secretary Yellen, and many other government officials of both political parties across 3 administrations have repeatedly stated that the largest banks are strong and well capitalized. In the wake of significant interest rate hikes, I believe the U.S. economy has proven to be more resilient than expected, and the chances of a recession have decreased, although there are many reasons to remain vigilant. We are seeing a further tightening of financial conditions. The U.S. structural debt continues to grow and become more expensive to finance, and the geopolitical stresses associated with Ukraine, China, and the Middle East could impact economic growth and stability around the world. Against this backdrop, one headwind to U.S. economic recovery is the finalization of the new capital rules referred to as Basel III Endgame. These rules were conceived to create a common set of international capital standards without raising the aggregate amount of capital. However, the U.S. proposal does exactly the opposite. It's significantly more stringent than any other jurisdiction and would increase our capital requirements by about 25%. Although this increase in capital is the result of a number of overcalibrations throughout the proposal, I want to highlight just one of the many issues that is particularly punitive to capital markets activities. The proposal nearly doubles the capital for market-making activity. These higher requirements are simply layered on top of the global market shock that I discussed moments ago without any consideration for how they interact, resulting in a significant double count. As a result, banks will need to hold capital for many of the exact same risks associated with those market activities. As of the third quarter, the institutions most impacted by this proposal amount to 2/3 of both lending and capital markets activity in the U.S. In addition, since 2010, U.S. banks have underwritten 70% of equity financing and 60% of U.S. dollar debt financing. These punitive regulatory measures also run the risk of harming U.S. competitiveness and capital market strength globally, as well as pushing activity overseas and outside of the regulated banking sector without making the U.S. system far safer. Indeed, we believe the proposal will result in increased costs for airlines, manufacturers, food producers, pensions and mutual funds, insurance companies, small businesses, and energy companies. These costs will likely get passed on to consumers. For example, it would quadruple our capital requirements for clean energy tax equity products and would increase our capital 8 times for important transactions we enter into with pension funds to improve their returns for retirees. Systemic financial stability is critical to the functioning of the U.S. economy, and we should ensure that we are only taking actions that enhance the capacity of financial institutions to support our economy and provide demonstrable systemic benefit. Thank you. I'd be happy to take any questions.
Thank you, Mr. Gorman. Welcome.
Thank you, Chairman Brown, Ranking Member Scott, members of the committee. Thanks for having us here. I'm honored to represent the Morgan Stanley employees today and for the last 14 years as their chairman and CEO. In 2021, we were still battling an extraordinary public health crisis. The economy was supported with monetary and fiscal stimulus and inflation was low. A lot has changed since. While inflation has receded from its highs, the macroeconomic environment continues to be very complex. We're also witnessing, as is obvious, substantial geopolitical challenges today.
At Morgan Stanley in our institutional businesses, we help advise private companies and public sector entities for their financing needs. That includes raising equity and debt capital to fund and grow businesses, invest in public infrastructure, ultimately contributing to the growth of the economy. We assist pension funds, mutual funds, and other financial institutions trade and manage assets around the globe. In our wealth and asset management businesses, we're managing nearly $6.2 trillion of assets for individuals and households, as well as institutions like endowments and pension funds that manage the retirements of our public employees. For millions of US households, our services help families save money for retirement and for college and for a mortgage to build home ownership. The US banking system remains strong and is the envy of the world. It is an extraordinary asset for our country. Nowhere, not China, not Europe, not South America, not the UK, not the rest of Asia, has a system remotely having these kinds of strengths. Large US banks have undergone a dramatic change in their capital and liquidity profile since the financial crisis of 15 years ago, when the US government, you, acted decisively and quickly in implementing the Dodd-Frank and CCAR reforms. As we saw earlier this year, there was a crisis among some regional banks. It was not a banking crisis. It was a crisis of 3 banks. It was in the spring, and it was quickly averted by prompt regulatory action. And with the strength and support from these large banks, we, along with 3 other banks, together provided $30 billion in uninsured deposits to First Republic to assist the regulators so that they could manage its ultimate resolution. It was gratifying, after being part of the problem in the 2008 financial crisis, to have the financial strength and stability to be part of the solution. Current proposals to put additional capital requirements, as you've heard today, on all the largest banks, the so-called Basel III endgame, need to consider the full impact of the US economy and what it will mean for US small business and consumers. Regulations are only effective when they find that balance. Blanket increases in capital for the large US banks who already undergo annual rigorous stress testing are required to maintain specific capital buffers already. Additional increases are wholly unnecessary. It will make credit more expensive, as everybody has said, make it less accessible for consumers and businesses, while harming the competitiveness of this economy, one of the great strengths of the US economy, the banking system. As it stands, the proposal would increase the cost of capital and borrowing across the economy, not just to large and small corporations, but to pensions, municipalities, and endowments. We hope the federal agencies will be open to the changes and reviewing the industry's comments thoughtfully. As a global leader in financial services, we have a responsibility to all the communities we operate. Many of those communities continue to experience social and financial challenges, and we're using our resources to help them. Finally, Mr. Chairman, your letter dated November 6, you asked me to provide additional information on a number of topics, and that's in the attached addendum. Thank you again, Chairman Brown, Ranking Member Scott, members of the committee. We look forward to your questions.
Thank you, Mr. Gorman. A productive third quarter for your banks. Your banks, as you like to say, returned capital to shareholders in the form of dividends and stock buybacks. During your earnings calls at the end of the third quarter, we heard statements about how you're going to continue to manage your businesses to deliver value to your shareholders. Of course, what we did not hear was any concern that your firms would not be able to meet the anticipated increased capital levels under Basel III endgame. If I'm mistaken, I would like you to set the record straight for the public and the investors. Do any of you have any reason to believe that your firm would not be able to achieve the increased capital requirements if Basel III was adopted as proposed? Any of you think you cannot you could not achieve the increased capital requirements? Raise your hands if you think you can't. Thank you. I think you've indicated your firms will be able to meet the enhanced capital requirements. It leads me to conclude that the proposed capital standards are not too onerous. Mr. Scharf, American support for unions, as we've discussed, is at a half-century high. Unions help ensure that workers share in a company's success through better pay and better benefits, control over their schedules, greater stability to their personal and professional lives. Workers at 2 Wells Fargo branches will be voting to unionize this month. Dozens of other union organizing drives are in the works. Wells Fargo's recent scandals highlight the pressure that overworked and underpaid workers at short-staffed branches face. One worker said, "The executives don't have to deal with the consequences of their decisions in a direct sense, but we do." Mr. Scharf, I appreciate your willingness to talk one-on-one about this with me. I remain concerned about unfair labor practices and reports that Wells Fargo is geared up in response to the union campaign. Will you remain neutral as these employees vote to organize?
Chairman Brown, I agree with your sentiment about the importance of the workers and our employees. And we've, as you know, we've done a tremendous amount to support them and we'll continue to do that. And we believe that it's best that we have a direct relationship with those employees. And we do intend to exercise our right to speak with them to make sure that they make an informed decision.
Thank you. It was an opportunity to show the American public truly a new day at Wells Fargo. I'm sorry that you failed to show that real change is afoot at your bank. Mr. Scharf, Mr. Moynihan, Mr. Dimon, and Ms. Fraser, according to CFPB, failure to invoke the Service Members Civil Relief Act interest rate reductions cost service members $100 million between 2007 and 2018. You can unilaterally act to ensure service members receive those benefits, the escrow benefits they're entitled to. Do your banks proactively check authorized military databases to identify accounts that may be eligible for escrow protections? Begin, Mr. Scharf.
Chairman, we have huge respect for those that have been in the military. Specifically to your question, I'm not sure, but certainly we'll check and get back to you.
Okay, thank you. Mr. Moynihan.
We again follow the SCRA provisions on an annual basis. We retroactively, looking back after we get notification, about $180 million a year we send back to those service members, including fees, which are not required to rebate, but we go ahead and rebate them. So I will check to make sure we're looking at all available means, but we comply with the law.
Thank you, Mr. Dimon.
I'm sure we comply with the law, but it's an opportunity to say that we hired 18,000 veterans in the last couple of years. We support the United States military. We've hired 3,000 military spouses. So we stand 100% behind the class of citizens we hold in the highest regard.
Thank you, Ms. Fraser.
Similarly, Chair Brown, we are very proud to employ many veterans, and we're incredibly grateful for everything that they do for our country. We make extensive investments in ensuring that we comply with the laws, and we do indeed tap into the database.
Thank you. Thank you for your candor about that. I urge you all to proactively check whether customers are eligible for escrow benefits. It's the type of work that you could be doing. The answers were helpful, and we will be back with all 4 of you about how we can help do that proactively. There's plenty we don't agree on. It's pretty clear. But I also want to finish somewhere we do agree. Supplemental security income. SSI provides a lifeline for 300,000 Ohioans, nearly 8 million Americans living with disabilities. The problem is SSI's eligibility rules haven't been updated by Congress. That's on us. In 40 years, they're now so outdated, they lock people in poverty. The Bipartisan Policy Center called SSI's asset limit the most regressive anti-savings provision in federal law. I have a bipartisan bill with Senator Rounds of this committee to raise the program's asset limit and stop punishing people for working and saving. Mr. Dimon, I know JPMorgan Chase is supportive of raising the asset level. I thank you for your leadership on this. Tell us briefly how it affects JPMorgan and why you're so supportive. Then I'd like to ask all of you if you would join Mr. Dimon and Senator Rounds and me in support. Mr. Dimon.
Senator, thank you. We have employees who don't want us to increase their salary because if it goes over a certain amount, they can't get that benefit, which they're entitled to. Or they can't have assets over $10,000. So this definitely should be fixed. We fully support it and try to be helpful if we can.
Thank you. Mr. Scharf, would you agree to support Mr. Dimon's position and mine?
It sounds like something that we'd be willing to support, but I'd like to take a look at it.
Okay, Mr. Moynihan, Ms. Fraser.
Fully and wholeheartedly.
Okay, Mr. Hanley.
We do support it.
Thank you, Mr. Vance.
We do support it.
Mr. Solomon.
We do support it.
Mr. Gorman.
Yes.
Thank you all, Senator Scott.
Thank you, Mr. Chairman. Question for the panel. The chairman asked a question about, can you achieve the increased capital requirements? My question is, can you achieve the increased capital requirements without negative consequences to the economy and to lending?
Senator, we do have concerns that some of the items in the proposal will lead us to either increase the price or to reduce the amount that we lend.
There's a chart in the NPR that looks deceivingly simple. It says, here's the RWA before the proposal, and here's the RWA after proposal. It says 24% increase. That is a reduction in capacity of this industry to serve its clients. No questions asked. The capital could have been used to create those additional RWA. Incremental has to be used to sustain the same activities we have today with no risk from the day before to the day after and what the enterprise does. That's the point we're trying to make, is that this is about using our capital, whether we have it or not, and whether we have it to meet the new requirements to support additional activity, not the old activity, which doesn't help the American economy.
Thank you.
I think one of the frustrations you hear from this group up here is this question should have asked before it went out. There's no question. We have to hold 30% more capital than international banks in the United States of America for every loan. A lot of loans have now fallen between, have become unprofitable. So a lot of loans, when we talk to Bill, they don't make sense for our company anymore. Small business, CDFI, solar, wind, middle market loans, certain trades you do with pension plans, et cetera. The work should have been done beforehand. By law, the QIS was the qualitative impact study should have been done beforehand. We had 10 years to do this. And it's shocking to me that we're sitting after 10 years and we're talking about what's it going to do for small business, and we have to analyze it today. It shouldn't now. We all going to fill hundreds of pages, thousands of pages of forms responding in a very detailed way to every single one of these things, but it was not thoughtfully done. I'm not sure it was shared fully among all the regulators. This should be relooked at.
And before I go to Ms. Fraser, my assumption is everyone's going to say, with consequences, that will be negative. So let me ask a different question to you, Ms. Fraser. The impact, and perhaps the unintended impact from Basel, the end game, on customers. We so often talk about the American consumer as if there's just one generic consumer out there. But from a state like South Carolina, where we have a lot of farmers, the impact on farmers and access to not only credit, but liquidity during the hard times. Can you perhaps give me a 30-second reaction to, will this have a negative impact on some of the rural communities that need derivatives? Will you walk me through that for a second?
Certainly, and thank you very much for your question, Senator. This will, to your point, increase the cost of borrowing for farmers and rural communities. It could impact them in terms of their mortgages. It could impact their credit card. It could also importantly impact their cost of any borrowing that they do. And let me give you an example. For a farmer, hedging your commodity costs and your commodity prices is an absolutely fundamental piece of providing stability and ability to sleep at night. Under the Basel III proposal, the cost of the derivatives would increase quite materially, and that would therefore have an impact on farmers' ability to do a fairly fundamental component of risk management. It could also impact their access to credit. So it's the cost of borrowing, it's the access to credit, and it's some of the fundamental tools that they need to manage their stability of their income.
Mr. Solomon, you said something earlier that I thought was really important, that as we discuss the Basel Endgame proposal and its impact on lending and on folks like me that come from poverty or looking for the ability to achieve the American dream, someone would say, contrary to what I'm talking about, maybe there are other points that are important that I'm missing in my thought process. Like, is it going to make our financial system safer? Have we not done enough work since the financial crisis of 2007 to 2009 to make sure that our financial institutions are able to meet obligations and responsibilities under an even worse case scenario? And your opening comments reflected that, yes, we can meet even a more disastrous crisis. Can you walk through the importance of the regulatory burden that exists and how the Basel Endgame would make it even harder for small business lenders or small business borrowers, but not necessarily making our economy safer?
Sure. Thank you for the question, Senator. I tried to highlight in my opening comments, and Mr. Gorman highlighted it quite clearly. These stress tests are very, very significant tests that look at very, very severe shocks to our balance sheets. I highlighted a 50% decline in equity prices over a one-year period, on top of then a simultaneous equity market shock that has looked at much as 30% instantaneous equity decline. So very, very severe shocks that we've not seen even in the worst crisis. That puts buffers in place that protect the system. Now, of course, a sound and secure system is imperative for our capital markets, and we can always have debates at the margin as to whether or not there are things that we can do that can strengthen the system. But a wholesale increase of 25% capital on the largest banks with lots of individual provisions that affect different activities, I think is ultimately punitive to economic growth and doesn't strike the right cost-benefit analysis. We, of course, need to make the system secure. The system is in good shape. We've seen that under stress. That doesn't mean there aren't things that can be done at the margin, but this is a wholesale change that leads to problems. Ms. Fraser highlighted one example talking about farmers. You can look at airlines hedging jet fuel. If you want to look at other derivatives, which obviously gets passed on to consumers, you can look at gas being hedged in utilities, which obviously gets passed on to consumers. And then you can look at other transactions. There's a provision under the rule called SFT, which allows institutions like ours to borrow securities from pension plans and give them cash. That increases the returns. It allows them to use their assets to increase the returns. Capital would increase by 8 times for those types of transactions, which would make them unattractive and therefore would diminish the ability for pensions to access that tool to increase the returns.
Thank you.
Thank you, Senator Scott. Senator Reid from Rhode Island is recognized.
Thank you very much, Mr. Chairman. And first, let me all thank you for your support of our military men and women. They are superb, and their spouses are superb. So thank you for helping them out. With respect to the legislation that we passed several years ago, the Military Lending Act, I think the key aspect is the 36% interest cap. And I think it's such a critical aspect that it should not be just a province of military personnel, but every American. I think essentially your banks collectively have made about $219 billion in profit this year, and I believe that your credit cards are not beyond 30%. So the 30%, 6% rather, interest range seems to be very appropriate. And so I can go down starting with Mr. Scharf. Would you support a national 36% interest cap?
Senator, I appreciate your thoughts on this one. I think we would be concerned about setting a flat number without really understanding what the impact could be in different inflationary environments.
Mr. Moynihan?
Senator, it's not really relevant to us. We don't engage in prime lending. I think, as Mr. Scharf said, it's a question of balance. What would it push outside the system? What would it make not available? And I think, but it's just not a relevant question for us because we don't have rates that high.
Well, I guess in a general sense, it's relevant because most of the people who use this adversely are payday lenders and rather dubious operators who will induce borrowers into arrangements which are something you wouldn't even tolerate. So I think that we've reached a point now after several years of questioning you all, and I'm not picking on you, Mr. Moynihan, to come to a conclusion. And I think the conclusion is it should. Mr. Dimon, please.
No, we don't engage in that. I completely agree with your intent. I think there should be a focus on payday lenders and check cashers and certain things like that. And we'd love to help you design it so it accomplishes the intent without any bad consequences. There are some people who make very small loans who it may stop them from doing that and actually push people into payday lending.
Ms. Fraser, please.
Senator, thank you for the question. We applaud the intent of what you're trying to do. I think as large banks, we're very mindful of our responsibilities in protecting our customers from abuses. Experience has shown that caps diminish access to credit, can do in the systems, and the Federal Reserve has a study to show that. So I think similar to my colleagues, we believe there are other ways to achieve the intent, but we'd be supportive of following up with the on how.
Mr. O'Hanley.
Senator, we don't engage in consumer lending, but we do support what you're trying to achieve there.
Thank you, sir. Mr. Vince.
Senator, we're also not in the consumer business, but we support the intent.
Thank you. Mrs. Sullivan.
We have a very, very small business in the consumer area, but we support the intent.
Thank you.
I support it, Senator. For normal, what I consider normal economic times, I actually came to this country and borrowed at 24%. So not quite your 36. I found that particularly heinous, but turned out okay. But no, I think anybody who's forced to borrow 36%, that's sort of unforgivable.
I was living in the United States when I was borrowing at 24%. In fact, I recall we had to repeal the Rhode Island legislation because it was 21%. So again, I hope to work with you on this because I think it's very important. And I don't think it'll cause the disruptions which you might anticipate. I think it can be done. And I think the other thing it should be done, and I know many of you are doing it, is to go out aggressively and start getting people banked. One of the reasons that they find themselves borrowing money from unscrupulous characters is because they have not been fully introduced to the banking system, understand that it's relatively easy and it's much more appropriate than some of these other arrangements. But thank you all, and we'll continue to work, and any advice I'd appreciate. Thank you.
Thanks, Senator Reed. Senator Rounds of South Dakota is recognized.
Thank you, Mr. Chairman, and I appreciate the plug for our bill together. We do things occasionally on a bipartisan basis, even in the banking committee, but we also have an opportunity once in a while to disagree, and sometimes that means that we get to have you folks participate in that disagreement process. Today, you're going to hear us talk a lot about consumers as they are the latest victim of heavy-handed Washington bureaucrats. In the last few months alone, financial regulators have put forth or finalized regulations and guidance that represent the biggest rewrite of banking regulation since the passage of Dodd-Frank. We've seen regulations on bank capital, long-term debt resolution planning, the Community Reinvestment Act, and climate risk management, just to name a few. However, we know that none of these regulations exist in a vacuum. Vice Chair Barr said himself that the Basel III endgame proposal is, and I quote, projected to raise capital for large banks. This may result in higher funding costs. But this is only half the story, end of quote. I want you to help tell the other half of the story. Now, I was just gonna ask this of one of you, but since our chairman has kind of set the example of asking folks to raise their hands, I'm gonna apologize in advance because I think folks hate to be put in that position. I think it's critical that you get to tell the other half of that story. None of you raised your hands when you said that it would be, that it was a case of where you couldn't meet the capital requirements. The issue is what damage it does to the economy when you're expected to raise that and the folks who need that capital. So here's my questions, and I'm going to ask you to raise your hands. I apologize for that. But if you agree with these assessments, would you please raise your hands? Do you believe in its current form, could these regulations negatively impact first-time home buyers? Do you believe in its current form, could these regulations negatively impact those saving for retirement? Do you believe that these regulations could negatively impact our farmers and our ranchers? And do you believe that these regulations could negatively impact small business owners? See, this is the rest of the story. Sometimes we think that we're just beating up on the big banks, but the bottom line is it hits the American consumer where it hurts. This is at a time that when they try to go after the big guys, it's the American consumer that will suffer. You can already see the signs of consumers struggling as they are utilizing the buy now, pay later approach to products and making late payments on credit cards. This is because Americans are paying more per month just to get by since President Biden took office. Bidenomics has led to a family of four in South Dakota needing to pay over $900 more in month just to get by for normal living expenses. I'm going to say this again, regulation does not exist in a vacuum, and the Federal Reserve must take this into account as they work towards finalizing their rulemaking. I won't embarrass you by asking you to raise your hands anymore. I apologize for that, but I think it's important that the American people see the rest of the story and who is really going to pay the bill for this overzealous approach, and without finding out the rest of the story about these types of regulations and who really gets stuck with it. In recent years, U.S. federal debt levels have climbed further, and annual interest on the debt is slated to reach over $1.4 trillion in the next decade, almost outnumbering all discretionary spending. I'm concerned about what risk rising indebtedness poses to the economy. According to recent estimates by your institutions, the Treasury will conservatively need to issue $20 trillion of debt in the coming decade. I'm not only concerned about who is going to buy this massive issuance of treasuries, but with a federal funds rate of 5%, the federal government is going to be paying even more to borrow as treasuries with near zero rates mature. Mr. Solomon, how could sustained high levels of debt have adverse effects on the U.S. Treasuries market, the dollar, and the general economy?
Thank you for the question, Senator. This is a significant issue and one I tried to highlight in my opening remarks. The growth in the U.S. Treasury debt has been very, very significant over the last 15 years. It's more than tripled. That debt will continue to grow as the cost of refinancing that debt will also grow. The Office of Budget and Management, looking out through the decade, estimates a 3.5% cost to refinance the debt, but I certainly think there are scenarios where that cost could be higher. This cost obviously hampers our ability to invest in other things, as a nation that we need. There certainly is a lot of attention and focus on things that are needed to strengthen our economy, to strengthen our society, and the cost and that burden of the debt to future generations based on decisions we've made is something that we're going to have to get focused on. As the cost of debt goes up, it certainly can create volatility in our funding treasuries. It can create volatility in the treasury market. One of the things I'm also concerned about when I look at Basel III Endgame is one of the impacts is to a business called Prime. The business of Prime finances institutions' securities positions. So asset managers, investment managers, asset management platforms that regularly trade in the treasury market provide liquidity to the treasury market. And the cost of the financing that they have to finance those positions would go up with this proposal, and it could potentially therefore impact liquidity. And so that's another risk that I think we need to look at carefully.
Thank you,
But
Mr. Solomon.
thank you.
Thank you, Mr.
Tester.
Chairman.
Senator Tester is recognized from Montana.
Yeah, I want to thank the chairman and ranking member for holding this hearing. I want to thank the panelists for your testimony and for being here today. And I also want to echo Senator Reed's comments on your support for the military, both active duty and veterans. Them and their families is very, very important. I serve as the chair of the Defense Appropriations Committee. I spend a fair amount of my time thinking about national security, how to protect against folks who want to do this nation harm, terrorist organizations, as well as foreign adversaries. You all have responsibilities, including legal responsibilities, to make sure that you're preventing hostile governments like Iran that would like to see the U.S. not exist from financing terrorist operations and other illegal activities with funds that have gone through your institution. So this would be a question for Mr. Gorman, and then not for any particular reason, it's just he's right in front of me. And then if any of you would like to add, you can. So the question is, how are you as chief executives making sure that procedures are in place and that they're followed so that your institutions do not end up inadvertently financing illicit activity?
Senator, thank you for the question. Obviously, it's critical as a good player in this country to do our best to work with the government. There are two things that I just point out. The first is what I call our cybersecurity efforts to understand incoming into the financial system. Several years ago when I started this job, I believe we were spending about $50 million on that activity. The number is closer to $1 billion now. We work very closely with all the intelligence agencies, ensuring that we have a proper cyber command to keep the financial system safe. And then secondly, as it relates to specific individuals, bad actors, governments, we have an enormous compliance effort focused on anti-money laundering to ensure that they don't get in by verifying the source of where their funds come from. Obviously, we deal with not as many clients as some of the institutions here, but we still have over 18 million individual clients and many, many tens of thousands of institutional clients. So it's an extraordinary effort with several hundred employees constantly working. Interestingly, I think the advances in AI will be a real strategic weapon in this regard.
Very good. Anybody have anything different to add? All right, thank you. Along those same lines on anti-money laundering protections and national security safeguards, Mr. Gorman talked about cybersecurity. Mr. Solomon, would you like to add anything in regards to anti-money laundering protections that you have?
I don't have anything to add that's materially different from what Mr. Gorman stated. An enormous focus. We file thousands of SARs in the course of our compliance department's financial crime team, working every day, but no difference in that focus and the intensity of that focus.
Very good. Earlier this year, Mr. Scharf, Wells paid nearly $100 million in penalties to the Fed and OFAC for violating sanctions against Iran, Syria, Sudan. I think we can all agree that's not a good thing. But what is your bank doing to make sure that these sanction violations never happen again?
Sure, Senator. Preventing bad actors from abusing our services is a top priority. We have extensive systems in place that we're constantly looking to make sure that they're as complete as they possibly be. We work in industry groups, we work with the government, and we work with the regulators to make sure that we're doing everything we possibly can to prevent that abuse.
Thank you. This goes to the non-banking world. Some of you have talked about the fact that, and maybe all of you talked about the fact that this will force, Basel will force money to go outside the traditional banking system into the unregulated banking system. Ms. Fraser, could you just talk about what kind of impact that you see that having from a, I don't know if you can project percentage of money that you would see going into the non-banking system, but it would be interesting because I remember in 2008, that was the problem. One of the problems. Go ahead.
Yes, Senator, we are worried about the migration of financial activities into the non-banking sector, particularly in a period where there is tremendous technological innovation, and making sure that we maintain the safeguards that we all invest billions of dollars in a year, be it anti-money laundering, be it fraud protection, be it cyber protection. All of these areas protect the American consumer, protect the American saver, safeguard the system, and also the critical role that all of our banks play in the global financial system as a strategic asset of the US. So we are very concerned that this will undermine some of the strength and foundations of the unique American financial system.
Thank you all. Thank you, Mr. Chairman.
Thank you, Senator Tester. Senator Tillis of North Carolina.
Thank you, Mr. Chairman. Thank you all for being here and for the preparation. I'm actually very pleased. I thought it was going to be the annual flogging of the GSIBs, but people were asking very serious questions. I'm glad to hear it. I've got a few serious questions for you all. Number one, I want to start by saying that thank goodness you're not the head of thank goodness you're not the head of an organization that's had an expose on a culture of sexual harassment and workplace hostility, because I guess if you were, every person up here would be asking for your resignation, including me. But we've got a top financial regulator that gets a pass. I don't expect you to respond to that, but it's true. That same financial regulator has implemented an SEC cyber reporting rule that now we have evidence that the ransomware companies are exploiting, right? Okay, this is a mandatory cyber reporting requirement that now a ransomware company has gone on record as reporting. I don't even want y'all to respond to that, but we've got detailed questions. We're going to ask you what impact this is. A 4-day reporting requirement, a national security waiver that you have to reapply for every 30 days and it has to be approved by the Attorney General. These people are out of control. We've got to try and repeal this one. I'm actually putting forth my first CRA to try and do that next week. Hopefully, the SEC can see that the bad guys are exploiting a rule, creating a burden for our financial services industry and not producing a good result. That's all on that. I want to go back to the operational risk question. And I think that Senator Rounds did a good job of saying this Basel III endgame is bad. It's not very well thought out, and hopefully it's going to look very differently before it gets promulgated. But who would like to speak for this group around the impact on operational risk just one more time and how we think that they've missed it in terms of the benefit? Mr. Gorman, if you could do it in 30 seconds, I would appreciate it.
It makes no sense. I mean, that's the bottom line. I've been at this for a long time. I served on the New York Fed board for years. I've seen a lot of rules. Some of them make sense, and it's a question of how far you turn the dial. This doesn't make sense. You shouldn't punish institutions for creating fee-based businesses.
Is there any evidence that that work has been done to really understand the fully burdened cost and the impact of this rule on the industry? And more importantly, people like my dad who would get 90-day notes to fund his construction job that I used to work on. Is there anything out there that I've missed in terms of the regulators actually doing an exhaustive study of the impact and the downstream implications? Are you aware of anything that I have just simply not read?
I'm not aware.
Okay, thank you. Mr. Solomon, would you go back to I think you mentioned SFT, security financial transactions. Can you go back and talk a little bit about why people in the pension business should be worried about the promulgation of this rule in about 30 seconds?
Sure. Securities financing transactions are transactions where institutions like ours borrow stock securities from pensions. We pay them cash. They can then invest that cash and earn returns. The capital in Basel III attributed to those transactions goes up by 8 times, would make the transactions uneconomical for businesses like us. So we would exit that business. That would then prevent the pensions from having that ability to increase their returns through that activity.
So anybody who is sitting on top of any sort of pension management should understand that if we implement it in its current form, their returns, at least in this segment, are likely to go down.
They are an end user that would be impacted.
Okay. Let's talk more about just I want to talk, I actually have to get something off my chest because I've heard more that I'm kind of doing that. Y'all may have noticed, but I understand that you are gaming CCAR, that somehow that you can game stress testing. That's what I'm hearing from regulators. I'm hearing from my colleagues on the other side. They'll give me an idea of how you game the system. I actually thought that this is a regimen that's provided by a supervisor or an examiner, and you've got to execute it, and then they have to measure it. Is that how it works? Any of you here want to share with me how you game the system? I used to work at Price Waterhouse. We didn't have a practice on gaming CCAR or stress testing at the time. Have y'all cracked that code? How many of y'all think it's absurd to think that people would actually assert that you could game a stress test? Okay. How many of you think that you're spending more time and money on trying to satisfy stress test requirements at the expense of looking at real risks that are unique to your banking activities?
I'll take this one.
Okay, James.
The CCAR test is 200,000 pages long. Most of us do 10, 20, 30, 40, 50 tests a week. We're quite worried about risk. It's one test. It's to the nth degree. It's a big black box. So we all agree in stress testing, that thing's just out of control.
Yeah, and you know, in closing, look, Silicon Valley was a disaster. It was a fingerprint. It was unique in terms of their activities. It was a failure of supervision, in my opinion. And one thing I hope that we have over the next year is a hearing on everybody who was in the loop, who failed to protect the investors and the depositors at Silicon Valley. Thank you, Mr. Chair.
Thank you, Senator Schultz. Senator Menendez of New Jersey is recognized.
Thank you, Mr. Chairman. For over a decade, the CFPB has stood up for everyday Americans and fought back against abusive and unlawful practices by large businesses, including some of the banks in this room. Mr. Dimon, how much money has JPMorgan Chase returned to customers in the form of redresses and payments at the direction of CFPB?
I don't know the number.
Let me help you. 360 million. Mr. Moynihan, same question.
I don't know the number specifically.
819 million. Ms. Fraser?
I don't know the number either, Senator.
1 billion. Mr. Scharf?
I don't know the number, Senator.
Well, it's over 2 billion. So from just the four of you, that's over 4 billion. It's amazing you don't know the number because they're not small in nature. Over $4 billion returned to hardworking consumers in the past dozen years. And yet this critical agency is under constant attack by my Republican colleagues. A lawsuit before the Supreme Court is threatening its very existence. And time again, we've seen why the CFPB is so necessary and why I intend to continue to fight for it. Otherwise, that would have been $4 billion out of the pockets of U.S. consumers. Now, while some banks have either decreased or eliminated overdraft fees altogether, in large part due to increased scrutiny and oversight, banks still collected an estimated $7.7 billion in 2022 in overdraft and non-sufficient fund fees. Ms. Fraser, your bank eliminated overdraft fees last year, isn't that correct?
Yes, Senator.
Is it fair to say that Citi is still a profitable bank?
Yes, Senator.
Did overdraft fees upend your business model?
No, Senator, we work hard to protect our customers and make sure that they don't fall into overdraft.
Now, the rest of the banks here that have retail operations continue, to my knowledge, to charge overdraft fees. Mr. Moynihan, Mr. Scharf, Mr. Dimon, you're all aware that Black and Hispanic households disproportionately incur overdraft and NSF fees, correct? Do you know that? Yes or no? Okay, could you give me a verbal answer, please?
I believe so.
If that's your statistic, I don't have any reason to challenge it.
Same for me.
Well, the reality is that, again, it's amazing you don't know that. Study after study have shown that the answer is yes to that question. So I suggest you call Ms. Fraser after this hearing to figure out how you can still be able to eliminate the fees in its entirety and still run a profitable bank. Charging the fees is a choice, one that disproportionately harms Black and brown communities, and it's something that you could do that would change the course of events for a significant part of the consumer base. The lawsuit currently before the Supreme Court over the CFPB's funding structure has the potential to upend every rule, guidance, and order the CFPB has ever issued, tossing over a decade of consumer protection law out of the window. That's not just harmful for consumers, I think it's dangerous to the financial system. The CFPB doesn't just issue regulations, they also provide safe harbor provisions like the qualified mortgage rule, which protects mortgage lenders from certain lawsuits. Mr. Scharf, Mr. Moynihan, Mr. Dimon, Ms. Fraser, if you were to lose this safe harbor, would it impact your bank's mortgage lending?
I don't think it would make a difference. We did mortgage lending before this, we do it afterwards.
I think it completely depends on the actual detail on the ruling.
Same, I'd like to know the specifics to draw a conclusion.
Same as my colleagues, I'd need to understand the specifics more.
Well, I'm saying if it would just if you would lose it, not if it's limited or what. If you would lose it totally, it seems to me pretty remarkable, based on previous testimony of how important the safe harbor provisions would be to banks' mortgage lending abilities, that you would suggest that it would have no effect whatsoever. We're already in the midst of an affordable housing crisis, and eliminating the CFPB and such a rule would have a disastrous impact on the mortgage market and make it harder for families to buy a home. Finally, the number of physical bank branches in the U.S. have been trending downward for some time. This has left more and more residents in so-called banking deserts, facing difficulties in carrying out basic financial tasks such as paying bills and depositing checks. A Philadelphia Reserve report found that bank closures during the pandemic resulted in the number of banking deserts in the 3rd district states of New Jersey, Pennsylvania, and Delaware rising from 48 to 63. Now, I understand part of this is mobile and online banking, but there are many who do not have the abilities to do that. What are some ways that we can ensure communities continue to have access to basic banking services?
Two things, Senator. I think if you look at the people who have big branch systems, we maintain approximately 30% of our branches Mr. Scharf said earlier, was same for us in LMI neighborhoods. But importantly, one of the things that's gone on, and you mentioned, is we're up to 97% of our LMI customers use digital banking, which then is more convenient, more safe, and reaches them where they are. And so we manage that carefully to make sure we cover every market and make the calculations. You can see that in the published statistics. But if you look at what we do as a group of institutions, we maintain that presence, but we've driven the digital and we've driven the types of accounts that are more appreciated. And that's why we're bringing 2 million people into the banking system that were unbanked a few years ago. It's largely these larger banks that have driven that.
I'd close by simply saying I would commend to all of you that you look at how your practices affect particularly minority communities, including on this issue. You have a disproportionate effect, and there's something you can do about the largest growing parts of the American society that would be beneficial to you and beneficial to them. Thank you, Mr. Chairman.
Thanks, Senator Menendez. Senator Kennedy of Louisiana is recognized. That's really good.
Unlike some, I do not think you are crooks. In fact, you're all American companies, and I'm proud of you. And I thank you for supporting the most sophisticated and powerful economy in all of human history, and the jobs you create for Americans in doing it. Mr. Dimon, since the last time the federal government raised your bank's capital requirements in Dodd-Frank and otherwise, have you had a depositor run on your bank?
We have not.
Have you failed a stress test?
We have never failed a stress test, no.
Have you ever reached a point where your liabilities were greater than your assets?
Absolutely not.
Well, unfortunately, we've had 3 banks this year that did go broke. They're mid-sized banks. You know them: Signature, Silicon Valley, First Republic. We've held hearings. In my judgment, they went broke because their management did really stupid stuff. And because the FDIC and the regulators who were in charge of keeping them from doing stupid stuff sat there like bumps on a log, sucking on their teeth, and watched them do stupid stuff. And in many cases, had to turn to you to clean up the mess. Now, in fairness to the FDIC, it may have been that the people in charge of watching those banks at the FDIC were too busy urinating off the top of a hotel or abusing young women who went to work for the FDIC. The FDIC chairman told us recently, yes, he knew about it, it happened, but he wasn't the chairman yet and didn't have the authority to stop it. Mr. Dimon, don't you find it ironic? The FDIC is now turning to you and saying, you know our track record, which is blemished at the FDIC. Your bank isn't broken, but we're going to tell you how to fix it. Do you find that ironic? They're going to tell you how to fix it based on standards put together by bureaucrats in Basel, Switzerland, not by the United States Congress. Do you find it ironic that they're telling you this and proposing this? Isn't that kind of like being given gun safety advice by Alec Baldwin?
Should I answer the question? So the major risk of those banks was hiding in plain sight, which is interest rate exposure. That was known to most people who actually could read a balance sheet and read their financial statements. And that's true. I also think
the FDIC said they didn't know. They were busy doing whatever else they were doing at the at their Gomorrah of carnal abuse over there.
I also do think you're making a good point that some of these rules were put in place, and some folks have mentioned here, are pushing business outside of the banking system. And to point out exactly what that is, it's almost 80% of the mortgage business today. It's half of the leverage lending business today. And it's a bunch of other things which people don't actually see about the plumbing of the system. And I do think it's adding risk about transparency, and a very important thing about the impact.
Let me stop you, Mr. Dimon, because I'm going to run out of time. How is this even legal under West Virginia v. EPA? You have bank regulators without clear direction from Congress who are borrowing standards from other regulators in Basel, Switzerland, imposing them on you without clear directive from Congress. It's clearly falls under the major questions doctrine. Why doesn't this violate West Virginia versus EPA? You don't have to know a law book from an LL Bean catalog to see that. Why doesn't it violate the law? Anybody?
Senator Kennedy's time has expired. Senator Warren from
Well, Ms.
Virginia.
Fraser was about to answer.
Would you like to answer, Ms. Fraser? I thought you gave her time. Proceed, please.
I think we very much appreciate your points of view, Senator, on this topic, and I think many of us would concur. While violations of law, we hope, are things that we will debate as a last resort. We would be prepared to do so because it's important that there's clarity in the law and that we abide by it.
Thank you, Mr.
Senator Warner.
Thank you, Mr. Chairman. I do find it's kind of an interesting presentation, the yin and yang of whether you're the source of all challenges or the regulators are the source of all challenges. Somehow I don't believe either presentation represents the truth. And my questions on Basel III have been raised already. I've indicated I think the timing at this moment is very problematic with interest rates as high as they are. And obviously members of the civil rights community have raised this as well. But before anybody smiles too much, I can also tell you that I get extraordinarily frustrated that any time there is any proposed new regulation or rule, the normal industry reaction is, oh my God, the sky is falling. And the same response is always, you do this, it's going to limit access to capital on Main Street. And I actually do think Senator Menendez's presentation, particularly on CFPB in terms of dollars returned, was pretty good. But I want to actually go to an issue that I've raised with many of you in the past, which is I do believe before we add new regulatory tools about the safety and soundness of our system, one of the things we actually ought to use better is some of our existing tools. Very beginning, when the Fed was stood up, the most important liquidity tool was the discount window and use of that tool. And yet we saw with the banks that failed this year, particularly in terms of SVB and Signature, they didn't even have procedures in place to know how to utilize that tool. So I think I'll start with Mr. Moynihan on this one, but I know there was guidance given out this past July to say everybody ought to get their act together. And candidly, I don't have a lot of sympathy because of the concern that many of you and other colleagues have raised that, oh my gosh, if I go to the discount window, that's going to raise a stigma with the market. Well, you can't complain about new regulations if you aren't using existing tools. So beyond the guidance that was given, why shouldn't we have, maybe on some kind of random basis, a mandatory use of the discount window so that we could start erasing that stigma to make sure that every bank, from large to small, know how to use it? Because at least in terms of liquidity, this would be the most powerful tool of all. Mr. Moynihan.
So, Senator, I think two things. One, readiness to use it. And I think you'd find that the institutions all here, because of the amount of regulation we have, are ready to use it. And that was an issue of readiness that arose. But then the second question is the stigma. And we couldn't agree more, whether it was in 7 and 8, whether it was in 2020, or whether it was last spring. Every time a crisis hits, one of the core roles of the reason why the Federal Reserve exists is to provide that liquidity at a time of stress and lender last resort. And every time we're 100% reluctant to use it as an industry because it looks like we're weak, and we've got to figure out a way to change
Somehow,
it.
again, and that's again where I think you see folks on my side of the house complain that, you know, if you're not using existing tools, well, maybe you ought to look at new tools. And I would love to engage with you. I'm going to put legislation forward that would require some mandatory usage, and maybe again how we do that on an episodic basis. But just saying we know there's a stigma problem, but we don't have a plan to address it, means that somebody that might be sometimes sympathetic to you, if we can't use that tool, my sympathy is going to go down dramatically.
We agree with you, Senator.
Let me try to hit a couple of other type. Artificial intelligence, I know, has been touched. I personally am surprised that there is not greater concern about AI in terms of using its ability to disrupt faith in the public markets. To me, it feels like if there was ever a time and a tool that has such wide-reaching implications, that FSOC, which I know his record has been somewhat mixed, but I strongly believe FSOC ought to take on the responsibility around looking at artificial intelligence in terms of safety and soundness to the overall system. Ms. Fraser, we've talked about this a little bit. What do you think on that issue?
Thank you, Senator. You're raising a very important issue and topic that has all of our attention at the moment. When we look at artificial intelligence, it's both an opportunity and a threat. On balance, we all hope it will be an opportunity to improve the strength of the financial system and of human beings, but the threats are also quite considerable. We have a lot of regulation that is in place right now that works very well to safeguard our financial system. We think that regulation should continue to be used to guide.
Let me
the
just say, I
system.
know my time's up, but I do think FSOC is a tool, and I would make the case, and as others have made the case about underserved communities. Some of you are participating in the Economic Opportunity Coalition and some of our efforts with CDFIs. That is still a tool to get into LMI communities. Those of you who are not participating, this is bipartisan, led by Deputy Secretary Ariamo out of the administration. I hope you consider it. Thank you, Mr. Chancellor.
I'll yield some of my time to him, son.
You have no time to yield,
Oh,
Senator
no.
Haggerty of Tennessee.
I tried, Warner.
Thank you, Mr. Chairman. And to all of you, welcome. I know how much you must look forward to these meetings that we have here. But today, my colleagues have focused a great deal on the Basel III endgame. It's something I'm deeply concerned about, too. What we have here in Washington, regretfully, are regulators that are in a competition with bureaucrats and other jurisdictions. They seem to be regulating for regulation's sake. I have a very difficult time when massive bodies of regulation are put forward and bureaucrats here try to tell us that the impact is going to be minimal. I'd like to quote specifically from Vice Chair Michael Barr, who's leading the effort on the Basel III endgame. He says that the impacts of the new requirements they're proposing are going to be minimal. In fact, specifically, he says, quote, "The phase-in will allow ample time for banks to adjust their balance sheets and activities and to build capital over time. In fact, most banks already have enough capital today to meet the new requirements." So the message that the public is getting is that these massive regulatory proposals they're putting forward with Basel III is going to have a very minimal impact on your banks. And I would just like to go back to the tool everybody else is using. Would anybody here that believes that the impact of Basel III would be minimal, raise your hand, please. I'd like the record to reflect, Mr. Chairman, that nobody raised their hand. No one believes that the impact will be minimal. In fact, I think one of the most infuriating patterns of behavior I see here among the regulatory class in Washington is either an unwillingness or a refusal to take into account the knock-on effects of the regulations. Mr. Dimon, I'd like to come to you. Your bank has stated publicly that the Basel endgame proposals would increase capital requirements by some $50 billion. That's not an insignificant number. There are obviously very real costs that are associated with this proposal. And I would like to get your perspective on how this proposal would impact not only your bank, but the markets and the economy more broadly.
I think, inside a bank, you try to look at every loan you make and every relationship and every client and every country. And obviously you want to do a good job for your shareholders in the long run. No one tries to be rapacious with customers or employees in the short run. And that, would it take a lot of loans and immediately make them unprofitable. And I'll give you a specific example, mortgages. I've already told our people that mortgages should not be in the balance sheet. And of course, we can't securitize them either because we haven't passed the securitization law. So it will diminish certain kind of mortgages. It'll particularly diminish mortgages for lower income people. And because the cost of all this is actually much higher on a $150,000 mortgage than on a jumbo $2 million mortgage. And I can go down the line, CDFIs, financial companies, farmers. And then we've already mentioned the extreme effect on market making, which is just a critical function to help finance companies around the world and help people manage money for retirees and veterans and state pension plans to manage their money. And so that one it's hard to figure out the full extent of that. I think it actually may cause issues in the marketplace.
All these knock-on effects, I think, are very negative. Ms. Fraser, not limited to your bank in particular, but just if you could comment on how this impacts the U.S. banking system's competitiveness on an international basis.
This diminishes the US banks' competitiveness on an international basis. I think as we've all reflected, the US financial system is the envy of the world. The US banks play an incredibly important role supporting multinationals and supporting the Western financial system and its operations. It's a strategic asset of the US.
Indeed, indeed. And I think it's incredible and competitive advantage. Yet the regulators that are focusing on Basel III seem to be hiding behind the claim that this is merely a harmonization of capital requirements. And when you think about a harmonization of capital requirements, it would lead you to believe that U.S. banking capital is somehow below that of our European competitors. And if that were the case, this might allow regulators to prevent, quote, a race to the bottom. But this is not the case. I want to quote from Chairman Powell. Chairman Powell says, quote, "The proposal exceeds what is required by the Basel Agreement, and it exceeds what's been required and what's been done by implementation by other jurisdictions." So, Mr. Solomon, I'd like to come to you. You made reference in your testimony about the competitive disadvantage that this unnecessarily stringent proposal would create for financial institutions, for the economy more broadly. And would you mind to just comment on how this proposal, if it were enacted, would compare us to other jurisdictions you're dealing around the world, but how it would make our competitiveness be affected in capital markets specifically versus other nations?
Thank you for the question, Senator. As you stated, the capital requirements in the Basel III normalization in the UK, in Europe, in Japan, and in other jurisdictions are meaningfully less significant than what's being proposed here. And so if you look at activities that we compete in around the world, particularly in market making and those types of activities, the US capital markets are the strongest capital markets in the world. I think it's one of our big competitive advantages that everyone comes from all over the world into our capital markets. If you think about IPO activity and debt capital raising, it's done to a great proportion for international capital in our capital markets on a relative basis. And this would just shift that balance. It would push more activity into other jurisdictions. It would make banks in other jurisdictions more competitive. And I don't think that strengthens the U.S. position over time.
And conversely, American banking system less competitive as well.
Thank you.
Thank you very much, Mr. Chairman.
Senator Cortez Masto of Nevada is recognized.
Thank you. Thank you, Mr. Chairman. Thank you all for being here. I know the last time you were here, we talked about affordable housing. I want to continue the conversation. As we know, not just Nevadans, but so many people across the country are struggling to afford homes. One way to do that, I believe, is by investing more in affordable housing through the Federal Home Loan Bank system. As we all know, the Federal Home Loan Banks enjoy federal benefits that really no other bank has access to in exchange for supporting affordable housing and community development across the United States. Last month, the Federal Housing Finance Agency published 2 reports. I called for them, exploring whether the Federal Home Loan Bank's hundreds of billions of taxpayer-supported dollars are being well used for affordable housing and community development. The answer, according to this report, was no. Federal Home Loan Banks currently only provide about 10% of their net income to affordable housing. I, again, believe that's too low. My question to all of you is, do you think the Federal Home Loan Bank should provide 20% or more of their net revenue for affordable housing or economic development? And does anyone not support greater affordable housing investments by the Federal Home Loan Banks? So let me ask you this. Let me just, for the record, nobody has said they don't think there should be more investment. So you think there should. Is 20% enough? Is 20% more? What more should we be looking at?
Properly done, 20% would be fine.
Does everybody agree with that? 20% would be fine? Does anybody not agree with that? Good. All right. Good start. And I'm trying to do this so you don't have to raise your hands. I don't like that either. I think that's kind of ridiculous. Let me say this. The Federal Housing Finance Agency is proposing to adjust dividends and advance rates to better reflect the bank's support of affordable housing and community development. Does anyone not support having the Federal Home Loan Bank's dividends and advances tied to missions activities of financial institutions? Is that a good start for us as we are looking at this? Does anybody have any comments regarding that and concerns? So it is a good start from what I see the nods of all of your heads. Great. Next question. FHFA has recommended that 10% of all institutions' assets be held in housing assets. 96% of credit unions would meet that test, but likely not some of our biggest banks. Under the proposed new policy, would any of your institutions invest more in housing to retain access to Federal Home Loan Bank funding? Questions, thoughts? Ever thought about it? Still need to think about it?
I think many of us meet it today, but I think, Senator, that the trick is going to Mr. Dimon's last point is if some of these rules change, we'll have to shrink our mortgages on balance sheet, which would make us less eligible and less able to live up to the principles you're doing, which is how much housing can we help drive. And so I think with everything balanced, but a lot of us meet that test today because of our business constitution.
So the concern is if the new changes in the rules might have a negative impact on what we're trying to achieve here at the end of the day.
Yeah,
Is that what I'm
mortgage
hearing?
loans are tricky to hold. And if you make them more capital intensive, they're going to be, less profitable. And if we're going to hold less of them, and already 80% of the activity goes on outside the financial institutions today. And so I think these rules may frustrate your intentions of what you're trying to do with the Federal Home Bank boards. And so we applaud that. We think more affordable housing, but you might be frustrated on the other side. So I think that's the kind of thing we worry about.
Helpful. Thank you. I want to jump to one other item around affordable housing. Currently in Southern Nevada in Clark County, which is the most populated part of our state, Clark County is looking at new ways, innovative ways to build more affordable housing. One of those is really looking at land trusts, federal land trusts. And the challenge they're having is they're not able to get any of the banks to write up the loans or the mortgages for these land trusts. And here's what I know. For decades, and this is what I want to talk to you about. For decades, banks have invested in apartment buildings that are deed restricted to require affordable rents. But in Clark County, so far, not a single bank has been willing to meet Clark County to discuss providing mortgages for deed restricted standalone homes on federal land. It's the key here is the federal land. I've worked hard to make sure more federal land is available for housing. It's frustrating to see that, unfortunately, the banks refuse to offer mortgages to new homes on federal land. The Clark County Land Trust has been looking for mortgages for 240 permanently affordable homes since August. Clark County has 2.3 million people. It's the top 30 largest metro area in the country. The county has a AA+ credit rating. So I guess my question is, what are we missing here from all of you that we need to be aware of why we can't get a bank to come work with us on this land trust?
I would love to get a team working the detail of that because I don't understand why that would be true unless there are legal things about collateral ownership or something.
Thank you. Thank you, Mr. Dimon. I appreciate it. I know my time is up.
Thanks, Senator Vance Lyle is recognized.
Thank you, Mr. Chair, and thanks to the CEOs for being here. I know a few of you personally, and I admire all of you, but one of the things that I've expressed in private and also in public is my concern that the American political system is infecting the American financial system, and frankly, the American financial system is infecting the American political system. This is a graphic compiled by my staff, which lists the ways in which your financial institutions have gotten involved in major political debates of the last few years. Things like the Georgia voter identification law, things like whether to lend to fossil fuel-based companies, things like guns and abortion. I should say, of course, that we all have our opinions on matters of public policy. Senator Cortez Masto and I disagree. But the difference between Senator Cortez Masto and I and all of you is that the people of our states elected us to do public policy. Nobody elected you. And so my counsel and my line of questioning is going to be very focused on this particular issue. Stay out of public policy unless it affects your core business interests, because if you don't, it's going to be a lot harder for us to see you guys as neutral arbiters and neutral actors in the American financial system. It's going to be much easier for us to see you as political actors. I want to focus on a couple of issues just because I think they highlight the absurdity of this, and that will lead me to my questions. Georgia in 2021 passed an extraordinarily moderate voter identification law. 6 of the 8 of you immediately issued statements criticizing the state of Georgia to that effect, or at least your institutions issued statements to that effect. Now, I should point out that New York has a voter identification law, a much more stringent voter identification law than the state of Georgia. Did any of you issue statements criticizing the state of New York for their voter identification law? Show of hands. Let the record show that none of you criticized New York for a more stringent law, but you jumped into a culture war over Georgia. I can't possibly understand why. Something that's more concerning to me, because it affects my constituents in the state of Ohio, is a lot of your approach on energy policy. We have seen over the last 18 months the consequences of reducing American energy independence. It empowers very bad people all over the world. It also impoverishes and immiserates some of my constituents and destroys their job. I'm not picking on you, Mr. Moynihan. I think you're the only bank that has a red X on every single issue. This is true of most of you. But I'm going to ask you this question about energy policy. In 2015, Bank of America committed to cut off lending by 2025, that's just a couple years from now, to companies earning 25% or more of their revenue from thermal coal mining. Now, that decision and some other decisions that have been made are raising the price of energy on Ohio consumers and imperiling the jobs of those who work in the energy sector. Why are you doing this? Did the government make you do it? And if not, why are you doing it?
Senator Vance, just to be specific, that was a statement about mountaintop removal policy. I grew up in Southern Ohio where it was called strip mining back then.
Sure.
My next door neighbor was engaged in the business. And the statement we made was we would not continue to fund people who would continue to take the tops off of the mountains in the Appalachian Mountains and turn them into mines. And that was based on our assessment of the risk at the time.
So you guys have taken a number of other energy policy decisions that raise the cost of energy in American consumers. You guys have committed to a net zero standard by which effectively there are no net zero carbon emissions. And you've held your clients to that standard, saying that they need to become aligned with net zero, and we plan to be the advisor of choice to our clients in this transition. So it's not just that particular decision, Mr. Moynihan. And again, it's not just Bank of America. My point here is pretty straightforward and simple, which is that whether we achieve net zero and when we achieve net zero is a debate for the elected representatives of the American people. What kind of voter identification law we have is a decision for the elected representatives of the American people. And every time you guys get involved in these cultural war battles, it makes it harder for the American people to see you guys as neutral financial institutions. And it frankly makes this harder for us to do the same. So I will leave you with just this thought. You've heard some very good line of questioning on Basel III. I agree with Senator Haggerty about Basel III. I don't know what some of the regulators are talking about doing. I don't think it makes a whole lot of sense. Often, bank CEOs and other financial institutions will come to Republicans for more reasonable regulations, for lower taxes, to fight it back against things like Basel III. I guess my point is, if you guys are going to use the financial power that you've accumulated to go to war against the values of our voters, impoverish our constituents who rely on cheap energy, and destroy the jobs of people who work in the energy sector, why should we listen to you when you come and ask us for a tax break or for reasonable regulations? I'm one Republican who wants to have a good relationship with you, but the more you guys insult yourself into these fights, the less good that relationship will be. Thank you all for being here.
Thanks, Senator Vance. Senator Van Hollen of Maryland is recognized.
Thank you, Mr. Chairman, and thank all of you for being here today. As many of you know, I'm a big fan of CDFIs and MDIs as vehicles for getting capital into lower income areas to small businesses in places like Baltimore. Baltimore really needs that ecosystem of CDFIs and MDIs. And as interest rates go up, of course, the cost of borrowing goes up for everybody, but often it's these entities that are hardest hit. I know all of you are involved in one way or another with CDFIs and MDIs. I know Mr. Moynihan and Mr. Scharf, your banks, your institutions have a significant presence in Baltimore. Could you just speak briefly to what your commitment is going forward and whether the higher interest rate environment is negatively impacting your determination to provide support for CDFIs and MDIs?
Senator, I'll start. I would say our commitment to working with CDFIs goes through all the cycles and is not going to be impacted by the rate environment that we see. We share your perspective that the CDFIs perform a service and reach a series of individuals in these markets that banks wouldn't normally be able to access. Whether it's the investments that we make directly in them. We've talked about what we've done with our PPP money, where a lot of it was given through CDFIs specifically because they have the ability to access, again, customers that aren't comfortable doing business with banks. Those partnerships and those commitments will continue.
Thank you.
Senator, we have $2 billion invested in CDFI country, and that has increased from about $1.5 billion 5-6 years ago up to $2 billion. And they're very interesting in the way they can help us, including most recently, a lot of us participates in a veterans loan fund where the CDFIs can work with veterans to start businesses. And that's not unique to Bank of America. Many of us participate in. We think they can reach parts of the economy with counseling and other things that are critical to the start of a small business. Not that we don't do a good job. We have $40 billion in small business loans outstanding. They grew 10% year over year. It's not that we all don't do a good job in that. It's just that they reach it. So our commitments, it's been there for many, many, many years, probably since they started. I just don't remember the history, and will remain solid through any interest rate environment.
Well, I appreciate that. And, I've worked with the chairman and Senator Warner and others. I chair the appropriations subcommittee that funds the Small Business Administration and the Treasury when it comes to CDFIs. So I look forward to really pushing hard on this as a vehicle going forward. We've had many conversations over the years about late fees. Obviously, late fees and overdraft fees have a disproportionate impact on people living paycheck to paycheck. Aaron Klein over at Brookings estimated that if the United States had adopted a real-time payment system in 2007, when the Bank of England did, American consumers, and especially the folks at the lower income end, would have saved $100 billion. And so I've been very focused on pushing the Fed to adopt the Fed Now program. We have the clearinghouse system out there as well. I do just want to get a brief sense of where we are on this. As I understand, Mr. Vince, Mr. Scharf, and Mr. Dimon, your institutions have enrolled in Fed Now. Am I right about that? Any qualifications?
That's
Yes.
correct, Senator.
I'm right. Okay. And I know, Ms. Fraser, you and I had a conversation about this just a few days ago. I understand you're working through some technical issues. Is that correct?
Yes, we will be joining the system.
All right. And Mr. Moynihan, if you could give us an update on where you are, American Express.
So Bank
of America. Sorry.
American Express isn't here. If you want to come next time,
Bank of
you'll be
America.
fine with us. We are in the process of doing the technical work, as Jane said, and so it's just a matter of time. It's a matter of when, not if, and it's just going through the systems planning.
All right. The more that you can do to push and get all your, coordinate this system, the better. My last question doesn't relate to banking specifically, but it does to an issue that the chairman and I have worked on over years with respect to trying to close a tax loophole on carried interest. I know that you're not all directly involved, but you're all involved in the finance system. You understand the workings of this. Mr. Dimon, if I could just ask you, do you agree that we should close the carried interest loophole once and for all?
Yes, I always have. I've been public about it.
I appreciate that. I would hope that we would do that because it's just egregious that it's gone on for so long. Thank you, Mr. Chairman.
Thank you, Senator Ronald. Senator Britt of Alabama is recognized.
Thank you, Mr. Chairman. It's a pleasure to be with all of you today. Thank you so much for carving out time for this. The last year, we have seen a host of incredibly complex and market-altering rules come out of nearly every financial federal agency. Interestingly, 5 of our top financial regulators sat before this very committee last month and unanimously told me that they believe the U.S. banking system to be strong, while at the same time, they argued for proposals that could fundamentally weaken it without providing any adequate answer to the question, why? You've seen actions, and we've seen them here from the Federal Reserve, the FDIC, the OOC, the CFPB, the SEC, many of which seem to go far beyond the bounds of their authority. Equally as concerning is the apparent lack of initiative by these regulators to understand both the qualitative and cumulative impacts of all of these rulemakings. For example, focusing on Basel III proposal. In this committee just a few weeks ago, Vice Chair Barr said the rule will have a, quote, minimal impact on lending that banks do, end quote. Now, I'd like to say, Mr. Scharf, I heard you earlier when I was watching say that you have the most rural branches of all the banks represented here. And my question is, can you briefly respond to that? Would this proposal only have a minimal impact on Wells Fargo's lending?
Well, Senator, we are going to be commenting to the Federal Reserve. We do think there are a series of asset classes, when you look at the increases in capital that are proposed, would affect both the availability of credit and the pricing of credit in the marketplace. And additionally, as we've seen in other asset classes, when regulation like this has taken hold, you can see substantial migration outside of the regulated banking system.
Absolutely. Thank you. At the end of the day, the GSIBs play a vital role in the U.S. economy, and I don't want to diminish that. However, I do want to focus on downstream. So impacts on, let's say, Alabama, smaller financial institutions, small businesses across the country, those in manufacturing and energy sectors, individuals seeking maybe a short-term liquidity to help pay their bills. I think the list of these potentially impacted goes on and on and on. And on this point, your banks have said that by raising capital requirements by nearly 20%, the proposal would ultimately limit access to capital across the board and undermine economic growth. Mr. Moynihan, can you briefly explain this trickle-down effect? And our banks, if your banks are squeezed by the requirements of this rule, what does this ultimately mean for maybe small business owners seeking a loan, a first-time home buyer, or a small financial institution in, let's say, Alabama?
Thank you, Senator. As Mr. Scharf said, and we talked about a lot today, if you have the same capital requirements increased by 20% to do the exact same activities you did yesterday, you have to get a higher return, and that higher return will be borne by the customer base, or you'll have to leave the business. And either one of those is not good for the customer base, and it applies across the board. In fact, the idea that this doesn't trickle down through the banking system overall, we provide services to a lot of those smaller banks. Those costs of the services will go up to them. And, so it has much more an impact than people think.
Right. And just quickly, I know I'm running out of time. I'd love an answer from all of you. Would it be an inaccurate statement for regulators to assume that under this threshold, those under the $100 billion asset mark, they have said, they won't feel the impacts of this? So my question for you is, will those institutions and people and things that I just mentioned under the $100 billion mark that are, quote, not affected by this, will they feel the impacts of Basel III? Just if we can, yes or no, down the line. Mr. Scharf, we'll start with you.
Ultimately, yes.
Absolutely. We provide them a lot of services.
Yes, the trickle-down effect is real.
Yes, it's an integrated system.
Yes, Senator, that's likely.
Yes, I agree.
Yes.
And last but not least, if this rule is implemented as written, do we risk putting the United States banking sector at a global competitive disadvantage? Mrs. Fraser, do you mind answering that?
Yes, we will. We already have a unlevel playing field with the European banks. The American banks play an incredibly important role globally in the financial system and ultimately affect the competitiveness of American companies. This is important.
Thank you, Senator Warren of Massachusetts is recognized.
Thank you, Mr. Chairman. So today I'm going to talk about how criminals are using our financial system to move money to finance terrorists, drug traffickers, and sanctioned countries like Russia and Iran and North Korea. Our witnesses are the CEOs of the largest banks in the United States, and they deal with this issue every single day. Mr. Moynihan, you are the CEO of Bank of America, so let me ask you, if a terrorist group that wanted to attack the United States tried to move money through Bank of America accounts, do you have systems in place to identify that activity, to report it to law enforcement, and to shut it down?
Yes, we do, Senator.
Okay, Mr. Dimon, you are the CEO of JPMorgan. What about you? If a terrorist group tried to move money through JPMorgan accounts, do you have systems in place to catch it, to report it, and to shut it down?
We have extensive systems in place, but no system is foolproof.
Okay, but you do have systems in place.
Extensive.
Work on this every day. And let me just ask all of you, in the interest of time, just raise your hand if you have those programs in place. Good. I see all the hands up. Look, I believe that none of you want your banks to be used to finance terrorist attacks. But let's be clear, none of you runs these anti-money laundering programs out of the goodness of your hearts. Back in 1970, Congress passed the Bank Secrecy Act to make sure that banks don't run a financial system that is open to terrorists and drug traffickers and rogue nations. But time passed and the crooks got more sophisticated. So after the 9/11 terrorist attacks, law enforcement discovered the way terrorists had gotten around the Bank Secrecy Act, and Congress was then called on to update the laws to cut off future access. And that's what Congress did. Today's terrorists have a new way to get around the Bank Secrecy Act: cryptocurrency. Last year, an estimated $20 billion in illicit crypto transactions funded every kind of dangerous criminal. North Korea has funded at least half its missile program, including nuclear weapons, using the proceeds of crypto crime. And Israeli officials have confirmed that Hamas received millions of dollars through crypto transactions, including, quote, large sums from Iran. Mr. Dimon, you've been CEO of JPMorgan for almost 2 decades. Can you explain why crypto is such an attractive financial tool for terrorists, drug traffickers, and rogue nations?
I've always been deeply opposed to crypto, Bitcoin, et cetera. You pointed out the only true use case for it is criminals, drug traffickers, anti-money laundering, tax avoidance, and that is a use case because it is somewhat anonymous, not fully, and because you can move money instantaneously, and because it doesn't go through, as you mentioned, all these systems have built up over many years, know your customers, sanctions, OFAC, they can get bypass all of that. If I was the government, I'd close it down.
Okay, well, that's what we're going to talk about. Because last week, federal law enforcement asked Congress to update the banking laws, saying, quote, we cannot rely on statutory definitions that are decades old to address the illicit finance risks that we face in 2023. And these law enforcement officials specifically called out the use of crypto to finance terrorist attacks. Now, the laws clearly need to be updated, but crypto lobbyists are working overtime to block any legislation. They claim crypto is special and it shouldn't have to comply with the Bank Secrecy Act, even if that means letting terrorists and drug traffickers and ransomware criminals and rogue nations move billions of dollars totally unrestricted. So I'd like to go down the line here. Maybe I can start with you, Mr. Scharf. Do you think that crypto companies facilitating financial transactions should have to follow the same anti-money laundering rules that your bank has to follow?
Absolutely, Senator.
Okay, I like absolutely. Let's go on down the line. Mr. Moynihan?
Absolutely. if they amend.
Okay.
Absolutely,
All right.
positively, certainly.
Unanimous, absolutely.
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 All right, it's the word of the day. You know, we've got a way to do this. Senator Marshall and I, along with 18 of our Senate colleagues, including Senator Cortez Masto, Senator Smith, Senator Fetterman, Senator Warnock, Senator Butler, who are here right now and on the Senate Banking Committee, have a bill that would do exactly what law enforcement asks. It would extend the anti-money laundering rules that banks follow so that crypto could not be used for financing terrorist attacks or North Korea's nuclear program. When it comes to banking policy, I am not usually holding hands with the CEOs of multi-billion-dollar banks, but this is a matter of national security. Terrorists, drug traffickers, and rogue nations should be barred from using crypto for their dangerous activities. It's time for Congress to act. Thank you, Mr. Chairman.
Senator Daines of Montana is recognized.
Chairman, thank you. And thanks to all of our panelists for being here today. Earlier this year, we saw a series of bank failures, which were among the largest in our nation's history. These failures, in my opinion, were due to gross mismanagement by bank executives and regulators who were also asleep at the wheel. Instead of holding accountable those in supervisory positions responsible for missing the impending crisis, regulators have decided to put forth a host of regulations that would have done nothing to prevent the failures in the first place. In fact, every regulator I have questioned this year, hearings like this, has confirmed what we all know to be true. And that is the U.S. banking system is strong, it's well capitalized. The proposals put forth by Vice Chair Barr and other regulators will limit economic growth, reduce lending to small businesses, and for those who are able to obtain financing, they're going to see increased costs. You know, I have frequent meetings with my businesses across Montana. We are a state noted for small businesses. I hear from them firsthand about the critical need for access to capital, the concern they have with pending regulations that could threaten their businesses. I questioned Vice Chair Barr before this very committee about risk weighting and public listing requirements in the Basel III Endgame proposal. Astonishingly, he claimed that small business would be better off under the proposed scheme than they are now, despite the fact that less than 0.1% of businesses are publicly listed and would qualify for the lower risk weighting. Mr. Dimon, could you speak to how the Basel III Endgame proposal would impact your ability to lend critical funds to small business and what trickle-down effects we might expect if this were to be implemented?
Yeah, so thank you for the question, Senator. I mean, first off, these questions shouldn't wait for the NPR coming out. They should have been answered way before because it's very complex. The work should have been done. The details should have been shared. Directly, it makes those loans, we either have to charge more and it'll have a lot of unintended consequences. You know, as you know, we open in Bozeman and Billings, but we have to charge more locally just to make sure we get our return on the cost of capital. Secondarily, like the operational risk capital will increase the cost of simply holding a small business checking account or making a loan. And so all these things are a cumulative effect. It'll also affect our ability to finance your local community banks, which we often do, your local affordable housing, or the Montana pension plan. So all these things will trickle through. They'll all become a little bit more expensive. And there'll be some other unintended consequences. One thing is moving out of banking, but also how we deal with customers. So I think some people will reprice, some people may drop a few customers. It also may lead to more concentration in certain ways because you're going to have to get more revenues from a client to justify the loan.
Mr. Dimon, thank you. Mr. Scharf, do you have any comments or thoughts on that as well?
I agree with what Mr. Dimon said.
Thank you. I want to shift into the issue of oil and gas investment. In this last year and a half since Russia's invasion of Ukraine, February 27th, I've had the opportunity to travel extensively throughout Europe, where I've met with leaders in virtually all the countries that border Ukraine, particularly on the west side. Been in the Baltics, also in the Balkans, as well as Ukraine border countries. One thing I've heard that's nearly universal is that they've let the whims of the day dictate their energy policy and moved too quickly away from reliable baseload forms of energy like natural gas, coal, hydropower, and nuclear. I was struck when I was in Vilnius. They took me out to their LNG facility. By the way, when that regasification, they're these floating ships, which is parked there, it's fittingly called the Independence, as this LNG really has been key. That's coming often from the United States to get Europe back on its feet to a certain extent here as it relates to energy. But I asked these folks who run the LNG plant, what did you do before you were making LNG? And I had a background in chemical engineering. I was kind of curious about process and who these people are. They said, well, we used to run the nuclear plant in Lithuania. So what do you mean you used to run it? It says, we used to supply 70% of Lithuania's electricity through a nuclear plant. But in 2009, it was shut down. So why was it shut down? It says, as a condition of joining the EU, they made them shut it down, and Lithuania went from being a net energy exporter to an energy importer. And this is just a warning thing for all of us. You can't let the whim of the moment, some particular segment of a green movement at that time was very anti-nuclear. And to their credit, it was an old Russian design, Chernobyl type reactor that needed to be changed over, but they were. Hitachi was going to build a new Japanese state-of-the-art reactor, shut the whole thing down. And they're paying a severe price for it. The need for fossil fuels is not going to dissipate in the near term. I'm very concerned the Biden administration has an all-out assault on the oil and gas industry in the United States to further their green fantasy and hallucination. We can do this the safest and the most environmentally sound way, to have a balanced energy portfolio that includes, of course, renewables and the exciting future we have in the transition. But we better make sure we think about expanding our portfolio when the world's going to need 50% more energy than it does today in the next 25 years. Mr. Dimon, can you discuss the importance?
Very briefly, 30 seconds if you can, Mr. Dimon.
Mr. Dimon, here's my question. Can you discuss the importance of having some common sense as it relates to capital requirements, lending, and so forth in the oil and gas industry?
We have to finance a transition. You need secure, safe, affordable oil and gas to do that. The oil companies are doing a great job reducing CO2. If you don't have affordable, cheaper energy, the cost on poor people, poor nations will be dramatic. We can get it done right as long as we were very thoughtful about it.
Senator Smith is recognized from Minnesota.
Thank you, Mr. Chair, and good morning to all of you, or I guess it's good afternoon now. So I'm glad to have you all with us. I'd like to start with you, Mr. Scharf. So I want to talk to you about the Community Reinvestment Act. I think that this is a really important tool for making sure that people and businesses and low and moderate income communities have access to capital and lending and financial services. And I, for one, am encouraged by the new CRA rulemaking, which I think is an important update. And I think it makes some thoughtful changes to realign the CRA with its core purpose and to give banks and financial institutions clear direction on what activities qualify for CRA credit. So, Mr. Scharf, could you tell me how you assess this final rulemaking for the CRA, and do you think that these changes will better enable banks to meet their CRA obligations?
Senator, I very much agree with your sentiment of both the importance of CRA and the need to make changes in existing CRA legislation to ensure that the ultimate goals are actually achieved through the actual legislation. I think when you look at the changes that have been made, there's certainly many items that are taken into account which are directionally supportive of what I just said. We've given some comments to the regulators about some of the specifics that we would like them to just reconsider as they work towards that goal. But directionally rethinking CRA and doing it in a way that all the regulators come together is extremely helpful.
Thank you. I agree with that. I think having everybody being on the same page was an extremely important part of this as well. Another thing that I think is true is that these updates to the CRA regs were decades overdue. So do you think that it would be helpful for regulators to update these rules more regularly to kind of have a more rapid cycle? I'm not talking about changing rules all the time, but I'm saying learning from our experience and your experience to make sure they're working well.
I mean, Senator, yes, it absolutely makes sense to relook at these things and make sure that they're having the intended consequences. And just At the same time, realize that all of those changes then filter through a lot of work that we have to do. And so just
Right.
striking that right balance is also, I think, very important.
Great, thank you. Mr. Solomon, good afternoon. It's good to see you. Many of us are giving thought to how AI, artificial intelligence, is being deployed and how we should be setting guardrails for its use, and understanding that AI has been in use for many years. I think it's true that generative AI has gotten a lot of attention over this last year, and both for its capacity and also for the limitations that have been on full view. Earlier this year, Mr. Chair, the Bing AI chatbot urged a New York Times reporter to leave his wife. And just last week, it was reported that the Amazon chatbot experienced, and I quote, severe hallucinations and leaked confidential data. So my question for you as the leader of Goldman Sachs is, how do you see using this? I know that you probably have been using our AI tools for quite a long time, but could you talk a little bit about how the generative AI projects that you're working on, how you see these being deployed internally, and how you are thinking about the appropriate guardrails?
Thank you for the question, Senator. Obviously, it's something we're very focused on. And as you highlight, there are super offensive productivity things that can be done with the technology as the technology accelerates. As you point out, we've been using artificial intelligence in our business for quite some time, but these large language models accelerate your ability to use very, very highly paid people more effectively with clients by giving them access to information and giving our clients access to information that is sorted and organized more quickly. Those are the positives. On the negatives or the defensive, the technology can obviously be used to disrupt activities, to disrupt markets. It falls into our category of thinking about cyber protection and guardrails. And so we have an enormous amount of focus in thinking through how these tools can be used to attack our systems, our platforms, et cetera. I think it's the acceleration of this technology is going to continue. The pace is quite robust. And I think there are opportunities, but we also certainly have to be vigilant to recognize that there are things that are going to develop that we can't see, and we've got to make sure we have the right protections in place.
Thank you. Ms. Fraser, I just have a couple seconds left. You and I spoke about this a little bit recently. Tell me how you think about this from Citi's perspective.
So about 4 years ago, we put some principles in place for how to use AI, and topics such as fairness and transparency in how it's used, making sure that you can understand and trace the different algorithms that are in place, elements like that, and making sure that there is human beings governing this, and make sure the protections are there so we get the opportunities realized from it, and also use it to defend against the threats.
Thank you.
Thanks, Senator Smith. Senator Fetterman from Pennsylvania is recognized.
Thank you, Mr. Chairman. Thank you. All right, Mr. Moynihan. Back in 2008, the Bank of America, your bank, didn't have enough capital to cushion the bad investments decisions that you made, and you had to be bailed out. And then in 2023 of this year, the Silicon Valley Bank didn't have maintaining enough capital and had to cost over $20 billion from the FDIC. So let me ask you, should we believe you that you have the Batman, we got this kind of an issue? Or should we able to have intervention to adjust this?
Well, Senator, I think since the financial crisis, this body, along with Congress and the president, passed the Dodd-Frank Act, and there have been, which changed the capital rules. There was an adoption of further Basel standards. On top of that, there's been 13 stress tests, if I got it right, each one of those more severe. And so even in the last 5 years, we probably have 10, 15% more capital required for under those tests. So I think there's been a significant amount of regime change made. The question is, for the institutions that failed early this year, is that none of them are captured with that scrutiny. And our view was that as a group that had to go in and do two things. One, try to keep them alive long enough so it could be resolved. And secondly, this week, soon we'll cut a check of $2.1 to $2.2 billion to the FDIC to pay for the cost of the cleanup. And our company, along with all of us, our view is that these capital rules aren't really going to address that. And there have been many capital rules applied to these institutions and the 30 stress test banks, which do apply to that. And that's why you saw us to be a source of strength earlier this year.
Oh, yeah. Well, if you felt that, we all supported those kind of changes after the crash, and then how come we have what happened at the Silicon Valley Bank now some 15 years later and if there wasn't the kind of intervention, they would have called another kind of a crash. So have we got it right yet? Should we have to make any more changes? How are you okay with this idea that a relatively small bank, especially compared to the size of all of you in front of us today, could cause a crash system-wide unless that the president had to quickly intervene and make sure that we address this? Any changes? Anything else? Or that it's okay to worry that a small bank could actually imperil our entire financial system?
I think 4,000 banks have failed over the course of time. That's what the FDIC was created to help. And they've been resolved as a
But have any of them almost crashed their entire economy or the financial system?
In 07, 08, the system was outside the system in addition to that. So many of the people up here were not bank holding companies at that time. And that was the invention of the broader purview of the banking regulatory net, the invention of the FSOC we've talked about, the invention of stress testing, the invention of all these things and Basel rules to move to a advanced methodology using models and other things to measure risk as opposed to standardized methodologies, which is what we're going back to now. All that was made to change the system. Silicon Valley didn't threaten the U.S. economy. It could have been resolved, and it was resolved.
Well, why did the president, act so swiftly if there wasn't such a concern? That's amazing that you can get, on the phone and act so quickly for that kind of money. Like, if there really wasn't such a significant risk. I mean, I wasn't read about the other 4,000 banks that crashed that, required the president to react in such a swift manner.
You'd have to ask the people. We didn't think that all that could have been resolved differently. Many of us that got involved with the First Republic transaction, the deposits we put in, but you're going to have to ask the other people why they did what they did. Like, it's not us.
Okay, so, but again, no changes are necessary, despite now that we seem to have this enduring kind of a risk that bad behavior or bad investments could actually crash, our whole financial systems.
There were specific things that happened in Silicon Valley Bank that should be addressed by regulations. And the most important one is excessive interest rate risk. That's got nothing to do with Basel III, the issue here. I think the American public should know that banks pay for the FDIC. That's not government money. That is a mutual company, and I would love to take it over and take it off your hands and manage it ourselves.
With all due respect, Mr. Dimon, I really think it really matters, who's paying for it, but the fact that anyone has to pay because of these choices are necessary. Now, my chairman, could I have, and actually, Mr. Dimon was next to my question.
Quickly.
Outstanding. All right. So, Mr. Dimon, you claim that the capital requirement and that will increase costs and reduce lending. Chase done $5.7 billion in share buybacks and $9 billion in dividends so far this year. So wouldn't it be easier just to kind of hold on to a lot of that money and lend it out? Or why would you want to give it away to the shareholders and other things like that, or buying back your own stock?
It is the shareholders' money. And we do all the proper lending we can and should do. It will reduce the profitability to a bank of doing the business. And I don't think you should be asking people to do stuff that's unprofitable for their shareholders. That's more like a charity. There's tons of that. Happy to talk about that in more detail.
Thank you, Senator Fetterman. And the committee will take under advisement Mr. Dimon's proposal to take over the FDIC.
Yeah, I would love to, if there was more time, because I would love to explain, have you explain why we should support, Democrats should support Nikki Haley for president, but I don't have the time.
Thank you, Mr. Fetterman. And while I like your ideas on SSI, Mr. Dimon, I need to think more about FDIC. Senator Warnock from Georgia is recognized.
Thank you so very much, Mr. Chair. Before I get to the question that I set out to ask, I have to respond to the senator from Ohio, not the chair, who apparently takes great umbrage to the words or the letters sent by the leaders of these institutions responding to the voter suppression bill that was passed in Georgia. I know a little something about voter suppression in Georgia. Today is, in fact, the one-year anniversary of my election in Georgia. But my election should not give people the false impression that there's no voter suppression in Georgia. It should not give us any misunderstanding about how bad a law SB 202 actually is. In fact, I had to sue the state of Georgia because at the beginning of my runoff a year ago, they decided that folks wouldn't be able to vote the first Saturday of the runoff, claiming that this was the clear letter of the law. You couldn't vote a couple of days after a holiday, that holiday being Thanksgiving, and a day that used to honor the anniversary of Confederate General Robert E. Lee. And so I had to sue them and then appeal again and again just so Georgia voters could vote. So I think that people in your position do have a corporate responsibility. And I hope you will certainly feel the freedom to lean in the places and the spaces where it's necessary. And in that vein, I want to ask you about the Safer Banking Act, legislation recently considered by this committee on cannabis banking. Many of your banks have lobbied for this bill, and the American Bankers Association, of which you all are members, supports the bill as well. I'm going to ask you to raise your hand if you support the Safer Banking Act. None of you support the Safer Banking Act. I'm going to ask you a question. Raise your hand if you support the Safer Banking Act.
Senator, we all support the intent of it. The problem is it doesn't fix the problem, and that's it. So don't take our non-essentials.
Let me ask my next question. Please raise your hand if you believe passing the Safer Banking Act will reduce the racial wealth gap. So this is interesting, and so we should have some conversation about this. The American Bankers Association, of which all of you are a part, writes that this legislation will provide, quote, legal and regulatory clarity for banks, and it would help facilitate access to financial services. My question is legal and regulatory clarity for whom, and who are we making safer? Since the war on drugs began over 50 years ago, communities across America have been decimated. They've been hollowed out. Communities all across our country in the wake of the explosion of mass incarceration, making us the mass incarceration capital of the world. Missing bodies and abandoned buildings. The war on drugs has been a war on communities of color. I want to be clear that I am open to safer banking and more regulatory clarity around cannabis, but my fear is that if we pass this bill right now, then your banks and other powerful voices will be missing in action when it comes time to address the broader harms of the war on drugs. And so I support safer banking. You all seem reluctant to say whether you support it or not. I'm concerned about equity and whether we will get that in the process. So let me ask you this. Will each of you commit to ensuring your banks will uphold the standards that would, standards in the Community Reinvestment Act, that is, which will soon have another opportunity to address? Will you support standards to increase equity as we move forward, perhaps on safer banking? Mr. Scharf?
Yes, Senator.
Mr. Moynihan?
Yes, sir.
Mr. Dimon?
Yeah, we support the intent, but I would have to see the actual words in the actual law.
Would you support efforts to be intentional about supporting equity and addressing the awful impact of 40 years of the war on drugs, which in many ways has been a war on Black and brown communities.
Yes, but I would, before I agree to something, I like to see the actual detail down to the last word.
Mr. Fraser, Ms. Fraser, I'm sorry.
Yeah. I think Senator Mr. Dimon absolutely support the intent. The details matter. We'd look at it and work with your office if we had concerns.
Mr. O'Hanley,
We support the intent.
Mr. Vince,
Similar to my colleagues, we would want to see the detail.
Mr. Solomon.
I would want to understand the detail more. We will continue to do things to support investment in underserved communities.
Exactly
Gorman.
same.
Thank you so very much. I think this is critical. There's nothing in history that suggests to me that if we leave behind these communities that are marginalized, as we make banking safer for powerful banks and people in positions who sit here and who sit there, there's nothing in history that suggests to me that we're going to go back and get those folks. And so I hope that I can continue to engage you and that as good corporate responsible citizens, you will take an active interest in this, recognizing that it's not only the right thing to do for the future of our economy, it's the smart thing to do. Thank you so much.
Thank you, Senator Warnock, and thank you for setting the record straight on the Georgia election law.
Thank you.
Senator Lemus.
Thank you, Mr. Chairman. Welcome. There's been a lot of talk today about Basel III. We know what it means for your banks. I'd like to explore for a little bit what it means for small community banks. Wyoming and other rural states rely on small community banks. And while the capital requirements apply to the systemically important banks, I would like to know if there are additional impacts on smaller community banks and their customers. So I'll address the question to Mr. Dimon and then ask anybody else who wants to take a swing at this to weigh in as well.
So thank you, Senator. I think the smaller community banks would say they're not directly affected by this, but since a lot of us up here bank those banks, we bank their retirement funds, we bank their cities, we bank other small businesses, we bank local schools, cities, states, hospitals. It will trickle down to higher costs to them in one way or the other. It also changes the competitive landscape. It may in some ways make it harder for them to compete with us as opposed to less hard.
Would anyone else like to take a swing at that one? Thank you. Americans interact with a financial institution through their banks, and they save like for kids' college education with mutual funds and protect their families with insurance. Can you explain why ultimately these changes will impact families planning for the future? So my question is, what are the impacts of Basel III on pensions, mutual funds, insurance companies, and other users of derivatives who hedge? Now, hedging in my industry, agriculture, is very important. So I'm interested in the implications for hedging and the other entities I mentioned. Perhaps Ms. Fraser, would you address this?
Yes, hedging plays a very important role for protecting against risk and helping mitigate risk, particularly when we're in very volatile times at the moment. It's important for providing stability and income flows. And commodity hedging is a critical piece for any farmer in America. So the increase in capital associated with the Basel III rule will have an impact on the cost of that hedging and potentially even the provision of that hedging. And as you say, it permeates many different parts of our economy and society. It's not just for the most sophisticated players.
I want anyone who's interested in responding to this question to take it. One of the things that my staff observed is that one of the most poorly thought out parts of Basel III is how public listings are used as a proxy for counterparty risk in derivatives, counterparty credit risk in derivatives. So it looks like this will harm at a minimum nearly 70 million households who invest in mutual funds. I'd like to know if you agree with my staff's concern and how we might address that. And this is for anyone who wishes to take it. Yes, sir.
It's a very crude measure of risk and doesn't reflect the fact that some of the largest and most sophisticated companies in America are public. So it's just putting in one basket, saying that by definition, if you're not public, and if you look at the trends, in fact, fewer and fewer companies are public these days. That's a whole different kind of debate that we can get into some other time, but it's a terribly crude measure.
Do you know why they chose to make public versus private companies different and treat them different in terms of using them as a proxy for counterparty credit risk and derivatives? Anyone? Well, we don't know either, so we're all in the dark. Okay, question. Why is it, and this again is for anyone who wishes to weigh in, why is it so important that the United States have a regulatory framework that allows our financial institutions to compete on the global stage? As we see the rise of China asserting the influence of the yuan all over the world, help me understand why we have to stay competitive.
I speak as an immigrant to the States. America plays a critical role around the world in terms of supporting supply chains, in terms of the risk management tools it provides, the stability it provides to populations all over the world, the investment flows. We account for over 50% of all of the capital activity and investment activity in the world. That is a strategic asset for America. It's something we should be incredibly proud of, and it's something that we need to defend.
Anyone else?
Okay,
Oh, yeah.
anybody else want to answer? Sure. Okay. I think when you're next to the last, people are getting kind of tired. So
Thank you so
thank
much.
you.
for
Thank you for
coming.
the patience of all of you. Senator Butler, the newest member of this committee, and sorry you have to sit there.
And number
Welcome.
100. When you were number 100, you stand between the panelists and lunch. So I appreciate very much the time that you all put into talking with me, knowing that I was going to be the last person to ask you questions. But because most of you have a significant footprint in the state of California, I thought it important on behalf of the 40 million California residents to sit here the entire time and represent their interests across this industry. I'm glad our ranking member made his way back as the newest member of the Senate. I'm still getting to know my colleagues, and I wanted a ranking member to know that I do agree with him on a key point that he made in his opening remarks, and that is the majority of the American people who are watching this broadcast, particularly who are still watching, are not talking about nor have any interest in Basel III Endgame. They are talking about fairness and fees and affordability. And so that is where I want to land my two questions. I want to, and it's honestly not to pick on anyone, but really in the space and intention of moving things along. I want to pick up on Senator Smith's point around algorithms and algorithmic deployment. Ms. Fraser, you and I spoke about this as it relates to customer account closures. We talked specifically about the November 5th New York Times article in which Citi was specifically mentioned, a customer of yours who owned a bar and who was making bar-like deposits, end-of-day cash deposits in round amounts so that they could actually keep petty cash on hand to be able to make change at the bar, and found themselves the victim of an account closure due to what the algorithm determined was suspicious activity. Can you talk more about the process that you have deployed across Citi to give customers confidence that when you are doing your due diligence as a significant global investment institution, when you are doing your due diligence to provide and enhance national security, how do those American people who are still watching, who are still listening, who will hear this back, how can they have confidence that their credit isn't going to be negatively impacted, that you're going to return their whatever remaining balance that they may have on time in a way that they can actually get their bills paid due to no wrongdoing of their own?
Senator, thank you very much for the question. Thank you also for sitting through the entirety of the hearings today. You raise a really important point. I think all of us want to protect our customers. There's a tremendous amount of fraud. There's cyber probably keeps us awake at night. We want to do a good job for our customers. We want to look after them and enable them to live their lives and their financial lives securely. We have money laundering requirements that are very significant, in which we're not allowed to go and then tell the customer why it is we've closed their account. And I think all of us appreciate how frustrating that is for our customers, but we must follow the law. You and I have also talked about when it's found out that a customer's account has been closed in error or for some other reason, or there's been fraud blocks, how do we then help them recover their funds quickly? And that, again, I think there is no bank CEO on this table that does not want to help a customer to do that. And we're very happy to follow up with you on what are different ways that can be achieved. Thank you.
Thank you, and thank you for extending that opportunity to continue to figure out ways that this body can act to protect not only California customers, but people who are banking with your institutions around the country. My last question, Mr. Dimon, you and I also talked about this. As the representative from California, it is critical that I represent those voices on affordability and home affordability. In particular, your institution has done an incredible amount on this issue, and I want to applaud and recognize you for that. On the other hand, the other issue that I raised with you is just a concern of this intersection of both a declaration and a support for investing in affordable housing and making mortgages more affordable for low and middle income families, and the practice of financial institutions in buying real estate development purely for the purposes of putting it up for rent. Those two things seem to be in opposite and in contrast to me. And there's a report of JP specifically in California about this behavior. And I'd love to give you the opportunity to talk to Californians about how you are meeting both of those obligations, the obligation to provide more affordable housing, help to create more access to the American dream, and at the same time, buying more and more single-family residential properties that where they are going to be only available for renting.
Right. So thank you for
Mr.
the
Dimon,
question.
be brief if you
Yeah,
would.
thank you for the question, Senator. Love affordable housing, do a lot of it, as do a lot of the banks up here. We can make mortgages at much lower cost for lower size mortgages. I've been dying to work on that for 10 years now. I think that you're referring to an instance where we financed a company which is building homes, and it's, I think, 200 homes for rental. Remember, rental is appropriate for some people. And so I understand your concern, and I'll look into the specific thing, but building more homes is good for affordable housing.
Thank you, Mr. Dimon. Senator Butler, thank you. Thanks to the 8 of you for joining us today. For senators who wish to submit questions for the hearing record, those questions are due 1 week from today, Wednesday, December 13. To the banks, please submit your responses to these questions for the record 45 days, no more than 45 days from the day you receive them. Thank you again. The hearing is adjourned.
Some big numbers coming out of the housing market today, and they're not looking pretty if you're looking to buy or rent.
There's a bidding war for literally every home on the market, every fixer-upper, every house that needs even a lot of work.
Our house had 44 offers on it.
The deurbanization trend, that's a real thing. People are moving out of the city. They're buying bigger houses. I think the way the suburbs were built was a big mistake. They should have been built very differently.
Home prices in the large urban metropolitan areas were so expensive that people started moving out. And then you see these wildfires, and they're not going away.
Rent growth has accelerated coast to coast, from big cities, rural areas, east, west, south, north, across the entire economy.
How hot is it? It's turning cold. Existing home sales falling in March, but at least in part because there just aren't enough homes to buy.
Shopping for a new single-family home in the U.S. is arguably harder than ever before.
There's a bidding war for literally every home on the market, every fixer-upper, every house that needs even a lot of work.
My neighbors, actually, because we're on vacation, were calling me and texting me saying, what is going on at your house? There's people in a line down the block. We saw two people having a fight.
With city dwellers emigrating to the suburbs and families looking for home offices and bigger yards, prices for the American dream home have skyrocketed. Home prices surged in March 2021, up 13% from the year prior, according to the S&P Case-Shiller Index.
Everybody expected housing to really sort of dry up with the rest of the economy, and in fact, the opposite has happened.
With homeowners unwilling to sell, a record low supply of homes for sale has forced buyers into intense bidding wars. At the end of April 2021, there were only 1.16 million houses for sale in the U.S., down 20.5% from the year prior. Higher costs for land, labor, and building materials have also impacted home builders.
So currently in the United States, we have a huge shortage of housing. We're not producing nearly as much housing as we should be.
We know that home ownership is the primary way of getting into the middle class, but unfortunately, there are many impediments to that are divided by class and particularly race.
With the 30-year fixed mortgage rate hovering near a 50-year low and a strong demand pushing prices to all-time highs, why is the housing supply so meager? Is the U.S. running out of houses? The U.S. real estate market is red hot. Since the start of the pandemic, 5% of buyers who purchased a home did so without even physically seeing the home in person. In many markets, competitive bidding wars are the norm.
There's a bidding war for literally every home on the market, every fixer-upper, every house that needs even a lot of work. It's still just a crazy bidding war.
Our house had 44 offers on it.
With his New York City office shut due to the pandemic and looking for more space for his family, in the summer of 2020, Justin Goldberg and his wife Jessica put their 3-bedroom Bloomfield, New Jersey home on the market. The house listed for $399,000.
My neighbors, actually, because we're on vacation, were calling me and texting me saying, what is going on at your house? There's people in a line down the block. We saw two people having a fight.
With multiple 6-figure offers over the asking price, the house sold for $542,000, over $140,000 more than what the couple was asking for. But the family then found themselves struggling to find a new home.
It was definitely a risk for us to take because we knew that the pandemic wouldn't last forever. His job said you'll be working from home for the foreseeable future and gave up their office space in the city.
With little inventory on the market, the couple signed a 1-year lease on a rental. And on the advice from their realtor, they then modified their house search from looking for a move-in ready home to a fixer-upper.
I'm telling you, immediately you walk into the house that you want to buy and you get the feeling. And I got the feeling. And we walked through the house and it was not in good condition. The bones were there, there was nothing structurally wrong with the house. Everything was technically in good shape. Everything that needed to be changed was pretty cosmetic, but every single room in the house needed changes.
The family of 4 found a 4-bedroom fixer-upper in Randolph, New Jersey, with more space and a bigger yard.
We wanted a bedroom for each of our children, and an extra office or a guest room would have been fantastic.
Although the home was already under attorney review, the couple put in a higher bid and ended up buying the house for $555,000. According to experts, a few key steps home buyers can take to navigate the ultra-competitive market include getting pre-approved for a mortgage, finding a good real estate agent, and figuring out exactly how much you're willing to spend. An additional option first-time homebuyers have is to rent the home back to the seller while they look for their new home.
My best advice at this time is if you don't want to overspend, go into a house knowing that you're going to do a little work and you'll probably get it for a better price. And honestly, you can turn it into your dream home.
The U.S. has a housing shortage. With potential sellers unwilling to show their homes during the pandemic, in April 2021, there were 1.16 million U.S. homes for sale, down 20.5% from a year earlier. That lack of inventory has helped push the median price of existing homes higher, up a little over 19% from the previous year to a historic $341,600. One key factor in that price jump is with fewer, less expensive homes on the market, sales at the higher end accounted for much of the activity. During that same period, homes were selling in record time too, typically just 17 days on the market. While several large publicly traded companies like NVR, Lennar, Beazer Homes, and Hovnanian Enterprises construct single-family homes, townhouses, and condos, the vast majority of new construction in the U.S. is done by small businesses.
Home building is one of the last real vestiges of small business in America. The overwhelming number of housing, and I want to say it's close to 75 or 80%, is built by small businesses, mostly family-owned, all over the country.
Those builders have faced serious hurdles in recent years, including pandemic-related supply chain disruptions that have caused a spike in the price of building materials like drywall, steel, and wood.
The supply chain is in complete disarray right now from COVID.
The poster child for that is lumber.
As of May 2021, lumber prices are up more than 300% from a year ago. According to the National Association of Home Builders, rising lumber prices have added almost $36,000 to the price of a new single-family home. An aging workforce and challenging immigration policies have also led to a shortage of construction workers.
We simply don't have enough people, therefore labor prices are going through the roof.
Labor was a problem for us during the last housing boom and during the recovery, and it's even more of a problem now because in many places it is easier for potential workers not to come back to work and stay on the sidelines.
An even bigger problem might be the land that houses are built on. As of April 2021, the price per single lot is up 11% compared to last year. Real estate data firm Zonda said new lot supply is down 24% from a year ago.
And the challenge moving forward is infill. How do we invest in cities, into older suburbs? How do we reinvigorate with greater density things like accessory dwelling units for your mother-in-law in the backyard? How do we handle people who are challenged with affordable housing? It's all going to mean that we have new development patterns. We need new forms of housing. So yes, we're not building enough housing, and we need to double or triple that rate of housing just to meet natural growth in our economy. And I think we can do that, but we have to do that by thinking of new forms of housing and really changing our zoning.
Home ownership is a catalyst for building wealth with the added benefit of providing safer neighborhoods for families and better schools for kids. But not everyone can afford to own a home.
That's why the home ownership solution is a solution, even now, for many households. The problem is getting into home ownership.
In the first quarter of 2021, the home ownership rate in the U.S. was 65.6%. According to the U.S. Census, the home ownership rate for white Americans in the U.S. is almost 74%, compared to 49% for Hispanic Americans and 45% for Black Americans. A major hurdle for many is the down payment. Typically, home buyers put 20% down when taking out a conventional mortgage.
We know that that typically also requires having a certain amount of income. And for a lot of people, that is much easier said than done. For example, for people of color, it is much harder to be able to put down that type of down payment because they may not have the familiar support as people who come from more affluent neighborhoods.
These gaps are exceedingly troubling because the implications of them are very pervasive. Black household wealth is 1/10 what it is for white households, and a large portion of that gap is due to the lack of home ownership. Even though mortgage rates are at historic lows, there's been a ratcheting up of the qualifications that are required to borrow to become a homeowner. And that has impacted minority households more than majority households.
Buyers paying less than a 20% down payment are often subject to primary mortgage insurance. That can range from an additional $30 to $70 per month for every $100,000 borrowed, according to Zillow. Student debt is another barrier many first-time home buyers face. According to the National Association of Realtors, the average home buyer in 2020 carried $30,000 in student debt.
When I talk to young people, a lot of times they are trying to pay their rent versus their grocery, or they're trying to pay their student loans.
Single-family zoning, pervasive across much of the U.S., limits the number of units that can be built on a plot of land, making it difficult for families to afford certain communities.
Single-family zoning has really been a barrier for lower to moderate income people to be able to live in particular neighborhoods, because single-family zoning bans any type of home being built or any type of multifamily home or any type of detached home from being built, which is a huge barrier to people who are just trying to start off.
But that may be starting to change. In 2019, Oregon became the first state to pass legislation banning single-family zoning in most of the state. Around the same time, Minneapolis became the first big American city to end the practice.
So one of the major impediments to our shortage of housing, in addition to the land economics and the supply chain, is that we have a lot of communities in this country that don't want to have affordable housing. They don't want to have anything other than large suburban estates, if you will. And I think we need greater exercise of federal policy over these local communities that are utilizing exclusionary zoning to really grossly impact the provision of affordable housing.
The federal government is taking steps to increase affordable housing too. In April 2021, the Biden administration announced a $5 billion plan providing financial incentives to push local governments to allow multifamily dwellings in neighborhoods that are currently restricted to single-family homes.
This is a market for housing, for home ownership, for those who wish to get into home ownership and those who are homeowners. People are expanding their homes, they're renovating their homes, they're building out new backyards. So this is a homeowners economy. There's never been a stronger economy for homeowners than now. And as a contribution to the overall economy, home ownership is more important than ever.
Between remote work and the pandemic, more people and businesses are moving to the suburbs.
The deurbanization trend, that's a real thing. People are moving out of the city. They're buying bigger houses.
We have seen that the housing market was incredible in 2021.
The pandemic itself, it has changed housing preferences and location preferences.
America leads the world in suburbanization.
I think the US is distinctive in that suburbanization has been particularly large in magnitude here in the United States.
And it's creeping up again, of course, but there's an opportunity here to rethink some of those patterns and reset the norm.
I think the way the suburbs were built was a big mistake. The cities needed to get bigger, but they should have been built very differently.
To combat the economic challenges of sprawl, some suburbs are building up rather than out.
Where we build housing, where we don't build housing, and what kinds of housing we build have big implications for the economy, for climate, and for patterns of racial and economic segregation.
The roads in the sprawling suburbs contribute to the nation's $1.2 trillion maintenance funding gap. How else does suburban sprawl shape the U.S. economy? Over centuries, developers built many homes in a pattern that experts call suburban sprawl.
And the farther out you go from the center of the city, we tend to build lower buildings, shorter buildings, more spread out and more space. It gives a little bit more of the illusion that you live off in the country far away from other people.
This style of housing is the foundation of the American suburb and the American dream.
The one thing it does enable people is to kind of escape the city. So there's a benefit and a cost, and individuals are deciding based on their private benefits and costs and making a decision they think is optimal. Sometimes that can have negative externalities for the rest of society.
The New Deal of the 1930s sped up suburban sprawl in the states. The bill created a federal housing administration, which standardized neighborhood design. It made mortgages more affordable.
And Fairless Hills is typical of the growing new community.
The FHA guidelines made country-style living a middle-class reality. They also created problems.
They prescribed rules to get an FHA loan. No sidewalks, curvy streets, dead-end streets, and made it hard to walk.
They also enforce a minimum lot size, which spreads people out and inflates the scale of the suburbs.
If that's an expensive community with expensive land, it means that the price of buying into the community is going to be very high. That means automatically the only people who can afford to move in there now are people who are pretty wealthy. A large minimum lot size doesn't say no Black people or no Latinos can move into the neighborhood, but it turns out that income and wealth are really strongly correlated with race, in part because of longstanding discrimination.
Many suburban towns also separate land by use. As a result, homes are generally far away from industrial and commercial areas.
Local governments adopt this so that they have some control over what gets built where, but it also can make it difficult to build the housing that people want to live in places they want to live.
These guidelines were formalized with zoning laws.
These are sets of regulations. There are subdivision codes as well as just regular zoning codes that exist in most municipalities across North America that provide a framework for what you can and can't build. And these were used as planning tools.
Restrictive zoning codes have long limited the supply of land for housing in cities like Minneapolis and San Francisco. Many workers in these cities haven't been able to buy or even rent homes near their jobs, which slows economic development. These old trends are still shaping development today.
It was in the 1940s when the United States population crossed that threshold from being predominantly rural to predominantly urban. And all of the growth since then has really been a shift from rural to suburban.
And since the 1960s, people have been trying to modify the zoning to let people mix uses and have stores, apartments, offices all mixed together, which is what lets you have these sort of lively neighborhoods.
In recent years, neighborhoods outside of cities with large job markets have boomed, while the population in America's heartland declines. As a result, the maintenance costs associated with suburbia are adding up. When a suburb grows, the tax base within the nearby city is expected to decline,
which reduces its ability to fund local public goods, including schools, including policing, and so on. And so those individual decisions, even though they can be good at the individual level, can have externalities for the city as a whole.
So the spread out development that's typical of the suburbs, it entails higher per capita government costs relative to the denser urban areas.
If you're building roads and sewers and all of the houses are located half a mile or a mile away from one another, you need more asphalt and more concrete and more pipes.
Suburban towns often struggle to finance their long-term infrastructure costs, and population growth nationwide has slowed to 0.1%, a record low. That means that the financial pressure on suburban towns is mounting.
All of the declining cities in the Midwest face this problem, that they just don't have the income from their current tax base to pay to maintain something that they built 50 years ago when they were 3 times the size.
So new, so powerful, so revolutionary is this force that we have hardly been able to appraise its influence.
Federal spending can hide the true cost of suburbia.
Local governments use property taxes in particular to pay for a lot of these costs. So if you've ever wondered, why do we have potholes on your neighborhood street and not potholes on the interstate, it's because they're paid for by different levels of government.
America has a $1.2 trillion funding gap for upkeep of roads, bridges, and tunnels. The American Society of Civil Engineers says new spending in 2021's infrastructure bill helps, but it doesn't cover the full costs. If further improvements aren't made, the country's failing infrastructure could cost each family over $3,000 a year by 2039. Another problem?
People don't realize how much of their income goes to their car.
In the past, the suburbs became more popular as cars fell in cost.
Once you take account of inflation, and once you take account of the rise in people's incomes, the real cost of car ownership today is lower than it was. Of course, if you get a frontier car, such as a Tesla, which has features which weren't available in the 1950s, you can pay a lot of money and it can be very expensive.
Since the 1990s, households have increasingly relied on credit to finance their cars. AAA says the annual cost of vehicle ownership has risen to nearly $10,000. Making matters worse, the 2008 recession has destabilized many suburban households. On average, people in the suburbs are now employed at lower rates and have declining incomes. Home prices have also been subdued when compared to central cities. Some call it the suburbanization of poverty.
There's typically a greater availability of land in the exurbs, and the land and housing that's on it also tend to be more affordable.
Experts say remote work and tasteful planning could make the suburbs better.
New growth and density could be directed through redevelopment and infill projects. There are so many of these surplus properties out there.
Many of these infill projects place residents closer to commercial areas, which could create opportunities for entrepreneurs.
If we focus on millennials, for example, they have things that they really like. They have bars, restaurants. So some of those preferences they carry with them. And so what that creates, it creates opportunities for someone to open up a business that caters to these needs.
And I think that sort of plays a big role in that shift of employment to the suburbs.
Experts say the most affordable suburbs are often also the least sustainable.
So, for instance, a metro like Atlanta or Phoenix has managed to keep housing fairly inexpensive over the last 30 years because they just build a lot of housing, and they build these huge subdivisions, 10,000, 20,000 homes on very inexpensive land that's essentially, farmland that's undisturbed. On the flip side, of course, we know that there are terrible climate impacts from building. So there really is a tension.
And you can see that very clearly in California.
You see how close those flames are to these houses.
Home prices in the large urban metropolitan areas were so expensive that people started moving into the more wooded areas. And then you see these wildfires, and they're not going away. In fact, they're getting much worse.
Meanwhile, suburban drivers on beltways are shaping the climate of the future.
It's really in the kinds of suburban settings that we would characterize as sprawling, separated uses, car dependent, relatively low density. This is where we see a more extreme emissions use.
Most U.S. emissions come from personal cars. Commutes lengthened as the country sprawled in recent decades.
So going back to 1970, around 81% of residents lived in the county where they worked. And that declined substantially over time by the year 2000.
If remote work persists, it could take some drivers off the road. Home appliances are another huge source of emissions.
Definitely, when you see more sprawl in the suburbs, you're seeing much more carbon emissions out there than you would in one large building in a city.
The U.S. has committed to eliminating carbon emissions from electricity by 2035. But in that time period, researchers expect U.S. auto emissions to remain flat. That's mostly due to suburban drivers.
But there's an opportunity here to rethink some of those patterns and reset the norm.
So what can be done to improve residential development in the states? Many regions are tackling sprawl head-on. In Montgomery County, Maryland, outside of Washington, D.C., 85% of the available land has already been developed. The county revised its master zoning code to increase the supply of homes along a forthcoming light rail path.
This is a suburb-to-suburb rail line. You see them in other countries. Paris has an enormous project underway, but for the United States, it is really one of a kind.
Leaders hope the improvements will take 17,000 daily drivers off of suburban roads. Experts say that expanding public transit can make a community more equitable.
Traditionally, lower income communities have benefited disproportionately from public transit options.
But funding and executing such projects is a feat. Residents are paying for the $9 billion suburban DC rail project with an increased tax on gasoline. President Biden's Economic Council wants to encourage more changes like this. They have called for a $5 billion grant program to fund communities that abolish restrictive zoning codes.
One thing to remember is that every part of the country has some walkable mixed-use places that feel like sort of a main street. And we don't have to invent this for real. We've already done this, just recreate what we used to do.
And so that's where we are now, that the kinds of beautiful scenic small towns, mixed use, walkable streets that we remember and we like to visit as tourists pre-exist zoning codes, and in many cases could not be rebuilt again if you wanted to do it from scratch without significantly revising the zoning.
Other parts of the world are experimenting with zoning reform too.
There's been some very interesting work in the city of Bogota documenting how the rapid bus transit network had uneven effects on low and high income workers in that city.
Another study found that changes to the code in Sao Paulo, Brazil, improved the quality of life for renters with college degrees. But those changes also greatly sank home prices, affecting landlords. In America, home builder stocks have wavered as the Fed weighs interest rate hikes
A rising rate environment is going to be very difficult for home buyers. It just takes away from potential buyers' purchasing powers. It means they either can't buy a home or they can buy less of a home. And we know that the entry-level housing stock is the leanest it has ever been.
Suburban sprawl will determine much about the American economy for the foreseeable future. The development choices made today last for generations.
So it seems as though over the medium term, the deck is basically stacked in favor of the suburbs and against the dense urban cores.
Ultimately, people are making those decisions for a reason, and it reflects a very kind of fundamental economic force that you see in many places around the world, in many different institutional settings.
You know, it took really 50 or 75 years to make the problems of the suburbs, and it takes a long time to undo it.
Rent in America is getting more expensive, no matter where you live.
Rent growth has accelerated coast to coast in big cities, rural areas, east, west, south, north, just across the entire economy.
The areas where we are seeing the strongest rent growth are in places like Austin, Texas.
Yeah, so my name is Maria and I live in Austin, Texas. During the pandemic, a lot of people began to leave, and actually the rent dropped that year by $100. I am due to renew my rent, and there was a spike of $400.
Making matters worse, few of the new homes in construction are affordable.
Rental demand continues to be extremely strong, and the rental units that are being built are the more expensive ones. That is the higher end ones.
Meanwhile, workers' pay isn't increasing enough to match the new rent.
We had wage suppression for 40 years, and then we have the period now where wages are growing, especially at the low end. And so the question is, how long will that continue?
Experts say the rent increases will have an impact on the economy.
A lot of the monthly expense for the typical household is money that's going toward the rent or to upkeep of the house. So it is a very important part of all of consumer expenditures.
In the most competitive markets, rents are creeping toward record highs. Renters in smaller markets are feeling the squeeze too. For example, one-bedroom rentals in Gilbert, Arizona spiked over 116% in the past year. Meanwhile, rent for a single-family home is growing at its fastest pace since 2005, according to CoreLogic. So how did we get here? One answer is the bounce back from the pandemic.
You saw tech companies, major firms moving to smaller cities, cities like Pittsburgh, Austin, San Antonio, Charlotte. These are cities that really started booming because workers had more flexibility. And when the city starts booming, of course, the rents go up because it's a supply and demand issue.
But the story goes back further than that, all the way back to the Great Recession.
President Obama, are you listening?
This has been building really since the end of the financial crisis back a little over a decade ago. A lot of communities have made it more difficult to build more homes closer to the urban cores. Building materials, particularly lumber, has been in short supply. That's been a problem. Labor, a lot of people left the construction trades in the housing bust back a decade ago. And because of the changes in foreign immigration laws, we have a lot fewer foreign immigrants coming into the country. Many of those folks would work in the construction trades. Also, a lot of smaller builders, they rely on loans from banks. And since the financial crisis, banks, particularly smaller banks, mid-sized banks, have been unable to, because of regulatory changes and other reasons, unable to provide enough loans. So, there's a melange of things going on here.
After the financial crash of 2008, house building stalled. By the end of the tens, renters had fewer options, especially in real estate hotspots.
Pre-COVID, we saw a huge rush to urban centers. Millennials love to live in cities longer. They were actually living there longer than the previous generations their age had because they weren't able to get out and afford to buy homes because home prices were so high. So you had so much demand in the cities.
Then the pandemic hit.
So if you look at some of the high-rise apartment buildings in the really dense central business districts, the big cities, rents were actually declining in the first 12 months of the pandemic.
But smaller cities like Phoenix and Austin received more of those remote workers. That sent prices upward for people like Maria.
Right now, I would say for a studio is probably $2,000. This place, it's a 1-bedroom, was originally set at $1,700 when I first moved in.
Maria is a teacher and needs to commute to work every day. She and many other Americans don't have the luxury to move further away from work to save cash. That's creating wider issues in the economy.
There's a lot of evidence that the lack of housing closer to where the demand is in urban cores is having a meaningful negative consequence on long-term economic growth. So if we can figure out a way to change zoning rules and laws and get the lumber and land and labor that we need and able to build closer to where the jobs are, our economy will be able to grow more quickly, more strongly in the longer run.
Renters in the traditionally cheaper suburbs are feeling the burn too. Economists say that finding any home to rent right now is uniquely difficult.
Because the vacancy rates are really so low. It's the lowest we've seen in a generation.
Coming out of the pandemic, it's likely for rents to keep rising.
Fortunately, builders are ramping up their building. They can make a lot of money, with rents this high and house prices this high. So they have a lot of incentive to put up more homes, and that's happening slowly but surely. We are seeing more homes put up.
So that's a good sign. And we've seen an increase in single family housing starts. That's really important because that's the preferred housing structure during the pandemic. So having investors come in, buying homes, maybe it puts a little upward pressure on home prices. Sure, maybe it does. But it does increase the stock of single family rental homes available in the market and should help to moderate rent growth.
And in the cities, some realtors are weighing whether to convert their less busy office districts into residential neighborhoods.
The idea is to say that there are some empty buildings, brick and mortars already established, but maybe one can repurpose it into residential units.
For the short term, renters are dealing with the market.
If I had signed the lease, it would be taking a lot of my savings. And so I decided to move to a new building. I'm losing about 150 square feet.
These hikes are hitting U.S. citizens at an inopportune time. Over decades, wages for most workers have stagnated.
The wages and benefits of a typical worker were suppressed in the period 4 decades after 1979. Growth was very slow. There was growing inequality that worked against the middle, in effect, against anybody in the bottom 90%.
In 2019, Oregon became the first state to impose statewide rent control. They cap increases at about 7%. Cities like New York, San Francisco, and Washington, D.C. also limit rent increases. These policies have some benefits. One study found that renters were about 20% more likely to stay in their homes with rent control. Other economists think that rent control does more harm than good.
So what history has shown is that by putting a rent control, yes, it's benefit temporarily for people to pay lower rent, but that deters incentive to build more homes or provide money for maintenance. So all the housing stock steadily deteriorates over time, and one does not want to see that. So we want to encourage more production.
The answer to rising rents may be in the job market. Both Congress and the Fed have pumped stimulus into the economy. It should eventually help some workers earn higher wages.
There's been a huge increase in the demand for goods and services. So we're going to see a period of sustained low unemployment, I think. This has always led to faster wage growth for those in the middle and the bottom. The other related question is, will we see the structural changes that will build this into the economy rather than be an episode of a period of low unemployment? And I think that will require improving labor standards, putting in the $15 minimum wage, rebuilding collective bargaining. I think it will mean paying attention to maintaining low unemployment.
Which means that the answer to rising rents might be getting yourself a raise or finding roommates.
They're not building enough affordable housing right now because for builders, the cost of construction is so high due to a high cost for land, labor, materials, shortages for materials, shortages of labor, that they can't build affordable housing.
It took us 10 years to get into this, predicament. It's not going to be solved next year or the year after. It's going to be 10 years before we solve this problem.
Some big numbers coming out of the housing market today, and they're not looking pretty if you're looking to buy or rent. It's all getting even more expensive.
Home prices in the U.S. have climbed at a record pace during the pandemic. The median home price reached over $363,000 in June 2021, a 23.4% increase from 2020. Many of these houses are being sold above their asking price, often entirely in cash, with bidding wars becoming the new norm to weed out the competition.
At the beginning of the pandemic, the Fed cut interest rates to zero, and that dropped mortgage rates to historical lows. And as soon as people figured out how to buy a home in a safe manner with like social distancing, people came right back to the housing market.
So you can see in just basically the last 15 months or so, we've seen a dramatic acceleration in home price growth to levels we haven't seen in decades.
How hot is it? It's turning cold. Existing home sales falling in March, but at least in part because there just aren't enough homes to buy.
While the market has cooled down considerably in June compared to its peak, fears of a housing bubble are becoming prevalent among many homeowners.
I think it was sticker shock. I think a lot of people got in there and said, I just can't afford this. And that's why home sales came down.
Almost every conversation that I've had over the past decade is, well, one, there's this fear that we might find ourselves in another crash, and buyers don't want to be the ones holding the bag in the middle of that transition of a shifting market.
If a housing bubble were to happen, it would mean that a very large portion of Americans' wealth are tied up in risky assets, and they can lose a lot of their wealth as soon as those home prices drop.
So is America currently in another housing bubble? And what are the signs that can help investors predict an oncoming crash? A housing bubble occurs when strong demand and wild speculation drive up the price of residential real estate to the point of collapse.
It's hard to look at any one data indicator to know whether we're in a housing bubble or not. The signs that I would look for are actually more intangible, kind of a mindset that people start to adopt. If people go into buying a home thinking that they're going to get this instant return.
And you see a lot of speculators in the market bidding up prices. If you see a lot of people or home buyers buying homes with no money down or very little money down, those are some telltale signs. If you see credit too easy, then that can be a telltale sign as well.
If a bubble is left unchecked, supply will continue to rise in order to meet the strong demand, and prices will climb beyond a reasonable amount. When demand suddenly and unexpectedly decreases, it leads to a sharp decline in housing prices, bursting the bubble.
Housing bubbles eventually pop because people start to realize that what's going on isn't sustainable. As soon as people, see their neighbor selling their home, and maybe their neighbor accepts a little bit less than what homes were worth when they bought, then they may start to get nervous and sell as well, and then it becomes like a cascade. Bubbles tend to burst pretty quickly. So that's why, one day you might have your home go down in value like 20% because the bubble burst.
But sometimes the market requires a more drastic incident to crash on a national level.
Catastrophic economic event. That's it. You need a catastrophic economic event to make a housing bubble pop. You can definitely have a pullback in the heat in the housing market, but to really have that market crash, there needs to be that event.
There have been numerous housing bubbles throughout history, going back as early as 1837. Compared to other equity busts that occur on average every 13 years, it's far less frequent. However, the International Monetary Fund discovered that housing crashes usually last nearly twice as long with output losses that are nearly twice as large, leaving a much more detrimental impact on the economy. The 2008 financial crisis is a prime example of how a real estate bubble could potentially contribute to an economic meltdown.
A lot of people got a firsthand experience in what it's like to see your home go down in value. Some people end up losing their homes if they weren't able to continue making their mortgage payments, and then they couldn't sell at a higher value than what they bought it for, so they'd end up having to take the loss themselves or end up in foreclosure. So all of that can be very damaging to people, and I think it's very understandable that people are concerned about that happening again.
Demand off the charts, prices rising at the fastest pace in 15 years. But is the market too hot? Is it overheating? A bubble, as they say.
So is the recent real estate rush a sign of a housing bubble? According to most experts, the market is shaping up to look more like a boom rather than a bubble.
I don't expect that we're going to see a house price crash. I don't think we're in a bubble.
We say bubble because we can't believe how much prices have gone up. But really, a bubble tends to be something that's inflated that could burst at any minute and change. And that's not really the case here.
While speculation certainly is a factor, the main cause for today's demand is in the low mortgage rates. At the start of the pandemic in March 2020, the 30-year fixed-rate mortgage sat at 3.45%. In July 2021, that number had dropped to 2.87%.
We've got 30-year fixed-rate mortgage rates for much of the last several months below 3%. That's a phenomenal rate. It's rock bottom. It's a record low. I don't see them going any lower, but that is one of the reasons why that has led to this pickup in demand to buy homes and has added the fuel necessary to push home prices up.
Supply is also an issue. According to the National Association of Realtors, the U.S. has underbuilt its housing needs by at least 5.5 million units over the past 20 years. That's a stark comparison to the previous housing bubble in 2008, when overbuilding was the issue.
In my town, which is Marblehead, Massachusetts, as of this morning, we had 17 single-family homes on the market. 17. So, and that's not even considered bad. Some of the surrounding towns, the town next door, they have 5 single-family homes.
So we've got really the demand and supply forces coming together. We've got a boost in demand that's fueled by record low mortgage rates, and we've got a shrinkage of supply as many of the older homeowners decided to postpone listing their home for sale and wait until a later date when the pandemic was in the history books. So between more demand, less supply, prices are up, and they're up at the fastest pace since the 1970s.
There also haven't been any signs of a lending bubble, which is often associated with housing busts. Most of the new mortgages today are fixed rate compared to the riskier adjustable rate mortgages in the past.
Subprime loans are those loans made to borrowers or to applicants who have very, very low credit scores. Those are gone from the marketplace. What's also gone are the liar loans. Just about all of the mortgages today are fully documented, documenting income, documenting employment, documenting financial assets, so that both the borrower and the lender have some assurance that the borrower has the financial capability to manage that mortgage loan over time.
Furthermore, rapidly rising home prices saw a correction in June 2021 after sales of newly built homes dropped to the lowest level since the early days of the pandemic in April 2020.
I think it was sticker shock. I think a lot of people got in there and said, I just can't afford this. And that's why home sales came down. We did see some more supply come onto the market, and that's helpful. And that's a lot of sellers saying, well, if this is the height of the market, I want to get in now. But again, they're not going to get that top dollar if people can't afford it. So I think we're at kind of a turning point, as in the housing market is cooling down on sales, but prices may stay elevated if we don't get enough supply in there to meet the current demand, which does still exist.
The U.S. might be safe from a housing bubble at the moment, but that doesn't mean another crash will never happen again. But there are certain indicators that could signal danger on the horizon.
What would be unusual, where you should fear about home prices really starting to plummet, is if you look around and you see all this new construction in your neighborhood, and yet home prices aren't moderating at all, despite there being all this added inventory. If you see a whole lot of flips, a lot of investors coming in, doing modest improvements to the home and then getting a whole lot more than they put in when they end up selling, that would be a sign that the housing market is starting to look a little bit unhealthy.
While the thought of another crash is certainly scary, experts say that a real estate crash similar to the one during the 2008 financial crisis is unlikely to occur again.
The market today is not in danger of a housing bubble bursting because everyone out there who owns a home has a mortgage that was underwritten responsibly.
Some of those changes were due to the Dodd-Frank Act, which also then created the Consumer Financial Protection Bureau, and through some of the regulations that have been promulgated that has really assured that mortgages are underwritten in a prudent fashion and provide for mortgages that can lead to sustainable home ownership for the home buyer over time.
But for both current and potential homeowners that remain worried, there are certain measures that can be taken to lessen the risk.
If you're a home buyer today and you're concerned that prices are overheating and you're buying at the top of the market, the most important thing you should do is not overpay for your house.
If you feel the price is higher than what you're comfortable with, higher than what you think the true economic value of the home is, then step back from it. You don't need to buy now.
The mindset that I would encourage homeowners to have is a very long-term mindset. Like, it doesn't really matter if home values go down for a couple of years if you're gonna hold and not sell for a decade. So I would just, keep your eye on the long-term goals. Make sure that you have enough savings that you could keep paying your mortgage payment, even if you lost a job, even if you lost some income, so you can ride out any temporary dip in the housing market.
The current United States tax code allows some of the most profitable companies in the world to not pay any federal corporate income taxes.
The present tax system ain't fair.
Actually, at least 55 of the largest corporations in America paid no federal corporate income taxes on their 2020 profits.
And paid zero in federal taxes.
Some of these companies include big names like FedEx, Nike, HP, and Salesforce. These companies are not doing anything illegal, and these companies pay many other forms of taxes.
If a large, very profitable company isn't paying the federal income tax, then we have a real fairness problem on our hands.
And it's costing the government billions.
You can think about a bucket of corporate tax breaks that are deliberately there in the tax code. And overall, they cost the federal government roughly $180 billion each year. And for comparison, the corporate tax brings in about $370 billion of revenue a year.
Those 55 corporations would have paid a collective total of $8.5 billion. Instead, they actually received $3.5 billion in tax rebates.
Corporations can receive refunds just like individuals do.
And that doesn't include corporations that paid only some of these taxes, but not all.
The federal government estimates that there's about $40 billion each year in corporate taxes that are clearly owed.
Here's how the most profitable companies in the country avoid federal corporate income taxes. It's important to note the federal income tax is not the only tax corporations pay. They're subject to state and local taxes too. Right now, we're only talking about the corporate federal income tax rate, both domestic and international.
Federal tax rate at the moment is 21% for domestic profits, but it's as low as between 0 and 10.5% if those profits are profits of a US multinational that are earned offshore.
What do we do to make America the most competitive place in the world?
The 2017 Tax Cuts and Jobs Act slashed the 35% corporate tax rate to that 21%.
The only tax levied at any level that publicly traded businesses are supposed to pay in proportion to how well they're doing. Where the bigger you are, the more successful you are, the more you ought to be paying.
The corporate federal income tax is about 7% of all revenues that the federal government collects.
Let's look at Amazon as an example.
Alexa, how much tax should Amazon pay?
Sorry, I don't know that one.
Amazon became famous in 2018 when the company reported about $11 billion in U.S. income and paid 0 federal income tax. They actually got a tax rebate of $129 million according to their financial reports. We now have 4 years of data. In those 4 years, Amazon has now reported $79 billion almost of U.S. income and has paid a total of $4 billion in federal income tax for a 4-year tax rate of 5.1%. So what that means is that they're avoiding income tax at the federal level.
Remember that the federal rate is 21%. So in 4 years, Amazon's effective tax rate was 5.1%.
I'll emphasize that everything I've just said about what Amazon is doing appears to be completely legal.
Amazon told CNBC that its U.S. taxes reflect its investments, employee compensation, and current tax laws. The company paid federal income taxes, other federal taxes, and state and local taxes. Publicly traded corporations have 2 different ways of accounting. So one form of accounting is for shareholders. Let's call it book income.
You have profits that are reported to shareholders using general accepted accounting principles under financial accounting. And the purpose of that is really to determine, is this corporation profitable? Is it worth investing from a shareholder perspective? How is the firm doing from a performance side of things?
And the second form of accounting is for taxes. Let's call it taxable income.
You have a set of rules that are different from and often diverge from that accounting. Determine how much tax a corporation is paying. And what that means is the amount of profits that corporations may be reporting for financial purposes may be very different from the profits that they are reporting and they're paying taxes on for tax purposes.
This is how some companies are able to tell investors we made billions of dollars, but turn around and tell the government we made $0. We can call all of these tools a form of tax expenditures. Tax expenditures are any targeted tax break. Think tax credits or incentives.
We want more oil. We want more solar energy. We want more manufacturing. We want higher paying jobs. We want more capital investment. And for each of these things, Congress has enacted a tax break that, at least on its face, is designed to encourage these things.
Take a tax credit for research and development as an example.
There's the R&D tax credit, which allows companies to take deductions and credits for their spending on research, the things they spend money on to, make better hamburgers in the case of McDonald's.
Tool number 2, accelerated depreciation, another form of tax expenditure. We can also call these write-offs or expensing. This is a key example of how those 2 different forms of accounting, book and taxable incomes, come into play.
If you are a corporation that's really in manufacturing, really capital intensive, you may make a really large investment in a given year. Under financial accounting rules to determine your profits you're reporting to shareholders, you may have to deduct that over, say, 10 years, for example, under the general accepted accounting principles. For tax purposes, especially, you may be able to accelerate those deductions in the given year, and in some cases, even taking a full and immediate deduction against your taxable income for that investment. What that means is you may be reporting a profit for financial accounting purposes, reporting no profit or even a loss for tax purposes. And that creates a difference between your financial income and your tax income.
Tool number 3, stock options.
There are tax breaks for stock options, which allow companies to write off the cost, with air quotes around it, of the stock options they give their executives and other senior employees.
So that just comes down to the different rules between book accounting and tax accounting for when that compensation can be deducted. For book accounting, it's deducted immediately. For tax purposes, and maybe at a later date when it's ultimately vested to the employee, and that creates a discrepancy in the total amount of taxable income that these firms are reporting.
They write them off as if they were actual cash expense, when of course giving stock options to your employees is absolutely not the same sort of out-of-pocket expense that signing a check every 2 weeks is.
And finally, perhaps the murkiest of all tools, tool number 4, offshoring.
There is a very deliberate, at the moment, lower rate for foreign profits of US multinationals, and something between 0 to 10.5 on their foreign profits. And that's an outright tax benefit for them that's worth roughly $60 billion a year, according to the Joint Committee on Taxation. But it also creates this incentive to shift their worldwide profits into that sort of foreign low tax bucket.
US-based corporations are finding ways to shift income into tax havens. They talk about the Cayman Islands, about Bermuda, Bahamas, Ireland, and Luxembourg, and the Netherlands to some extent.
There are estimates that sort of shifting is in the tens of billions of dollars a year, up to $100 billion a year.
Here's an example. Whirlpool, a U.S. company known for manufacturing home appliances both in the U.S. and Mexico.
Whirlpool tried to avoid both US and Mexican taxes on the profits from its Mexican operations. And it did that by having the Mexican operation owned by a Mexican company with no employees, and then having that Mexican company owned by a Luxembourg holding company that had 1 employee. And then it tried to claim that due to the combination of the US, Mexico, and Luxembourg tax rules, the millions of dollars of its profits from the Mexican operations wouldn't be subject to tax in Luxembourg, wouldn't be subject to tax in Mexico, and wouldn't be subject to tax in the US. So it was trying to sort of take advantage of the disconnect between all of those tax systems to avoid tax in all of those countries. And a court said, no, that goes too far. That's not what the law actually allows.
Whirlpool told CNBC that it follows all tax laws in the jurisdictions in which it operates, and that Whirlpool's use of the tax code actually increased the amount of tax that the U.S. collected on its Mexican profits. The IRS thought Whirlpool should have paid those U.S. taxes earlier.
It's still quite possible for U.S. companies to shift their intangible assets out of the U.S. to avoid taxes. And it should be a top priority of policymakers right now to prevent them from doing so.
Accounting and tax experts say that probably the first best way to fix the problem is to go to the tax rules and look at each of the different provisions and decide whether or not you want that in the tax code, repeal those inefficient tax breaks or reduce them. Some say that is unrealistic, otherwise it would have happened anyway, and it's a hard thing to do.
One solution could be to beef up the IRS.
There is nothing the IRS does that is more cost intensive, that requires more resources than investigating the tax avoiding behavior of large multinationals.
Between 2011 and 2019, the IRS's budget for enforcement was cut by about a third.
One policy solution would be to implement minimum corporate taxes, both an international minimum tax and a domestic minimum tax.
That global minimum tax would end the race to the bottom in corporate taxation.
The legislation that's been debated by Congress would raise the U.S. minimum tax rate on foreign profits from 10.5% to 15%. Implementing an international minimum tax would help tamp down on some of the offshoring of profits that companies can maneuver about.
Where that country doesn't impose at least a 15% rate of tax, then the US will impose an additional tax so that the corporation pays at least 15% in each country. And that would raise about $350 billion over 10 years.
Then there's domestic profits.
One major proposal that's come out over the last year and advocated by both Biden administration and members of Congress has been to levy a minimum tax on book income directly.
Implementing a domestic corporate minimum tax of 15% could reduce the gap between the book income and taxable income, basically cutting down the value of some tax expenditures.
The first priority with corporate tax reform should be to get it to lift its own weight, to pay for companies to pay by whatever means something closer to the statutory rate. And the book income tax would certainly accomplish that. I think there are better ways of doing it. I think there are more all-inclusive ways of doing a minimum tax, but it's certainly better than nothing.
The more money you make, the more you have to pay in taxes, right? Well, not always.
Here in the US, the more you earn, the bigger a percentage cut the government withholds from your pay. But here's the thing. The ultra-wealthy typically take advantage of rules in the tax code, which enable them to lower their effective tax rate.
The rich are different from you and me, as the old saying goes, in large part because the sources of their income are different.
Just take the case of billionaire Warren Buffett. He often points out that he pays less taxes on a percentage basis than his other employees, including his secretary. The reason? Well, most of his wealth comes from his stock holdings, not his annual salary.
The great thing about stocks is that you aren't taxed till you sell them. And even then, the taxes are typically lower than the rates on wage income.
So if you ask people, what bothers you most about the tax code, complexity is a common answer, but also the feeling that the wealthy don't pay their fair share, or the feeling that corporations don't pay their fair share.
In 2018, Amazon famously pulled in over $232 billion in global revenue, and yet its federal tax bill was $0. And in fiscal year 2020, at least 55 of the largest corporations in America, including FedEx and Nike, also managed to pay no federal corporate income taxes.
There's a great Supreme Court case with Judge Hand going many years ago that it's not the taxpayer's responsibility to pay the most taxes that he can. It's the taxpayer's responsibility to pay the least taxes that he can. There's even a rule within the IRS code that if you want to pay more taxes, you can write a check to the United States Treasury and you can take a tax deduction for that.
But some experts say tax breaks are designed to reward the taxpayers who are helping to pump up the economy.
Individuals who are not, again, contributors in terms of real estate and businesses, they don't get tax benefits, but it's because they are not contributing to, the economic growth at a larger scale.
So how exactly are the country's biggest earners using the tax code to avoid paying taxes? To understand how the wealthy take advantage of the tax code, you first have to look at where all that wealth comes from.
The biggest loopholes arise when you have assets. Most Americans don't have assets. All they are depending upon is their income from their salary from their employer. So if you have someone who has assets such as business and real estate, again, they are unlocking different areas of the tax code that most individuals do not get to explore.
You can think of someone's wealth as being comprised of separate assets which fit into one of three different tax buckets: taxable, tax deferred, and tax-free.
If your only form of income is your annual salary, then all of your wealth just fits into the taxable bucket. But the rich also tend to diversify into other types of assets and investments that the tax code doesn't consider to be taxable income. There are individual retirement accounts, some of which are not subject to federal taxes, and then you have investments like stocks that fit into the tax-deferred bucket. If the value of your stock portfolio goes up, you don't owe tax on those gains until you realize that gain, aka not until you sell that stock. And even when you do sell, the tax rate is typically lower than the rates on wage income.
Capital gains can be avoided in life and also largely avoided in death. And so that's highly advantageous to high income, high wealth people.
Capital gains taxes also apply to bonds plus tangible assets. So think things like real estate or cars and boats. And with the right tax planning, you can time it such that you only realize those gains during a fiscal year when you have big capital losses to offset that gain. You can also skip the tax entirely if you pass that appreciated portfolio onto your heir when you die. Plus, owning property opens up higher earners to even more ways to chop down their tax bill.
If you own real estate, you can now deduct things as depreciation, real estate taxes, property taxes. Even if you are not investing in real estate to get rental income, even if it's your primary residence, you can itemize your tax deductions on a Schedule A, which can also lowerly affect your tax liability. On the other hand, if you do have rental properties, you can take advantage of depreciation, your expenses related to your real estate property, and earn some extra income while paying minimal tax on that additional income that you are earning.
And these strategies are just the tip of the iceberg. There's a whole patchwork of ways to drive down that annual tax bill.
There's not some magic deduction or magic credit that people overlook. And once I tell you, ooh, you're going to get a $10,000 refund. What there is a myriad of rules, opportunities, and options to lower your taxes. I'll give you a simple example. There's almost 12 different tax breaks for higher education, whether it be the tuition and fees deduction, 529 plans where you can put money in an account and have it grow tax-free.
Borrowing against the value of real estate or borrowing against the value of insurance policies. For example, you can take out a life insurance policy with a high cash dividend and then borrow against that from a bank. The bank sees that as an actual asset, may loan up to 90% of the value of that life insurance policy. That loan is effectively income to you, but in the tax code, it's not considered income or a capital gain. So it's tax-free. So there's these kinds of techniques that can be used if you have a lot of income and a lot of assets that are just not available to ordinary people that don't have that kind of disposable income.
In 2013, many-time Grammy winner Lauryn Hill was sentenced to 3 months in prison, 3 months of home confinement, plus a $60,000 fine for not reporting more than $2.3 million in income. She isn't alone. Some of the biggest names in Hollywood have had serious run-ins with the IRS for failing to pay their fair share of taxes.
To be clear, these are all examples of tax evasion, which is illegal, not to be confused with tax avoidance, which is legal, even if it is deemed unfair by large swaths of the population.
Tax evasion is illegal and is actually punishable for up to 5 to 20 years in prison.
And the law is pretty black and white. There may be some new grayness on things like cryptocurrency, and other new innovations in the world, but most of the time, you know it when you owe it. And I can certainly tell whether you owe taxes or not on a situation. But when people come in with fabricated dependents, made up deductions, phantom partnership losses, that's when you get into evasion. And evasion's the line crosser.
Those sophisticated tax strategies that we just talked about, they are all totally legal ways to avoid paying more taxes than you absolutely must.
Tax avoidance, on the other hand, is utilizing the tax code to benefit you in the way that is legal. So if there is a deduction for you having a dependent or you being able to expense something through a business, as long as you're following the tax code and guidelines, you can take these tax positions.
Thanks to lax enforcement by the IRS, tax avoidance by the top 1% of taxpayers could exceed $5 trillion by 2029, according to former Treasury Secretary Lawrence Summers. This same report found that the top 1% account for about 70% of underreporting. So why is it that the country's top earners also tend to be pros in the arena of tax avoidance? Experts tell us a lot of it comes down to tax planning.
Wealthy individuals, tax plan. Most Americans don't have a tax plan. And a tax plan is going to encompass the CPA or tax accountant to go into the new stimulus package or new tax reform and actually look at how they can use the new changes in the code to benefit their clients. These wealthy individuals have that guidance throughout the year to get them to a more reasonable position by year end.
A tax loophole is a provision in the tax code that allows people to reduce their taxes to a point below that intended by the lawmakers.
In other words, it's a technicality that lets the filer avoid a law without directly violating it. Not everyone likes the connotation.
Yeah, loophole's kind of a bad word. I'm not even sure what loophole means because it's either legal or it's not legal. And if it's legal, then it's not really a loophole. I would put forth it's a best practice. And what I would tell you, some of the best practice, not of just high income earners, but any smart, savvy taxpayer, is to take advantage of all the tax rules in the law.
Once embedded in the tax code, it's pretty difficult to get rid of a tax loophole. Each one not only benefits somebody by saving them money on their taxes, but it also typically has an army of lobbyists backing it up.
Sometimes they're not partisan because they are more about protecting a given economic sector or even specific businesses, and that has to do more with the locale. It might be more about what parts of the country, what states, what congressional districts have a certain economic sector that's very important.
Essentially, the U.S. tax system creates an incentive buy system for those who aspire to achieve wealth. And here's why. you get tax credits for having a business or having real estate. In that act, you are creating opportunities to employ people or creating opportunities to house people. Unemployment and homelessness are two of the major concerns for any government. So why not give tax incentives to those who are going to assist in creating a way to aid these issues? So if you close out tax loopholes and tax incentives, we don't know what the outcome would be, because this can potentially discourage individuals who are contributing to the vast growth of our economy to not make those contributions at a more accelerated rate.
Despite the quagmire of opposition, the question as to whether or not to close loopholes often pops up in elections and with new administrations. Just take the Biden White House. The president is taking aim at some pretty popular loopholes in the tax code, though it remains to be seen whether he'll succeed.
Wealthy New Yorkers may soon be getting the highest local tax rate in the nation.
The combined city and state taxes will be 14.8%.
In early April, the New York State Legislature passed a $212 billion budget for fiscal year 2022. Among spending cuts, it includes tax increases on the wealthy. Others have done the same.
New Jersey raised that top rate from 8.97% to 10.75%. for those making $1 million or more.
Revenues are bleeding, and states have to do something.
Honestly, if I had the choice of taxing the wealthy more or preventing someone from dying on the street, I would always choose the other.
Raising taxes on the wealthy is contentious. While advocates say it's fair in a way to decrease inequality, others say it'll drive the wealthy out. After all, the 1% are critical to state revenues, paying up to nearly 50% of total state income taxes.
There is a pack mentality to wealth. When all your friends are now in Florida and you're the uncool guy or woman who's in New York, that is something that could be a tipping point for why this becomes less of a trickle, as we've seen over the past 3 or 5 years, and more of a flood.
If they leave, there's a huge fiscal crisis. How do you pay for all of these services? And that affects everyone.
While tax flight is often talked about, it's hard to prove empirically. Someone may move for warmer weather or to get closer to family, and it just so happens that taxes are lower where they're moving. What we do know is that millionaires and billionaires are highly tied to where they live and make money.
Considering I can do what I do from here in South Florida, having no income taxes is a great draw, for sure.
If taxes were your sole consideration where you were doing business, you weren't in New York anyway. This, again, is really different.
At the early stages of the pandemic, wealthy people left to seek safety, not to save on taxes. And they have now spent over a year in their second homes and are no longer bound to their offices in New York City or San Francisco, or their children's schools. Raising taxes at this fragile junction could make the decision to officially relocate easier, and that could have serious repercussions for state revenues. Will the wealthy flee cities and states with high taxes?
The COVID-19 pandemic has dealt a heavy blow to America's states.
In the early months of the pandemic, state lawmakers were warning of unprecedented fiscal crises in nearly every state. The Brookings Institution estimated revenues falling by $155 billion in 2020 and $167 billion in 2021. More complete data later showed that states ended fiscal year 2020 in better shape than initially expected, mainly thanks to federal aid and the unusual nature of the recession, where wealthy and high-wage earners' economic situation only got better. Even so, local government officials have remained weary. Limitations on borrowing to fund day-to-day operations left states with two options: cutting expenses or raising revenue.
When we talk about economic recovery, rich people don't need a recovery. They're actually richer right now than they were before.
Among spending cuts, a number of states have either passed bills or are considering tax hikes on the wealthy to balance their budgets.
I mean, I'm happy to pitch in and pay the taxes for infrastructure, for education, for technology advances. If it's not going to some of those things, it does make it a little harder to support.
New York's tax increase may be the most rigorous, involving several tiers, starting for those earning $1 million to $25 million and above. They expire in 2027.
Now, I lived in New York, worked in New York, and now I'm going to live and work in Florida. And obviously, one of the reasons I'm doing that is for the lower taxes. It is very easy for financial firms to move to Florida because they don't have a huge head count. Those are the guys, the hedge fund guys, who make far and away more than the Wall Street guys, the biggest salaries.
in New York City. And so it doesn't take a lot to have a big impact on tax revenues, especially if you've been away and you say, you know what, that's what they're going to do. I'm just not going to come back.
You also can't ignore the evidence of 15 to 20% commercial vacancy rates and lower asking rates, and generally a picture that suggests the city's property taxes are going to be depressed for quite a while, at the very best.
Despite early reports that California was going in the same direction, in January 2021, Governor Newsom rejected the policy. The state had an unprecedented year and ended with a budget surplus of $15 billion. But this wouldn't have been the first time the Golden State would tax the wealthy.
In the 1990s, the tax cut didn't do anything to millionaire migration. Neither in or out migration was affected. The millionaire tax in 2004 didn't do anything. The millionaire tax in 2012, which was larger, had small migration effects. To the extent that there was an effect, it was mostly driven by people sort of finding ways to, essentially hide their money or find ways to report less income on their tax returns.
In December 2015, the wealthiest man in New Jersey, David Tepper, moved to Florida.
He pays so much in taxes that it's going to screw up possibly the entire state budget.
It was covered by most media outlets, and although he never explicitly said why he made the move, many assumed it was for tax reasons.
Frank Haynes, he's a legislative budget and finance officer to the Senate Budget and Appropriations Committee of New Jersey, says, quote, "We may be facing an unusual degree of income tax forecast risk if news reports are true that the person ranked by Forbes as the wealthiest man in New Jersey has shifted personal and business domicile to another state."
Tepper moved back in September 2020.
There's just this sort of one-way interest and anecdotes and stories about millionaire migration because, it fits a story, but, when you hear the counterexample, people don't know what to make of it.
Young has devoted much of his career to studying the mobility of high-income earners based on taxes, but he's one of the few. The idea that tax policy affects location decisions of wealthy individuals has long history, but the empirical evidence is limited.
Unless you interview people as they're getting on their U-Haul or G650 private jet to go to Palm Beach for good, you don't know what their reasons are and how those reasons stack up. It's always hard to say people move for tax reasons. What we can do and what we are studying is the parallel causality or coincidentality of higher taxes and outmigration.
According to Young, though, it's simple. Millionaires and billionaires spend a lot on trying to reduce their tax burden by hiring creative accountants and lawyers. They travel a lot, but they don't move a lot, and taxes are rarely their main consideration.
I always thought about it, of course, right? I mean, taxes are important.
That's John Caden. He's a member of Tiger 21, a peer membership network for high net worth individuals.
But really, I was motivated to be in New York City and develop my career there. After my marriage, didn't work, and I moved from New Jersey into the city, I recognized there would be additional taxes. New York and New Jersey are around the same at the state level, but I had the additional city taxes, and it was worth it for me.
New Jersey is my home. This is where I go to see doctors. This is, where I have all my contacts. And I clearly, taxes aren't going to be the motivational factor that's going to get me to move or re-domicile.
Those sentiments are true for most Americans. Rich or not, more than 2/3 live in the state in which they were born. And the 1.5% to 2% that do move from one state to another do it because of losing a job or family. And it's nearly as likely that those moves are from low tax states to high tax states. Of the ones that do move to a low tax state, it's primarily folks with low incomes rather than high.
The reason that people are moving is largely housing prices. And then they, oftentimes they feel like there's a lack of opportunity in that state.
Anecdotal evidence tells a different story. The Boyd Company is a site selection consultancy. They help clients choose the right location to operate their business.
Over the past decade or so, with respect to the exodus of California, markets like Phoenix and Las Vegas and Reno and Salt Lake City have been big beneficiaries. These are states that hold the line on taxes, that aren't in this never-ending game plan of borrowing, taxing, and spending. And the property and income tax savings for a relocating worker from San Francisco or Los Angeles to a no income tax Reno or Las Vegas, for example, are just enormous.
This is one of the greatest moves to the suburbs from urban areas.
We expect there will be something close to an exodus from these really large cities where housing is so expensive.
For months, News reports, preliminary data, and anecdotes suggested that the pandemic had ravaged state budgets. And because of the mass urban exodus, states should be weary of increasing taxes on the wealthy. States took 2 austerity measures and spending dropped by 6% in the second quarter. In reality, many states and cities ended the year in decent shape, especially with the arrival of President Biden's American Rescue Plan. California had a record year, and New York City's budget generated a surplus of $3.4 billion instead of the initially projected $4.2 billion deficit.
The wealthy and companies in New York are saying, wait a minute, we actually were on board fixing that giant hole we had. But if we don't have the hole anymore, that's a very small hole, and you're not cutting, and you're just going to tax us because there's a moral argument, well, then we don't want to be here anymore.
This, for a relatively small revenue hole, has the potential to become a self-fulfilling prophecy. If you're worried about the revenue losses because people aren't coming back, then probably the worst thing you can do is impose varied taxes that would make them not come back.
As for that mass exodus, it didn't happen. Except for March and April, patterns mimic 2019. Data collected by a number of moving companies show that the biggest inbound states were Idaho, North and South Carolina, and Maine. And the biggest outbound states were New York, Illinois, California, and New Jersey. Looking at regional data, California didn't experience a pronounced exit either, just fewer people moving in. Moves in and out of those living in the wealthiest zip codes were similar to other zip codes, except for in the Bay Area. There, net domestic exits increased 178% for the entire area and 649% for San Francisco alone, compared to 2019. But it doesn't appear people were escaping the high taxes. Nearly 80% stayed in the state. That's why looking at plummeting rent prices only tells part of the story.
The reason why there's so many anecdotes about rich Californians moving away is because there's an enormous population of rich Californians. If you want to pull out like a lot of examples of them doing anything, go to California, you'll find just an enormous base population to draw on. But, who's leaving California are, lower income folks who can't afford it.
The data aside, there are plenty of anecdotes of wealthy individuals leaving urban areas. They've been gone for over a year, and making it permanent will likely be easier than ever before. The question is, will it be enough to make a serious dent in New York and other states' revenues?
The pandemic just kind of sparked me to really think outside the box and think I can do this from anywhere. Even more since I've been down here, I felt the swell of businesses moving down here for sure.
There is now an emotional component to what was an existing financial component for why more want to leave. And again, we may find out that it was all overblown and they didn't leave. The challenge is it will be too late.
The U.S. spends about twice as much on healthcare than other large and wealthy countries do.
It's just a complicated product, and people have a hard time figuring it out, which is unfortunate because it's such an important product.
People are recognizing the importance of having available, affordable, quality services.
You have to make the commitment to provide health care for everybody. That's the destination. It turns out there are many different routes to that destination.
Healthcare spending is rising around the world.
As far back as we've been measuring this, healthcare spending has always risen.
Overall spending on healthcare has doubled over the past 2 decades, reaching $8.5 trillion in 2019, which comes out to 9.8% of global GDP.
The US spends about twice as much on healthcare than other large and wealthy countries do.
The US healthcare system is not as effective when it comes to controlling costs compared to systems in other countries.
The way the system is structured now, it is cure-driven system, not a prevention-driven system.
There's not one access model here in the United States. And so for preventive services, for treatment, it really depends on people's insurance status, where they're located, and the provider network near them.
It is extremely frustrating for not just patients, but physicians also.
The way we do it, by definition, makes things much more expensive for the US.
So why are US healthcare costs rising more than anywhere else? And can it be stopped? Healthcare spending made up 5% of total US GDP in 1960. In 2020, spending hit almost 20% of total GDP.
So what that means is that for every dollar that people spend in the US, about 20 cents is going towards healthcare.
This rise in spending can't be attributed to inflation alone.
Healthcare almost always outpaces inflation. And so, healthcare costs grows faster than the economy. That's why it's representing a larger and larger share of the economy.
The United States spends more per person on healthcare than other high-income countries, but still has a lower life expectancy.
We have poor outcomes relative to other countries. We pay twice as much as any other country. We pay more and get less.
We see that people in the US use a similar amount of healthcare to people in other wealthy and large countries, but we pay more for each interaction. The money's in hospitals and doctors. That's what makes up the big difference between what we spend on healthcare in the US and what other countries spend.
Hospitals, physicians, and clinical care made up more than half of total healthcare spending in 2019.
When we talk about ways to reduce spending, you can either look at ways to reduce the amount of care that people are getting or to reduce the price that people are paying for their care. And in the US, it seems that there needs to be more of a focus on the prices of care, because that's where the real difference is between what we spend in the US and what other people spend in other countries.
Drivers of the rise in healthcare spending has focused mostly on the symptoms of the rising healthcare spending. So when we are talking about hospitals, prices are very high, or drug prices as very high. These are not the causes of the high spending. These are the symptoms of high spending.
One of the causes of high spending is the fragmented nature of the US system. Some Americans have incredibly comprehensive and affordable health insurance coverage, while others have little to no coverage.
For some people, they might spend a very small share of their income on healthcare, and that's usually because they're healthier. People who are sicker will spend a very large share of their income on healthcare, especially if they're in private insurance coverage with a high deductible plan.
Over 11% of the US population was uninsured in 2020, with a large disparity when it comes to race. 51% of Americans said they have delayed or skipped medical care due to cost. That number jumps to 63% among those living in a household with an income of less than $40,000 per year. Even those covered by insurance say they've experienced financial trouble. About 46% of insured adults reported difficulty affording out-of-pocket medical costs. The WHO argues in a 2021 report that universal coverage would limit catastrophic health spending. This lack of universal coverage can make costs rise while also leading to worse healthcare outcomes, specifically when it comes to preventative care.
When costs become prohibitive for patients to seek care is that, number one, preventative care and preventing diseases from getting worse is always going to cost less. And the cost meaning to the overall system, it's always going to cost less.
Let's say somebody has no insurance or very little insurance, and she feels a vague pain on the right side of her abdomen. It would cost her $120 to go to the doctor. She's not going to do that. She's going to work through it. And 3 months later, she's in the emergency room, the first appendix. It costs $60,000. And we'll treat her. But if she could have gone to the doctor when she felt that first pain, the doc could have treated the infection. It would have cost $100.
There is a phenomenon in healthcare called the cost shifting. Cost shifting happens when healthcare organizations shift the cost of those who cannot pay the bill to others who are covered by insurance providers by increasing the prices somehow.
We also have to take into consideration the concept that, maybe 30% of these bills will go unpaid, which can be thousands of dollars. So at some point, if you want to keep your practice afloat, those have to be recouped in a different way.
This is a factor of the US healthcare system where how much people end up paying is going to depend on your insurance.
A lack of universal coverage and a fragmented healthcare system also mean that people don't have the same insurer for their whole lives, which means that insurers have less of an incentive to provide preventive services or to ensure that you don't get sick later.
The majority of Americans don't have much of a choice when it comes to their insurance plan. More than 54% get health insurance through their employer.
Capitalist view works when the market is free. Healthcare is never a free market.
Instead, we have insurance companies bidding on patients' behalf, which limits patients' ability to bargain with their healthcare providers.
We have what the insurance companies call narrow networks, where they dictate which doctors you can go to.
Patients also can't bargain because they usually don't know how much care actually costs.
One key requirement in a free market is to be informed about the price of the product or good you are purchasing. But in healthcare, patients are in the dark about what would the cost be when they seek their care.
Insurance makes prices even more opaque, not just for patients, but also for doctors.
Sometimes it is difficult to know upfront what a patient's costs are going to be for whatever services that they're getting. At the end of the day, we are actually not the ones controlling the rate for each different company. And even if we have a whole list of every single possible charge, we don't know if people have met their deductibles yet. We don't know where they are with respect to out-of-pocket maximums. We don't know, what their copay might exactly be, if it's a percentage.
A lot of care is delivered through what's called fee for service. That means for every service that your doctor delivers to you, that doctor is billing for each individual thing. And that can create an incentive called provider-induced demand, which is basically that your doctor has an incentive to do more things to you.
But it's more complicated than just greed. America's litigious culture can play a role in excessive testing.
I do think that in the United States, we do order more tests simply because, one, there's this fear of missing something. Of course, that comes from a human aspect where you don't ever want to misdiagnose a patient. But then there's also the malpractice side of things, where if you do miss something, what are the consequences?
Since there isn't true free market competition, insurance companies will try to rein in the spending by either denying claims or requiring pre-authorization.
Most physicians are doing the right thing and choosing the right treatments for their patients. But sometimes there are instances where the procedure that's being requested may not always be the most effective treatment for that particular patient. And sometimes the prior auth process also serves as kind of a gatekeeper, so to speak, of whether that physician has tried everything that could potentially help the patient.
There are proponents for completely overhauling the heavily commercialized system.
You have to make the commitment to provide health care for everybody. That's the destination. It turns out there are many different routes to that destination.
One of the more popular policy proposals is Medicare for All, which would replace for-profit insurance companies with government-funded health insurance.
I am a strong supporter of Medicare for All because it is our principal goal in this country to give everyone coverage at the lowest possible cost. And Medicare is the best way to do that.
President Joe Biden is instead focusing on expanding the Affordable Care Act to enable more people to get insurance. There's also been a bipartisan push for increased price transparency. Congress passed the No Surprises Act, which went into effect in January 2022. The goal of the legislation is to help Americans avoid surprise medical bills.
Now people who inadvertently go to an out-of-network provider, for example, by going to an in-network hospital but being seen by an out-of-network doctor, that patient is held harmless. And then it's up to the insurance company and the doctor to kind of work out how much gets paid to them.
Researchers and economists are still debating what exactly is driving these costs in the US.
It's very hard for people to know how much healthcare is going to cost them before they get it. Some of that can be addressed through price transparency efforts by basically posting prices on hospital or doctor's offices' websites.
Research has to be intensified in this area to clearly identify the root causes of the high spending and the interrelationship between the different routes.
There's a lot of moving pieces here, and there's probably not going to be one single solution to healthcare costs and access and quality of care and insurance coverage, but there's a lot of different directions that policy is starting to go in terms of actually addressing the healthcare costs in the US.
It's an open secret among Americans that calling for an ambulance is a financial gamble. According to one study, 71% of all ambulance providers do not take the patient's insurance. That same study found that 79% of patients who took an ambulance could get a surprise bill, with an average total around $450. And when nearly 4 in 10 Americans would have to borrow money to cover a surprise $1,000 emergency, these surprise bills can be a huge problem. The COVID-19 pandemic has exposed wide inequities throughout the American healthcare system. And like the rest of the healthcare industry, ambulance operators are feeling intense financial pressure from the crisis. So why are ambulance services so expensive in the United States? And what's being done to solve the problem? There's a broad price range for emergency medical services in the United States. The U.S. Government Accountability Office, or the GAO, found that in 2010, the median cost per ground ambulance transport was $429, ranging from $224 to $2,204 per transport. And that price can vary a lot by state. In 2016, the average price of an emergency ground ambulance in Georgia was $824. In New York, it was $752, $930 in Texas, and $557 in Florida. Even within the same state, the charges can vary widely. Take Florida, for example. In Lake City, Florida, the average charge for an emergency ground transport with basic life support services was $463. In Tallahassee, 2 hours west of Lake City, the average charge was more than $200 higher, at $680. In Miami, the average charge was $630, and Tampa's average was $590. A variety of factors contribute to this disparity in price, including the type of ambulance used, the medical services rendered, how far the patient was transported, the state and city the ride was taken, and whether the ambulance service was publicly or privately funded. There are many types of organizational structures when it comes to running an emergency medical service. They could be privately run or funded by the municipality and work in conjunction with other entities such as the fire department. They can also be a volunteer organization that's funded through private donations and grants. Art Cook and David Sloan work at Westfield Volunteer Rescue Squad in Westfield, New Jersey. The rescue squad is funded completely by grants and donations from residents and businesses in the town, so there's no out-of-pocket charge at the point of use.
We're lucky that we live in a very generous and affluent community, so we don't generally have difficulty raising the funds.
Because all of the rescue squads, dispatchers, and EMTs are volunteers, the organization can operate without high staffing costs.
As with any labor-intensive organization, your highest cost is going to be payroll.
Supporting a nonprofit ambulance provider through donations can be tough for less affluent areas, as well as dense urban areas with high call volumes.
If a less affluent town were not able to meet the fund requirements of that individual rescue squad to be able to supply their ambulances, or if they have a problem getting volunteers to be able to operate that system, each town would look for an alternative to be able to provide ambulance service. And more often than not, that either becomes contracting with a private ambulance service, or which is a cost, or hiring EMS personnel under the auspices of their police or fire department.
Many patients who get surprise ambulance bills can trace them back to for-profit companies.
My name is Karan Chabra.
I'm a resident in the Department of Surgery at Brigham and Women's Hospital. Surprise medical bills happen when you get medical care from somebody who you were unable to choose, and that person or that provider doesn't take your insurance. So in those situations, if they don't participate in your insurance plan, they can charge you whatever they want to be paid.
Dr. Chabra and his colleagues recently released a study that evaluated insurance claims from a large national insurance plan, focusing on the years between 2013 and 2017. The data couldn't tell them how many patients actually received surprise bills, just how many could have if the ambulance provider decided to bill them for what the insurance company didn't pay. They found the average patient could be charged $450 per ground ambulance ride after the average insurance payout. Contrast that to the potential surprise bill for an air ambulance, which came in at a staggering $21,700 per ride. Ground ambulances usually get the focus when it comes to surprise billing, even though they cost less than air ambulances. That's likely because ground ambulance rides are 55 times more common than air ambulances. Chabra's analysis found that potential surprise bills for ground ambulances over the 4-year period he studied would add up to more out-of-pocket costs overall than air ambulances. Despite being less common, air ambulance billings are trending upward. Chabra's study notes that potential out-of-pocket air ambulance fees are catching up, with a 15% annual increase in potential surprise billings for air ambulances between 2013 and 2017. Betsy Imholtz is an attorney who used to work on healthcare issues at Consumer Reports, a nonprofit consumer advocacy and research organization.
One of the arguments about why there's more air transport these days for medical reasons is that rural hospitals are closing. But we found, in fact, that there's a lot in metropolitan areas. Some would say the traffic has gotten bad, and so we need to even transport people locally in highly concentrated, populated areas. For whatever reasons, there's a lot more of it going on all over in all kinds of areas now.
Imholtz says one reason for this spike could be the air ambulance industry shifting more toward a for-profit model.
Between 2012 and 2017, more than 100 new helicopter bases were added, some of those in areas where there already were services. So they're duplicating services, not responding to higher demand.
When air ambulances first started to be used in New Jersey, they were run by the state police and didn't charge for their services. Now there are also competing private air ambulance services that are generally affiliated with hospitals.
In a normal functioning market, this would work. If there were more suppliers present in the market, then prices should go down. But the problem is that people in medical emergencies don't get to choose their ambulance provider. The ambulance provider is dispatched by a 911 operator. And since they don't have to take your insurance by law, they can charge you whatever they want. So there's no price competition. There's no pressure driving down prices.
In some cases, there's been an argument over whether patients' medical issues were urgent enough to warrant the use of air transport.
Some of the consumers that we interviewed felt that they had been unnecessarily transported by helicopter when they really didn't need to be. It was an urgent situation, but they felt that by the time the helicopter landed and picked them up and got them to the hospital, they could have even more quickly gotten there by ground transport. So it's very hard for consumers to know, was it really necessary or not? And often that's a fight with insurance companies. Was it medically necessary?
A big problem is that emergency medical services are expensive to operate. The amount of revenue that's generated from even the most efficient ambulance systems is limited by the fact that if you want the ambulance in your community to be available for you when you need it, that means they can only really be doing ambulance calls about half the time at best.
But not much data is available about how much ambulance services cost to operate. Aspel Montez is the Senior Vice President of Strategic Initiatives for Acadian Ambulance Service, as well as the chairman of the Payment Reform Committee for the American Ambulance Association.
We are one of the last industries to do any type of cost data collection, or what in most people refer to it as cost reporting. And that is something that we have advocated for as an industry. We do not have a mechanism like hospitals and any others that are actually having to do cost reports to validate their the Medicare payment system. That is not, we do not have that data yet.
The GAO and the Nonpartisan Medicare Payment Advisory Commission, or MedPAC, do collect some data regarding reimbursement rates for EMS providers. But those within the industry say the reports do not accurately estimate costs of service. The lack of comprehensive data also leaves some consumer advocates, such as Imholtz, concerned.
The question is, what is the real cost of providing this service? And are people price gouging? Are some of these companies price gouging? Because of the private equity control of many of these companies, we really don't have the data on what it really costs, how much is profit, how much is surplus, how much are unnecessary rides. They're just building up more supply than they really need to. So there's a lot of information lacking still.
Many private insurance companies consider most EMS providers out of network. This means the two entities do not have a predetermined agreement about how much the service costs.
The way reimbursement's set up right now, it's often more profitable for these ambulance companies to avoid contracting with the insurance companies. It's more profitable to stay out of network. So why would they bother, writing a contract?
The American Ambulance Association does not believe the concept of in-network or out-of-network should apply to emergency medical services.
There's really no such thing as an out-of-network 911 provider. You might be the city of, and I'm just going to throw out a name here, the city of Houston, who provides their own EMS services. If you as a citizen do not have a choice in who your 911 provider is, that is set by the mayor of that city and the city council saying the city of Houston is the one that provides 911 services. How is that out of network? So the issue there that we've got going on is the insurance company is denying it wrong, saying the city of Houston does not want to be in our network, and so they're out of network. No, the issue is you don't like the rate that the city of Houston is charging.
In addition to private insurers not paying the entire cost of the bill, government-funded insurance plans such as Medicare and Medicaid don't cover the entire cost of the service either. A report conducted by the Moran Company, contracted by the American Ambulance Association, concluded that EMS providers lost money from Medicare and Medicaid rides.
That did conclude that we were being reimbursed below cost for Medicare. And then Medicaid, remember, actually reimburses less than Medicare does.
We often hear that there's cost shifting, that much more has to be charged of private pay or even uninsured people because the reimbursements either from insurers, Medicare or Medicaid are insufficient. And we haven't really found the evidence for that to be valid.
So how much should ambulances cost patients out of pocket?
The main reason we have out-of-pocket costs for any healthcare is so that we don't use healthcare willy-nilly and without some rationale. So we want to discourage things like calling an ambulance for a routine stomachache. So the out-of-pocket cost for anything should be just enough to discourage people from overusing ambulance services, but not so high either that they discourage appropriate use or they make people go broke.
And the problem is you have to balance this out so that the patients don't get hit with a $3,000 bill, but at the same time, you want to also have some controls over utilization. So while you don't want bills that are going to bankrupt people, you do want bills, preferably some kind of payment at the point of service, which discourages people from utilizing an ambulance when they don't really need one.
There are some countries that do maintain low out-of-pocket costs for ambulance services. Take Australia, for example. Ambulance fees do vary in Australia from no out-of-pocket costs to more than 1,000 Australian dollars in certain regions. In some of the Australian states and territories where there are no out-of-pocket costs, many residents call for ambulances without actually having an emergency. Because this puts a strain on the system, Australia runs a public education campaign urging people not to call an ambulance if it isn't an emergency.
000 ambulance emergency.
Yeah, g'day. Look, I think I've sprained my wrist. I've had a cold for 3 days now.
Last year, Ambulance Tasmania received too many trivial 000 calls that could take us away from real emergencies. Save 000 for saving lives.
Rational people behave in rational ways. If you're poor and you could either have to call an Uber and pay for the Uber at the point of service, or you call the ambulance and not have to pay at all, people call the ambulance because that's perfectly rational.
Despite there being agreement on both sides of the aisle that this is an issue, it's been difficult to make progress on legislation.
It's been a completely bipartisan issue. There's been proposals that have been agreed upon by both Democrats and Republicans in both the Senate and the House, and remarkably, the Congress and the President agreed on this as well.
Congress has taken some steps toward collecting more cost data for the industry in order to better understand reimbursement rates.
The Bipartisan Budget Act of 2018 did actually mandate a cost data collection provision to start this calendar year for the ambulance industry. Over a 4-year period, they will basically mandate every ambulance provider and supplier that bills the Medicaid program will have to, at a minimum of one time, report their data. And they will do an analysis on the system from all of the rates that we get paid based upon the different organizational types to understand where are we being paid inappropriately.
The legislation authorizes what is known as extender payments for ambulance services. These are Medicare add-ons that increase the payments depending on the area the providers are servicing.
Basically, Congress this time said, we want data from your industry. You keep telling us, based upon the GAO reports, the MedPAC reports, that we are underfunded, or you're reimbursing us under cost. Well, in order for us to give any more money in here, we'll extend these for 5 years, but we're going to mandate cost data collection.
Some states have also been working to pass laws to fill the holes of federal regulations, but they can be met with legal challenges.
There are many states that have tried to intervene to protect consumers on this, several of them at least. But generally, the industry comes right in and takes them to court and challenges the law.
Under the CARES Act, one of the coronavirus relief packages, any provider that got federal funding through the relief package is actually banned from balance billing anyone with suspected coronavirus.
Well, you can't help but think about our big healthcare system in the middle of this pandemic kind of crisis, and people are recognizing the importance of having available, affordable, quality services for us. And certainly in the emergency context, as we rethink the healthcare system, I hope that as a nation, we will just really think hard about whether we want to leave emergency services on a catch-as-catch-can basis with unbridled for-profit companies without any rate regulation, or whether we really want to think this through carefully and have a system that ensures that every American can get the care they need without going bankrupt.
Most Americans pick the wrong health insurance plan. Sora Bhargava and his colleagues at Carnegie Mellon University conducted a study of almost 24,000 employees at a major Fortune 100 company. The study found that 61% of them chose the wrong plan for their needs. The researchers estimated that the average employee could have saved $372 per year by choosing a different plan.
The average cost of these choices was about 2% of salary.
In 2018, over 8% of Americans' total household spending went toward healthcare costs. This represents about a 37% increase since 2004.
It seems like people aren't able to maximize their welfare because they're having trouble understanding the decision environment.
It's just a complicated product, and people have a hard time figuring it out, which is unfortunate because it's such an important product.
So why do Americans struggle to pick the best plan for them? And how can we fix it? One major issue in choosing a healthcare plan is people don't understand the lingo insurance companies use to discuss each plan.
We usually ask every year, what is a premium? What is a copay? What is a deductible? And the results are usually pretty depressing. Only about a third of people usually correctly identify all three. These are the most basic terms to understand.
This basic lack of literacy, I think, contributes to a number of problems that people have exhibited when they do choose from a plan.
The way plans are presented to people makes it difficult to figure out exactly how much each plan costs.
People have trouble doing the math from the features to the consequences. We see things like, what's the deductible of each plan? And what's the copay of each plan? And what's the maximum out of pocket of each plan? The part that's difficult is to actually then say, okay, so suppose next year I break my leg and I go to the hospital. How much money do I actually spend under each plan?
There are premiums, which is the amount of money people have to pay each month, regardless of whether they go to the doctor. This is the bare minimum someone would have to pay for their plan each year if they don't use any healthcare at all. There are also deductibles, which is a set amount of money a policyholder has to pay out of pocket in the beginning of each year before the insurance plan will kick in and start sharing costs. It's common for people experiencing information overload to hyper-focus on one aspect of a plan, such as how much the deductible is or how much the premium costs, rather than looking at the plan as a whole based on how much healthcare they'll actually use over the course of the year.
When you're in a decision environment that's complicated, is to try to simplify it for yourself in some way that you can. And often that's a rule of thumb or what we call a heuristic.
But in some cases, they can go awry. And I think in the case of a lot of health insurance contexts, the heuristics that people use result in them selecting overly expensive plans that end up costing them quite a bit.
A lot of people are basing their decisions on the absolute numbers they're seeing presented to them rather than calculating their financial risk with each plan.
One challenge that I think people have is that while plan choice really should be about your health risk and your willingness to take on financial risk, I think a lot of people, they look at more expensive plans and they see more expensive plans as being better. Almost like choosing a hotel.
Research has shed light on how to best help people determine the plan that makes the most financial sense for them.
Find that showing people the consequences improves the choices that they make.
The best way is to do the math and figure out how much a plan may actually cost over the course of the year based on how much healthcare the policyholder might need. One study gave people several health insurance plans to choose from. The researchers also gave the study subjects some help choosing their plans by laying out exactly how much each plan may cost based on how much healthcare they use that year.
We designed as this tool that allows you to see for every potential expenditure under each plan, how much money you actually are going to be spending over the course of the year in terms of both the premium you're going to be spending and then also how much you're going to be on the hook for relative to how much the plan is going to help you out with. And we could show it in a graph, and you can actually see some plans are above other plans in this graph in terms of how much money you're spending overall. And the tool helps people to pick a plan that over the course of the year, they end up on average spending less money.
Some employers and state-run Obamacare marketplaces are beginning to provide decision aids, such as calculators that help people make the best decisions for them. If you are going to do the math yourself, take into consideration your own health risks when doing so. That means considering the best case scenario where you may not need any care or just preventative care, and the worst case scenario where you need a lot of care. You should also be careful to check which doctors are in network within specific policies, because the doctor you go to can change costs dramatically.
If you have expensive health conditions or kind of a serious health history, I'm a cancer survivor. So I have a group of doctors who I really want to keep seeing because they've saved my life a couple of times. So it matters to me that, they're in my plan network. I can't necessarily guarantee that all of your doctors or the facilities that you go to, the treatment facilities and so forth, are going to be covered. So you're really going to have to check. It's not very transparent. So all the plans have a link to a provider directory, but you're going to have to kind of click into all of them.
It's also important to revisit a policy every year to see if it's still the best option that fits your needs, even if your employer hasn't made any changes to the plan.
So only 20-25% of employees in employer-sponsored contexts will actually change their plan from year to year. So if you choose a poor plan from a financial basis, then normally you stick with that plan for, potentially multiple years. So it can become quite a costly choice.
There are places for people to turn to get assistance.
If you are looking at marketplace coverage anywhere, there are navigators. These are trained experts who can help you walk through the application, answer any questions, what am I supposed to fill in here, and help you kind of sift through the plan choices and try to figure out how they're different and which one works best for you.
Picking the wrong plan means people are spending more money on healthcare than they have to, and the numbers show it. Healthcare costs in the U.S. have been rising overall due to a variety of factors, including out-of-pocket expenses for Americans. Healthcare spending in the United States has gone from 6.9% of total GDP in 1970 to more than 17.5% as of 2019.
When we are spending that amount of money on healthcare, that money is not available for other sectors of the economy.
The average American household is also spending more on healthcare. According to federal data, average deductibles in employer plans more than doubled between 2008 and 2017, from $869 to $1,808. Cost of living as a whole is also getting more expensive, which puts more pressure on Americans because wages have not been keeping up with this increase in prices. The average household income in the US increased by 27% between 1984 and 2020. In that same time period, the average American household spending on food rose 155%, spending on housing rose more than 160%, and out-of-pocket spending on medical care rose more than 390%. This burden of incomes not keeping up with costs has implications for what kind of plans Americans are drawn to. High deductible plans can be a big problem for a lot of people because they may not have the cash for it.
The recent proliferation of high deductible plans across the employer-sponsored landscape is that there's a real worry about liquidity and being able to pay for out-of-pocket costs. These liquidity concerns are also driving people to select what end up being fairly expensive plans.
Bargava's study found that employees earning less than $40,000 per year were much more likely to select a plan that would end up costing them more money. Lower income employees were also less likely to switch their plan each year, and even when they did switch, they were less likely than higher income employees to switch into the highest deductible plan.
The high deductible plan tends to be the better value over the long term because that plan, you're paying a lower premium. And then under many states of the world, especially the ones where you're relatively healthy, you end up paying less over time.
Ultimately, economists say that the whole system needs to be simplified in order to provide plans that are higher quality while also being more affordable.
Whereby we get rid of a lot of the complexity of cost sharing and replace it with just a much more simple, much more transparent menu of options.
But attempts to make the actual costs of plans clear can backfire. For example, on the Affordable Care Act marketplace, which is frequently called Obamacare, people are presented plans using a metal tier system. A plan could be labeled as platinum, gold, silver, or bronze. These are meant to help people understand the cost-sharing features of each plan. So the platinum plans have the most financial coverage. The insurance company would pay 90% of costs at time of service, and the policyholder would pay the remaining 10%. The trade-off is that those plans have a higher monthly premium. At the other end of the spectrum, a bronze plan has the least amount of cost-sharing support. The insurance company pays 60% of the cost of service, and the policyholder pays 40%. Research shows that people are misunderstanding the metals, thinking they're actually a reflection of the quality of the plan rather than the amount of money they'll end up paying in monthly premiums or out-of-pocket costs at time of service. President Biden signed an executive order in July 2021 that aims to improve cost transparency and standardize plans on healthcare.gov starting in 2023. The goal of the order is to make it easier for people to compare across plans. Several states such as Maine, Massachusetts, Oregon, Rhode Island, and Vermont have rolled out budget comparison tools to help people navigate the state's local health insurance exchanges.
Well, I think giving people access to this type of data in a way that is simple to understand would definitely be helpful. Having more information that is easy to understand is very important.
The pandemic brought on a boom in the housing market, with home sales reaching the highest levels since 2006. I know I spent a lot of time perusing Zillow.
An insatiable demand in the housing market right now, causing sales to skyrocket. That from one prominent housing expert, as new home sales soared 19% over last year.
People in general looking at a home that they want to buy or build, their first question is not, do you have sprinklers in this building? Or do they look around and see this beautiful forest and say, oh my God, it's going to be on fire in 2 years?
2020 also meant a lot of natural disasters. It was the worst fire season in US history, and there were over a dozen severe weather storms that each cost over $1 billion.
We're not going to be able to create fireproof houses, non-ignitable fireproof houses, because by and large, nobody wants to live in those.
Building towards a resilient nation saves money, saves the environment, saves lives.
In 2019, just shy of 1 million new people were displaced due to climate disasters in the US. The good news is that that number is down from 1.25 million in 2018 and 1.7 million in 2017.
We're delivering a very safe product that is making people's lives so much better. Could we do it better? Absolutely. We can always do things better.
Cost is a big consideration. I know it was for me when I was doing my Zillow research, but I'm lucky enough to be able to afford to rent an apartment with adequate safety measures. For example, this fire sprinkler. So America needs to get a lot of people into homes that can withstand the ever-increasing wrath of natural disasters quickly. But is the US approaching building homes all wrong? And how should houses be built in the US? Nearly 1.3 million privately owned new housing units were finished in 2020. Those should have been built to the building codes and standards set by local regulators, usually based on guidelines from the International Code Council or the ICC.
The codes basically say if you have this kind of function going on within a building, in this kind of building, you can use these standards in order to meet our level of safety, sanitation, etc.
When you build in an area, one of the first things you do is you acquaint yourself with the exact code requirements that will affect the development and building process at that specific site. Then the specifics, you also check against the code as you go.
Though we at FEMA are active in that process and engage in promoting these hazard-resistant building and fire codes, it is really down to the local level to adopt and implement those new codes and standards.
Industry experts try to keep up with changes in technology and include evolving environmental factors when designing codes.
Every 3 years, they republish their codes. It goes before a committee that review these things in a public hearing format. That then goes back out to the entire membership. A ballot is open to them to come in and vote on whether they want to see this code change be introduced.
I think one of the biggest challenges in a code development process is there are all sorts of competing interests and needs. And it's really important that if you're a proponent of a code change and you're trying to move that code change forward, you have to engage in the process.
These codes are enforced at the local level. Punishments could include revoking permits or holding up construction. And in construction, time is money.
$1,000 added to the price of a new home at any time in any way, we will eliminate 153,967 households from being able to buy that home. Just $1,000 increase.
A faster build might help save money in the short term, but be devastating in the long run.
The last hurricane we saw in Florida with that one house left standing on the beach was a rather interesting solution. It was an extremely expensive solution, but it was a lot less expensive than the solution that all their neighbors had when they didn't have a house anymore.
Since the first edition of the I codes, the international codes, for example, in 2000, communities that have adopted them have saved the nation approximately 1.6 billion, that's a B, billion in average analyzed losses from flooding, hurricanes, and earthquakes.
Building to withstand the forces of nature can be tricky, especially as our understanding of the environment changes.
If you're looking to buy a home, the best thing you can do from a flood perspective is know what your current risk is from the current environment, and then how that'll evolve over the next 30 years. And flood risk isn't a static, one-time thing that you need to look at. It is an ever-evolving risk that continues to grow in some parts of the country at an exponential rate.
Since building codes can change frequently, staying up to code is easier said than done. For example, depending on when a home is built in a community, different flood or fire regulations may be required.
If you have a large community, you can find yourself building under different code requirements. And what's also quite easy to evaluate is the increases in cost, for example.
Homeowners may choose to invest in resiliency measures to stay up to code as opposed to buying a brand new house.
If we work toward addressing existing structure as well as new homes, what we find is that at times there's so much focus on the new that they bear way out of percentage what the price tag should actually be. So we can't have that burden on new homes because we're losing too many first-time buyers, first-time move-ups.
There are examples all over the country where communities have evaluated their risk and then adopted resilient current building codes to address that.
For example, a fire may not cross a street if nothing on the other side of that road ignites from the embers. Communities that are flood prone may choose to build trenches in the street to catch excess rainfall, as opposed to letting that flood into a home.
So what we want to make sure of is that we eliminate most of the ignitions. And in high density neighborhoods, we can begin to do that with very limited or no window exposure between houses. And we can have the exterior materials non-flammable, including our eaves and the boxing of our eaves using, let's say, fiber cement. So we can have fiber cement on the walls. We can have a non-flammable masonry material like block or something on that order, and then use a non-flammable material for eave facing and boxing. Okay, non-flammable roof. That will help greatly.
Flooding is a little trickier than fire, but the floodplain map provided by the National Flood Insurance Program provides some guidance for stakeholders.
I would say it's less about, from my perspective, whether we're building the houses incorrectly, and more so, where are we building these houses? So when you look at the things from FEMA and the special flood hazard areas, they come with a base flood elevation. Those base flood elevations are built on engineering grade, amazing studies that they do at that time. The problem is that about 11% of those studies are from the 70s and 80s. And if you think how the environment has changed since the 70s and 80s, to not then have that incorporated in the new base flood elevation and where we should be thinking about building and why, you start to see why that can be an issue. Further to that, there's a whole swath of the country that just doesn't have any regulation around this within the special flood hazard area because it's never been mapped.
The codes can't solve everything. A resident's behavior has a huge role in stopping fire spread.
It won't help us if we keep our firewood on the deck all through the fire season. It won't help us if we have patio furniture that's ignitable from firebrands next to the view windows.
Research like Cohen's can save lives and billions annually. Being cognizant of where structures are built is important too.
There's lots that the individual homeowner can do to help prevent a fire from actually spreading further or causing more damage than if you just didn't take any action, or maintaining your yard and other items like that in a very similar way to flood, where you can raise your home, or you can put in backflow preventers, or you can have sandbags and other things like that ready for those flooding events when you know they're coming.
The good news is that displacement due to natural disasters is on the decline, mostly because of better research and innovations to address the issue.
Our perception of the wildfire rolling through the community like some tsunami of hot gases, that is not what happens in reality.
We've also had significant success in improving fire safety in the past.
I don't know about your apartment. I think I see sprinkler head in the background. That's why. And that has been incorporated into the model codes in some degree. I wish it were stronger. But there are those who think that's a burden. It's a cost impact issue. It's difficult in some communities because of water supply issues. There are problems with it. It's not perfect, but it's certainly better than not doing anything.
We created a national flood model across the entire contiguous United States that can be applied to an individual property parcel. So based on the building type, the elevation of the building, the value of the structure, and our flood model, we're able to leverage the Army Corps of Engineers, what are called depth damage curves, to know how much water would equate to what damage to that structure, and then calculate that on the fly and give it to you as the user. So now not only do you know how much risk you have, but what that'll likely cost you if that event does take place.
They plan to move to fire next. Cohen is collaborating with federal and local officials to better inform builders to stop the spread of wildfires through his home ignition zone research.
Fundamentally, we need to define the problem as a structure ignition problem, not a wildfire control problem. We have a lot of decisions we can make effectively in changing the local conditions of the house and its immediate surroundings. And we have zero opportunity to control extreme wildfire.
This effort is also supported extensively at the federal level by FEMA.
I really want to encourage people to go to the FEMA website, download the app, go to the United States Fire Administration's website, download the information. There is a tremendous amount of great information there for individuals to help them be resilient before, during, and after a disaster.
Architects and builders suggest that consumers like me need to adjust our mindsets to include safety as a top consideration. This will allow people to make the necessary adjustments to stay in their homes longer, and therefore slow the flow of climate migration and have better financial investments.
People see the events occur, the wildfires, the floods, the daily news that somebody died in a house fire. But it doesn't stick. It doesn't change their perceptions. And that's to a certain degree why architects are there, to guide their thinking.